derivatives are good for the market ecosystem. Derivatives aid in price discovery. They create depth in the market. They allow market participants to risk manage appropriately, including hedge positions or take active positions. Trading, hedging, derivatives are good for the ecosystem. Capital formation is the theme of this particular conference. Price discovery, market depth, hedging, risk management are essential for sustained capital formation. So let there be no doubt whatsoever. As an ecosystem, as first-line regulators, exchanges, clearing corporations, depositories, as SEBI, we are for a thriving, healthy, sustainable derivatives ecosystem. Anytime you have any doubts whatsoever, try and remember these words. This is our overall overarching philosophy. Then let's reflect on what is it that has happened over the last few months, which have been a topic of discussion. In January 2023, our research team, many of who the senior officers are present here, if you recollect, came out with a report which suggested that 89% of all individual traders actually lose money in futures and options. This was followed up by a second research, updated research, which was done sometime middle of last year, towards the second half of last year, which found that for the last 3 fiscal years, 93% of individuals trading in derivatives were actually losing money. There are 2 areas which catch regulatory attention. The first is investor protection, particularly small investor protection. Whatever you say, we cannot close our eyes to investor protection. If you look at the SEBI Act, the very first pillar which defines why we exist is for investor protection. So that is an area which naturally has to be something that we think about. The second area which we have to think about is market stability, which means if there is any excessive positioning or trading which creates the potential for market instability, we have to be concerned. Now, what we tried to do is not throw the baby out with the bathwater, not paint everything with one broad brush, but be very, very thoughtful about what the issues are, if any, in the derivatives ecosystem. So while the research was done first in January 2023 and then updated sometime in August, September of 2024, no steps were taken by SEBI whatsoever to do anything with respect to derivative markets. So what are the issues that we found in the middle of last year and through the course of last year? And there was a lot of public debate about this. One, as I mentioned, investor protection was a question that came up because small derivative traders were consistently losing money. Second, which is less appreciated, what we found was that a lot of these losses were actually coming in index options trading on expiry day. So effectively, we were not painting all derivatives with one brush. We were focusing clinically and surgically on the issue of over trading on expiry day in index options. That seemed to be the area of concern from an investor protection perspective. Second, there was also a market stability issue that was coming up, again with respect to index options trading on expiry day. Not in single stocks options and futures, not in futures, not in normal index options trading, only on index options on expiry day. What was happening with respect to financial stability, potential financial stability? The open interest in the market in index options, in any way you look at it, both in notional terms as well as in actual risk and delta and future equivalent terms, was actually going up through the course of the expiry day, right up to minutes before the expiry. What that meant was, now let me be very clear, our ecosystem is very safe. Our exchanges, our clearing corporations, our depository, our risk management is second to none in the world. Everything that we do is adequately margined, and margins are collected at an individual trader's level, not at a broker level, but an individual trader level. So there's a lot of safety buffers involved. Nevertheless, if God forbid, if there was a world, event like a 9/11, 10 minutes before expiry day, on the day of an expiry, the impact on the market could have been heightened because of the nature of the positions being built up. So this was the specific area of concern that we noted, which is specifically trading in index options on expiry day. So the steps that we took subsequently, after a lot of deliberations and consultation, we received more than 15,000 responses from market participants to our consultation papers. And we took many of the responses on board because they were very logical and well argued. We took a series of steps. Effectively, 5 out of those 6 steps were essentially to curb excessive overtrading in index option on expiry day. They were very, very clinical, very, very focused. The 2 biggest steps was reducing the number of expiries and increasing the extreme loss margin on expiry day for expiry day trading. The others are still coming into effect, and some of them will not have too much of impact. But these are the 2 large steps that we took. Now, again, what I want to emphasize is while there was a lot of noise on both sides, there was one set of arguments saying, "Jala do ye dunya, band kar do derivatives." There were other side of the argument saying, do not get involved, let innovation be there, let the market decide what needs to be done. You as a regulator, stay away. We had to find what is a rational, objective middle ground. On the second argument, that do not get involved, do not come in the way of innovation, I can tell you as regulators, we think about this all the time. We know that we cannot play God. In fact, one of the mottos and the maxims that we keep reminding ourselves is, first principle, do no harm. It's a part of the Hippocratic oath of doctors. With the best of intention, you might do something which will actually make the patient worse. So we are very, very conscious of this, which is why it takes us time to think through, consult, make sure we are all on the same page, and then thoughtfully arrive at something which is balanced. And then we calibrate the steps as we go along. If you have done too much, we'll bring it back. If you have not done enough, we will take some more steps. So that's the incremental consultative approach that we will always take. Do not worry about something coming as a jhatka overnight. Okay? So this is where we stand. We have taken some steps. Now, we are often asked, what is the impact of these steps? I have to caution you, it's too early to tell. We all want instant analysis of what is happening. The reality is there are so many variables involved. There is seasonality, there is market context, there is who's participating, what is the mood in the market. It's not a univariate equation where regulatory steps and volumes can be correlated simply. It's a very, very complex equation. Having said that, ceteris paribus, keeping everything else constant and assuming nothing else is changing, ignoring seasonality, ignoring December month, ignoring activity of FPIs, everything. Yes, in the first month where some of the steps have kicked in December, we have seen a reduction of about 31% in the volumes, in the notional volumes. We have seen about 13% reduction in the actual premium, which means the number of trades have come down, the notional volumes have come down, but the premiums really haven't come down as much, which is precisely what we want. We want the quality of the trades to improve rather than a wholesale, reduction in the overall ecosystem. Having said that, I have to emphasize, do not go with these numbers. There are plenty of variables at play. We have to watch for the next 2-3 months to see how things work out. I want to emphasize one thing. At this point in time, there is no thought of SEBI taking any further steps in this particular regard. We will watch how things play out. We are in no hurry to follow it up with any additional steps. And whatever steps will be taken with full consultation, as the chairperson mentioned yesterday. Having said that, that doesn't mean we stop doing our work. There is an expert working group set up under the chairmanship of Mr. G. Padmanabhan, the former executive director of RBI, which is looking into derivative markets. We also take whatever recommendations they have to the Secondary Market Advisory Committee. Again, as our chairperson mentioned yesterday, we have a lot of committees that we go through, including with public consultation on all our steps. There are some discussions happening at this expert working group on the next set of ease of doing business and better risk management. This has nothing to do with curbing derivatives. This has everything to do to see how can we grow the ecosystem further. Now, in the interest of disclosure, because we often get queries from the friends in the media saying, I'm hearing ye ho raha hai, tum log ye kar rahe ho, tum log ye karne wale ho. Let me try and, in the interest of openness, tell you what we are thinking. With the caveat, we are still in the stage where we're being guided by the expert working group, then we will do public consultation, then we'll go to the Secondary Market Advisory Committee. So none of our thoughts are cast in stone. It will be guided by whatever you tell us. But in the interest of openness, let me tell you what are some of the thoughts that are going through our mind. The first, which I think is a crucial change that we are looking at, is trying to see if we can measure risk better in the derivatives market. Now, let me explain to you a little bit of the background of what we are thinking here. You know, since time immemorial, particularly for single stock futures and options, there's been one overall concern that the market has tried to grapple with. What you need ideally is that the volumes in the cash market should be nice and liquid and there should be depth in the market. And likewise, the volumes in the derivative market should also have depth, should also have good volumes. If you have lopsided markets where the volume in one dominates over the volume in the other by a very large margin, that creates conditions which could possibly lead to things like manipulation or unnecessary volatility, etc. So making sure there is some kind of connectivity in the liquidity in the two markets is important, so that there is a nexus between the two markets which is healthy and good for the overall ecosystem. So, you know, one way of expressing this has been there should not be a tail that's wagging the dog. Either the cash tail wagging the derivative dog or the derivative tail wagging the cash dog. They should both be somewhat comparable in terms of market impact. So what we have done in derivative markets so far, particularly in single stock futures and options, is to have this concept of market-wide position limit, which means what we say is that the collective positions across everybody, measured in terms of open interest, should be limited to a particular number called the market-wide position limit, which is set at 20% of free float of that stock. This is the philosophy that we have followed for a long, long time, and it's a good philosophy. Couple of issues that we are thinking about here, again subject to consultation and whatever discussions happen in the wider marketplace. One is the way in which we measure open interest today is notional volumes of futures and options put together. So we add whatever is the notional open interest in futures, notional open interest in options. Now, all of you are smart. You're young people who have gone through math, who understand math, and are a generation ahead in terms of risk management. You will all appreciate that adding open interest in notional terms across futures and options is a classical example of adding apples and oranges. The two are not additive, they are not equivalent. Option has multiple risks. They are called the Greeks. They have delta, theta, gamma, vega, etc. But delta is the immediate risk that comes out from an option. It's called the future equivalent as well. That is additive with a future position. You cannot add notional of option with a notional of a future. You have to add, at best, the delta of an option with the notional of a future. So this future equivalent is a metric that makes far more sense than adding notional on both sides. This is a transition that we are exploring making because it is good. And by the way, it's an ease of doing business, because today what happens is, if there is excessive trading of out-of-the-money strike options, that can show up as a large amount of open interest in options, which can hit the market-wide position limit and therefore create a ban period in a stock. So you can have spurious ban periods where actually the underlying risk is not very large, but it looks as if the risk is very large and therefore a stock is pushed into a ban period. Moving to a delta-based metric would ensure that we are actually measuring risk the correct way. Now, let me hasten to add, we are also very conscious that delta alone is not a great metric. Particularly in options, as market prices change, the delta can change very rapidly. So we will take into account all of that, but we'll try and find a balance between simplicity and measuring risk appropriately. What is very clear to us is the current way of measuring open interest as notional of futures and notional of options is simply not right. It gives a very, very wrong picture, and there is a need to debate how do we move forward into a more meaningful metric. So this is something that's on the anvil. Again, subject to discussions, we will see how this goes forward. The second thing which I want to bring in here is, currently, the market-wide position limit is a certain percentage of the free float. It's 20% of the free float, okay? Now, that might have to be tweaked if we move to a future equivalent basis rather than a notional basis, because the numbers are very different on the options particularly. Let's keep that technicalities aside. What we also find in some particular single stock futures and options is that the actual risk being run in a particular stock could be several times the daily delivery volumes in that underlying stock. We have seen cases where the gross of the net deltas across the system, and this is an intelligent audience, so I'm using a lot of technical jargon, but I'm sure you'll get this through. But the gross of the net delta across market participants, if you add that all together, we have seen cases where that overall market delta in derivatives is 50 times the daily delivery volumes or 60 times the daily delivery volumes. Now, this is a classical problem of actually having a lopsided case of the potential of a tail wagging a dog, when there is so much of risk available in one market vis-a-vis the capacity of the other market. So linking this market-wide position limits to some multiple of average daily delivery volumes in the cash market on a dynamic basis. So as the cash market volumes go up, this limit can go up as well, might be a sensible way to give trust to the ecosystem that there is no manipulation happening, that I'm not taking a small position in the cash market to drive something in the derivative markets and therefore create volatility and create some kind of manipulation in the market. So linking market-wide position limits to delivery volumes is something else that we are considering. Now, linked to this, sometime back when we had the COVID incident, we had brought in some limits on index trading. We had said that the notional that you can actually take on a net basis in futures is 500 crores. We had said that on options as well, the notional that you can take on is 500 crores. This was brought in during the COVID time, essentially as a measure of controlling the volatility during that period. That needs to be revised now. The reason why we've been holding back on revising this is exactly what I told you, that this notional limit is in the first place not correct. You're adding apples and oranges across futures and options. Specifically, when you're looking at a 500 crore limit for options, if I buy at the money calls and I sell completely out of the money calls, that will show up as zero utilization of risk. Whereas in reality, I am running an actual risk in terms of future equivalent or in terms of Vega, in multiple risks. So what shows up as zero risk actually can be a substantial risk. On the flip side, simply doing options up to 500 crores might sound like a large number, but in delta terms, it might be a very, very small number. So we are thinking of moving these limits, which are currently notional based and are restrictive in some people argue it's restrictive, to a more delta based limit. Again, the theme being, let's move to a future equivalent metric, which is more sensible, which is more reasonable, and by the way, in line with global best practice across most markets. Now, another thing which I want to bring out in relation to this theme of moving to a delta-based metric, currently in mutual funds and in AIFs, and I see some stalwarts of mutual funds here, the way in which exposure in derivatives is measured is again a little questionable. Currently, whatever option premium is paid to purchase an option is counted as exposure in that underlying stock. Now, we all know, those of us who understand the math in derivatives know that the actual risk can be several times higher than the premium that's paid. So an at-the-money option would have a delta of 50% of the notional, whereas the premium paid would be a very small percentage of the notional. So the way in which we measure exposure in mutual funds and AIFs is incorrect. Now, this is not to suggest something is wrong is happening in the ecosystem. We are simply saying the metric is not correct. Let's make it more realistic so that there is better disclosure of what the risks in the ecosystem are, and therefore a better appreciation of what is really happening in the market, both for investors as well as for the managers. Essentially, we are saying let's move to a more realistic way of managing risk. The last bit I want to speak about is this question of having indices with futures and options with very high concentrated weightages of some specific stocks. You know, one of the crucial things in the derivatives ecosystem that we want as regulators is that there should be trust in the ecosystem. Often in social media, we hear murmurs that something is wrong is happening, especially in index trading. That there is some manipulation happening in the cash market, which is leading to some kind of activity in the derivative markets, and overall there is creating some, either huge volatility or no volatility, and that it's being done as a manipulation for some people to profit. First, let me give you some comfort. Our exchanges, our clearing corporations, our first-line regulators have excellent surveillance ecosystems. SEBI is no babe in the wood either. As you would have seen from some of our recent orders, we have excellent surveillance ecosystems. So please have some trust and faith in the ecosystem. It is not so easy to manipulate things in the market here. We are not saying we are perfect. We are learning all the time, but we are not closing our eyes either. We are absolutely watchful. We always have been watchful for any signs of manipulation. We rely a lot on market intelligence coming from experts, and I have to compliment the ecosystem across the first-line regulators, across market participants. We've had some very good trusted advisors who are telling us what happened, who teach us what's happening. And we are learning all the time. But the broad theme that there should be trust in the ecosystem, that there is no manipulation happening in one market in order to profit in the other market, it is important to maintain that trust. Let me also again hasten to add, before you start panicking, it is not unusual for a trader or a market participant to trade in both markets. They could trade in the same direction, they could trade in opposite direction. It's absolutely fair to do so. In fact, many large institutional players do so as a matter of risk management, as a matter of taking on risk. Using both markets is absolutely fine. But every regulator in the world, not just SEBI, we are very conscious that there should be no pump and dump in the market. What do I mean? That a burst of huge activity by a large player in one market in order to profit in the other market. So I do a lot of buying followed by a lot of selling in order to profit in the derivative market. Likewise, marking the close, where just at the time of expiry, if there is a lot of activity in the cash market to try and get a particular close, these are standard manipulative practices that every regulator in the world watches out for. Now, when you have indices which have very huge weightage on a few handful of stocks, even if there is no manipulation happening, the fear that some people might be manipulating the cash market in order to drive the derivative markets and increase volatility is not healthy. So one of the questions that we have is, when you have indices trading in futures and options, purely for trading in futures and options, not for benchmarks for mutual funds, not for anything else, should there be restrictions on how much of weightage the top stock, the top 3 stocks, etc. should have? Now, this is a matter of discussion. I'm being very open and telling you what's on our mind. This doesn't mean we are taking steps tomorrow. Anything that happens will be done with due discourse and due consultation. As I said, there is a plaque in SEBI saying, first do no harm. But in the spirit of saying that we have to be as open as possible, I'm telling you what's on our mind. So these are some of the things which are on our mind. What you will notice is all of these are largely either ease of doing business in terms of increasing limits, increasing the scope of what can be done, or in the nature of making sure we all measure our risks better. Again, which frankly will facilitate better trading. As I said, a lot of stocks go into ban period for the wrong reasons currently. That will hopefully stop when we move into a more scientific, future equivalent way of looking at it. So, just to emphasize, when I started off by saying SEBI is for derivatives, let's remind ourselves of a few things. Despite the steps that have been taken, that have been so publicized, there has been no reduction in the number of actual contracts which are traded on exchanges. Every contract exists as before, including index contracts. Only their expiries have been rationalized, not the contracts per se. All avenues for trading in those contracts still remain. On the contrary, when it comes to single stock futures and options, it used to be about 184 a few months ago. Today it's 223 as per the NSE website. So actually the number of derivative contracts in single stocks, futures and options have actually gone up. Often we are asked, what is wrong with you guys? We thought SEBI wants to reduce the number of trading in derivatives. How is it that the number of contracts have gone up? Please understand, we are not against derivatives. We took very specific action of over trading in index options on expiry day. That is not derivatives as a whole. Overall derivatives are good, we need them, they are crucial towards capital formation. Last bit, lot of speculation happening, which I personally have received queries. Is SEBI doing something for suitability and appropriateness, limiting who can trade in derivatives, who can't trade in derivatives? Let me make it very clear. We are not contemplating anything at this point in time. Suitability, appropriateness are requirements that the first line regulators, whether it is exchanges or clearing corporations, anyway have. They've had it since time immemorial. My earnest request to the ecosystem, first line regulators, brokers, intermediaries, please take care of these things yourselves. Regulations and market stability are too important to be left to SEBI alone. We should be the last persons coming into the picture. A lot of these things can be managed ourselves, but to emphasize on suitability appropriators, nothing is being envisaged by us at this point in time. As I said, we will see how things pan out. We will consult with you, and then we will decide what further needs to be done. And we are very, very thoughtful of any kind of regulatory intervention in the derivatives market. Okay. To summarize, we like derivatives. The steps we took were very surgical and targeted at a particular level of over trading happening, particularly in index options on expiry day. The steps are still coming through. We don't know the full impact of it. Be patient. We'll have to watch how things pan out. We are in no hurry to overreact one way or the other. But yes, in terms of moving to better metrics on a future equivalent basis, we think it's a great time to explore this, and this will be in the nature of ease of doing business, allowing more markets to develop and getting better metrics around this, and the system will continue to grow. I'm going to stop here. Once again, thank you for your very, very patient hearing. Really appreciate your time.
Thank you, sir, for a very engaging and stimulating address. May I request Dr. Thankar Patnaik to felicitate Anand, sir. We'll start with the first discussion for today. Ashish would take us through the sessions.
Thank you, Ashiana. So good morning, ladies and gentlemen. I welcome all of you to the first session of the day on the topic Bonds for Viksit Bharat, New Products and Strategies to Deepen Corporate Bond Market. For this session, we have a speaker and two discussants. The speaker is Neeraj Gambhir, Group Executive, Treasury, Markets and Wholesale Banking Products, Axis Bank. And the discussants are Mihir Vora, Chief Investment Officer, Trust Asset Management Company, and Amit Tripathi, Chief Investment Officer, Fixed Income Derivatives, Fixed Income Investments, Nippon India Mutual Funds. So I will request all the dignitaries to come up on the dais for the session. May I request the speaker and discussants for a group photograph, please. Now, before we begin the session, we would like to have a small quiz. The rules remain same as the day before. Although we would love each and every one of you to participate in it, but the prizes are exclusively for the young and the bright minds, that is the college students amongst us. So please scan the QR code to go to the Slido website to enter the quiz. And the quiz will have 4 multiple choice questions. Each question will have 4 options, of which only one is correct. You will have 20 seconds to select the correct option. The 3 winners would be the one who answer the correct questions in the shortest possible time. So the first question. The second question. The third question. Okay, two questions. Okay. So the winners are Anirudh Subramanyam NISM, Mr. Reddy and Amit Nayak. So I will request the winners to... So congratulations to the winner, and I will request the winners to reach near the dais after the session to collect your prize. So now I hand over the stage to the panel, to the speaker, sir. Sir, over to you.
Thank you. Good morning. First of all, heartfelt thanks to SEBI, NSE, for giving us this opportunity. This is a topic that the more we discuss, the more educated we become. We've been involved in development of corporate bond market in one way or the other for a very long period of time. And sometimes when things don't move as you anticipate, it's not that we don't have the intelligence, it's maybe because the problem is quite hard. I just want to take an example of nowadays the fashionable thing, which is artificial intelligence. During my engineering days, we used to tinker around with artificial neural networks. And those days the compute was very limited, those days the understanding was very limited. And this problem stayed for almost 30 years. And bang, lo and behold, in 30 years you had an interesting algorithm and suddenly AI is all over the world. So sometimes these problems take a lot of time, a lot of effort, and something suddenly clicks and the markets develop. What I want to do in this presentation is just do a little bit of historical retrospective around how far we have come over the last 10 years in terms of market, what has worked, what has not worked, and then maybe after a few slides, it's not a very long presentation, maybe after a few slides, come back to the questions that all of us are, yeah, thank you, that maybe we can discuss and debate. So, firstly, we are at 224 trillion bond market right now. It's huge. Corporate bonds account for roughly 21% of this market. In terms of outstanding, the corporate bond market has kind of remained the same, about 25%, 26% over this period. It's not as if the corporate bonds market has not grown, but what has happened is the government bond market, the outstandings in the government bond market have actually leapfrogged, particularly after COVID, when the size of government issuance actually significantly increased. The proportionality kind of changed once again, which is why you see what started as 28% market share has now moved to 24% market share. But clearly both the markets are progressing quite well, both the markets are growing fairly well. The second aspect, and this is what I mentioned, that both the markets have grown fairly well, CAGR of roughly 12% in corporate bonds in terms of outstanding. It's outpaced by SDLs by roughly 18% CAGR. And we know that in India, given the size of our fiscal deficit, government is the large borrower, but from 15 trillion INR to 47 trillion INR in 10 years' time, it's a fairly remarkable growth. Of course, the cornerstone of Indian corporate bond market is private placement market, and we've seen 14% CAGR growth in private placements. Private placements account for roughly 95–97% of the market size. So that is the way Indian corporates like to raise money. In corporate bond market, people don't really want to do public issuances for a variety of reasons. But we've also seen a notable shift in the issuance characteristic, in the sense that who's issuing these bonds. So while the top three tiers, which is private sector, FIs and NBFCs, were accounting for roughly 55% of this market in 2014, that proportionality has actually increased to 62% in the last 10 years. Having said that, we still are dominated by highly rated frequent issuers. Issuances by AAA issuers account for roughly 67–68% of our market, and less than AAA is still about 35%, 34–35% of the market. Incidentally, and this is the most interesting part, in terms of tenor, 33% is above 10 years, and if you count 5 years to 10 years, we are roughly more than half of the market, which means that there is a very distinct preference in our market for longer tenor bonds. We have made some strides in terms of deepening the market. On the left hand side, if you see, we have kind of spelled out what is the size of the market relative to GDP. Of course, markets like Korea, China are still far ahead of us, even if you just compare in Asia. We've moved from 13 to 16%, but still at the lower end of the bucket. Bank credit still continues to be the dominant way in which corporates in India like to raise financing. But there is a lot of volatility, a lot of variability in the size of bank credit year to year, if you see. On the other hand, the amount of issuances of corporate bonds has kind of moved on at a pretty steady clip over a period of time. It was in about 3 to 3.5 trillion INR, and in FY24 that number has actually increased quite a lot. And this is, we're just talking about private sector corporate bond issuers. This does not include the quasi-sovereigns. The biggest bugbear of our market is secondary market trading volume. So while the outstanding and the market share has steadily improved, in terms of secondary market trading, we are pretty much stuck over the last 5 or 6 years at about 14 to 15 trillion INR in a year. So as the outstanding has grown up, the percentage of the stock that we trade in a year has steadily declined from 53% to 29%. Of course, given the focus on listed markets, given the focus on transparency, clearly the market preference has shifted towards listed corporate bonds. So listed corporate bonds now account for roughly 90% of the secondary market trading, and there has been a steady decline in the unlisted corporate bonds. Most of this trading happens in AAA bonds. There is very, very limited trading that happens even in AA plus or AA rated bonds. In fact, the share of below AAA corporate bonds in the secondary market trading is just a little less than 25%. And most of this trading actually happens in financial issuers corporate bonds, which basically means the NBFCs, the PFIs and the like. Again, very, very limited trading in the corporates, non-financial corporates bonds. That's the other hallmark of our market. Now, it is my belief, and I often say this, corporate bond markets exist largely to serve non-bank investors, because banks don't need corporate bonds. Banks have been doing lending in the form of corporate loans for a long period of time. Bank lending is largely relationship lending. Corporate bond markets are very impersonal, and they suit the needs of non-bank financial institutions. So we also looked at what has happened to these institutions and how their participation and their holdings in corporate bonds has moved over a period of time. And it's no surprise, given the increase in their AUMs, insurance companies have been at the forefront of increasing their holdings in corporate bonds. So clearly, insurance companies today, including LIC, are the largest holders of corporate bonds in the country. Mutual funds and commercial banks are the next ones, and provident funds obviously account for a large portion of that as well. The new set of investors, which is the wealth and the AIFs, AIFs are obviously catering to wealth sort of clients, have started to show up in their holdings, but it's still a very small component of the overall size of the market. Just a quick laundry list of a whole host of interventions, regulatory interventions and the innovations that the market has seen. We've seen ISIN consolidation, reduction in face value, tripartite repo. A whole bunch of issuer categories have been sort of facilitated through enhanced frameworks. Responding to stressed market situations, there is a backstop facility that has been created particularly for mutual funds, and a bunch of other reforms related to debenture trustees and credit rating agencies. RBI has also introduced guidelines on credit default swaps. In terms of market infrastructure, I think the biggest innovation that we have seen is electronic bidding platform, which has substantially increased the transparency in the system, and it has also fundamentally changed the way corporate bonds, even in the private placement market, are issued in India. For mutual fund to bring more transparency in the secondary market, we have RFQ platform, though I'd like to debate whether there has been a real change because of the RFQ platform. And we've seen a whole host of product innovations that have actually been introduced in the market. We've seen partly paid bonds, credit enhancements being introduced, multi-issuer cross-collateralized rupee bonds, green bonds, REITs and InvITs, significant development and growth there, and some initial sort of signs of municipalities and some of these bodies coming and issuing bonds. ARCL repo is the latest innovation that has been done. We'll have to see how that plays out over a period of time. So if I were to just look at from an issuer's perspective, what are the challenges that they face or they see? First, linked to what we've seen before, secondary market trading, and the investor preference is the fact that less than AA rated issuers don't find it very easy to issue corporate bonds in the country. Part of this is also economic. Banks are pricing less than AA credit at a far finer spread as compared to what the bond market would like to see. I mean, if you think about this, if I look at the bank pricing for a typical SME credit today, is somewhere in the region of 9 to 9.5%. And these SME credits are typically BBB minus. And if you ask a mutual fund investor or an insurance fund manager that would you like to hold a BBB minus asset at 200 basis point spreads over where AAA is trading, answer would be no. So clearly we have this disconnect between the bank pricing and what the bond market would see as the pricing of these lower rated credits. That to my mind is the real economic reason why we don't see issuers coming into the corporate bond market and trying to issue here. There is also linked issue of the shallow secondary market. We just saw that bunch of the trading that happens is in AAA rated bonds. Only 25% or thereabouts is what gets traded in the less than AAA rated bonds. We also have a problem of uniformity of valuation in the market. There is no standard benchmark yield curve at this point in time. Different players in the market are using different valuation frameworks, and each of these valuation frameworks end up giving a different price to the same bond which may be held across a bank or a mutual fund or insurance company. We debated this issue in COBOSAC, the issue of compliance requirements. There is a sense and feeling that if you are an unlisted entity and you come up with more than 500 crores worth of a corporate bond issue, it kind of brings the whole requirement of the compliance requirement of being a listed company onto you, and some of these are issues related to the kind of board composition that you need to have, the kind of committees you need to have, the kind of compliances that you need to have. There has been a discussion paper floated on this, and I think this is an active discussion at SEBI as to what can be done to ease off some of these compliance requirements. But in my view, this is also probably one of the reasons why we are seeing some sort of activity in the unlisted bonds. I'll just pause here. What I've done is listed a bunch of questions for the August panel to discuss, debate. All of you guys have been veterans in the market. Should I read out the question or should we just go on? Yeah? Yeah, we can just start. I think, let me just kick off by saying that as mutual funds, you have been used to trading now through the RFQ mode. I don't know whether it's a reporting platform or a price discovery platform. I think it's a reporting platform. I don't think it's a price discovery platform. But will associating guaranteed clearing with RFQ platform, do you think will it help us drive more secondary market volumes?
Sir, it is essentially a reporting platform right now. It's not a trading platform. 3 or 4 reasons for that. I think the first is that the heterogeneity of the market itself creates an environment where it becomes very difficult at a principal to principal level to match requirements. And then there are a lot of regulatory stroke technical issues that various investors face. Somebody will not buy a premium bond, etc., etc. I'm not getting into the details, but the fact is at a principal to principal level, in a relatively much more heterogeneous market like corporate bonds compared to government securities, a screen-based system finds it many a times difficult to match requirements. Possibly what you require is 2 or 3 things. The first obviously is that like in equity markets, which are also a very diverse market but have shifted brilliantly to the screen-based system, you need a set of intermediation which can actually smoothen out this difference in requirements. So we need to think about the RFQ platform similar to the way we think about the equity platform, and work according to ensure that there is more and more participation of people who can actually bridge this gap between principal to principal in terms of the requirements. So that's point number 1. Point number 2, I think we need to make this platform completely anonymous. And guaranteed settlement is obviously the best thing to have, but given where we are right now, if we move to a complete anonymity with exchange settlement rather than counterparty settlement, which we are doing right now, and when I say exchange settlement, what I essentially mean is that as a counterparty, I am facing the exchange, and as a counterparty, you are facing the exchange, and we are not facing each other, even at the settlement stage or at the trading stage. Then I think that improves it by many notches. And then guarantee settlement, obviously, if you can possibly have that at some point in time and explore that at some point in time, it will work. But the only problem with the guaranteed settlement will be that if you introduce then a margining system for the guaranteed settlement, then the costs will come into play, and you need to figure out what the costs are or what reasonable costs are, so that institutional and retail players both will be willing to play. And third most important, I think, if you have to make the RFQ platform work, you need everyone on that platform. Today you have too many silos in which corporate bonds are getting traded. You have RFQ, you have the retail segments of exchanges, you have the phone markets, you have OBPPs. Everyone is working in different screens and silos. If you want this market to perform, you make it transparent, you bring in those guys who can oil this market in terms of matching demand supply, and you bring everyone here. You can't leave half people outside and half people inside.
Mir, you want to add, or should we?
Thank you. I'm the odd one out here, having spent most of my time on equities.
Yeah, maybe you can bring your equity.
Yeah,
into
so,
this.
I mean, frankly, you know, coming from the equities market and having seen the development of the equities segment over the last 30 years, I'm still unable to get a grasp on the complexity of the debt market settlement and trading systems. I mean, while I was preparing for this debate, I asked my fund manager, debt fund manager and trader to let me know how many systems they are logging into every day. And they gave me a list of 12. There are 12 logins they have to do every day, and this is not counting Bloomberg and Reuters and all those news wires. So you have NDSOM, we have TREPS, we have Chromes, we have ARCL, NSE RFQ, BSE RFQ, NSE EBP, BSE EBP, and then there are the polling systems for price discovery, etc. CRISIL polling system, ICRA polling system, Asteroid for OIS trades, and there is eCubear for the primary GSEC trades. And as I said, these are 12. This is not counting all the other news sources and our own MFED platform that we log into every day. So,
and you thought bond markets was easy?
No, I never thought bond market was, that was stuck to equities. So the point is that, as Amit mentioned, there is a plethora of platforms, there is a plethora of systems, and there is a plethora of regulators, right? It's not under one regulator. So some of the platforms are sponsored by the central banks, some of the platforms are under the purview of the securities market regulator. So there obviously is a need to bring everything together, and as you pointed out in your presentation, the bond markets in India have evolved in a certain way in trading volumes. They don't compare anywhere in terms of size compared to equity markets. If you look at the global, systems, in the US, the loan book of banks compared to the bond market book of banks is 1/4. So bond markets are almost 3 to 4 times bigger than the loan markets in the US. In India, it's 0.6, 4 versus 0.6. You talked about trading volumes. In the US, the entire notional of the corporate bonds outstanding gets traded twice over in a year, so 2x. In India, as you mentioned in your presentation, it's about 0.3x, probably 30%. So obviously, there's a huge discrepancy in the bond market structure and trading volumes in India compared to a market like US. And in contrast, our equity markets are giving all the world markets a run for their money in terms of trading volumes, in terms of notional, in terms of settlement, in terms of T+1, T+0 also potentially. But the point is that the same country which has given a run for the money in the equity markets, why are we not able to do it much better on the fixed income markets? And I think one is, as I said, the plethora of platforms and trading system. Second is also the fact that there is something which has changed after 2018. You talked about the corporate bond market growing at 12% CAGR over the last 10 years, but if you break it up into the first 5, pre-19, the corporate bond market growth was 16% CAGR. Post-19, it's more like 8-9% CAGR. So it's even less than notional GDP growth. So something has changed after 2018. We all know there were a couple of risk incidents, credit incidents that happened. But because of that, I think the entire system has become risk averse. The regulators, the investors, whether it's mutual funds or insurance companies, or they have become risk averse. And I think it's time to get those animal spirits back again. I remember, if we're all there in the 80s and 90s. India used to have a thriving bond market. Of course, it was maybe Wild West, no regulations, but those huge issues of, bond issuances by, I remember the large refining and petrochem companies, large steel companies. Of course, they were high yield bonds, but trading was not a problem. They were liquid bonds, traded, bid ask, any volumes you give and take. So I think we need to kind of get back those animal spirits in the market.
I just want to push back a little bit on that one. What do you think is the largest amount of single corporate bond issuance in a day done by any Indian corporate? Take a shot.
Largest amount. Any idea?
Sorry?
Largest amount of single bond issuance done by any corporate in India?
14,500 crores.
25,000 crores. 25,000 crores is the single issuance done by a corporate, priced, distributed, bought. The point that I'm trying to make here is we tend to confuse between secondary market liquidity and what the primary market is able to give. I think in primary market, we have seen a significant depth and diversity now.
But it's all institutional.
It's all institutional. Corporate bond markets are institutional. Unlike equities, bond markets are not very glamorous for the retail investors, and I'll come to that a little later. Can we get back to those questions, please, if you can? So, Amit, I'll go back to the point that we started with, which is basically market infrastructure. You talked about we need somebody to provide liquidity. We need somebody to provide liquidity, right? We need somebody to hold the both sides because of the diversity of instruments and the need for price discovery. We have toyed with the idea of having a market maker framework in this market for quite some time. I don't know whether it's because of the fact that we have two different regulators looking at it, and we have two different sets of players who are active here, or maybe three different sets of players who are active here, but we haven't been able to come up with a viable market making framework for the intermediaries. We also toyed with the ideas of having a repo market so that when the intermediaries are making prices, they have inventory, they should be able to finance this inventory at a cheap cost. But that's also not really taken off, right? So I'm trying to weave in 2-3 points here. The market making framework, the need and the existence of repo market. We also don't allow short selling in corporate bond market. And typically market making, short selling, repo financing, they all tend to go hand in hand with each other. What do you think needs to be done for us to get a viable market making framework or some sort of institutional arrangement which can bring in those players who want to but don't have the capability to sort of carry the inventory of the size that is required for this market and provide liquidity to the market?
So I think what we are looking forward or looking forth to is there. Okay, we are here.
Yeah, we need to get there.
We need to get there, but we need to do the journey. I will pick on 2 points that you made, and I think so let me first give credit where it is due, that in the last 18 months, we have created 2 or 3 specific infrastructures which are brilliant, which are very timely, and which are essential for this liquidity. Okay, so liquidity, obviously everyone knows we trade 5,000 crores on a 50 lakh crore market, which is nothing. But everyone will be also happy to know that now we trade 2,000 crores of corporate bond repo every day in a market which trades 5,000 crores. Okay, so that's a reasonably substantial chunk. I'll make 2 or 3 points here. One, obviously when you talk about regulations here, so it's true that there are inherent reasons for large institutional players not to trade. Some of the reasons are regulatory, some of the reasons are valuation led, some of the reasons are in terms of the nature of flows that we have, right? So who are the guys who can actually create liquidity in this market? If you are trying to force fit a market making system, that is never going to happen. You need people who want to trade. And who are the guys who want to trade are not necessarily the guys who have money. Okay? If you look at all markets, you will see, for example, we were hearing, sir, about the derivative markets or the equity markets for that matter. The volumes that get created do not necessarily get created by entirely one's own capital. The volumes get created by a capital which is supporting a risk appetite. Now in corporate bond markets, we have not been able to do that over the years. So if I as an individual have a very high risk appetite, and I'll go back to your point that since 2018, we have seen AAAs, actually if you go by rating agencies, it's not 77%, it's 86%. 86% of all ratings are AAA and less than 10% is now AA. I don't think investors have lost risk appetite. The providers of products have not been providing enough right products to the investors to come through them, and that's why we see so much interest now coming into direct bond buying that we have been seeing of late, right? Now coming back to this, I think the first step is a repo market. You need to allow people who have risk appetite but do not have capital to be accessing the repo market for funding themselves. Whatever checks and balances we need to have there, because today if you actually look at it, while the corporate bond repo market is trading 2,000 crores a day, the number of borrowers are not more than 5. The number of lenders are not more than 5 or 6. So you need a much larger base to come and start borrowing and lending. And once that base comes, that base has risk appetite and will start trading. It's very simple. I think we need to be very, very focused on this corporate bond repo market going forward. The second point that you need for this liquidity to happen is that you will need to bring some homogeneity in at least the AAA segment as far as issuances are concerned, so that that could be the first layer where it is very, very easy to understand the corporate bond and trade. So there is always some work being done in terms of, for example, we did this reissuance of bonds that started a few years back, so we now have much larger volumes, etc., etc. But again, because that goes predominantly into the institutional category of players who don't have an incentive to trade, they don't trade. And the last thing is valuations. I think this is something that we have, like you rightly said, we have been struggling for the last 7-8 years now. Somewhere the incentive to trade also is driven by valuations, and the valuations today are so wide that it is very, very difficult for two principals who are being regulated separately and who have different valuation systems to actually find common ground in terms of valuation of a bond, which is a basic requirement if a bond has to trade, right? So we need to work much more towards that is what my sense is. So market making will happen, sir, when it has to happen. But I think we first need to...
if we have the right infrastructure and
yes, and sir, if you remember, the market making, who are we asking to market make? So if you go to the pre-2008 environment, who were the market makers? PDs were the market makers, right? Banks were the market makers. Is the regulatory system of a PD or a bank today incentivizing them to make markets in corporate bonds? Is the first question we need to ask before we start asking them to make markets. If it is incentivizing, they will obviously make it. If it is not, they will not make it.
Yeah. Let me come to you, Mihir, as equity guy, and you've seen equity markets, significantly explode, the retail participation significantly grow. What do you think are some of the learnings from that market? And I'm very cognizant of the fact that there is an inherent conflict of interest in asking this question to two mutual fund managers. What do we need to have direct participation in corporate bonds by the retail investors?
I think it's about ease of doing business. In equities, you can log into a online account, one click, and you're on, right? So it's As simple as that, because the back end has been developed so well now in terms of trading systems, settlement systems, margining, risk management, that it's pretty much a process which even the lay investor can understand, and that's the reason why you see millions of demat accounts being created every month now. I think we also probably are highly underestimating the power of the HNI, the speculator, the jobber, the erstwhile jobbers that used to be there, which are now trading in derivatives to discover prices. I think Indians inherently have speculation and trading in their blood. And if you give a good enough platform, they can make a price on anything. I mean, if we can trade mustards, guar gum, nat gas, where we don't even manufacture nat gas, natural gas. If we can trade crude, gold, I don't know why, bond which is a AAA bond or a AA or product, which is far less riskier and, far more, analyzable, so to say, why we can't make a market on that. So I think it's more about, as we discussed in the beginning, making sure that the trading system and settlement systems, are smooth enough for the retail investor to participate. HNI. I think we have got millions of people, even a small fraction trading a few thousand rupees a day adds up to the amounts that we are seeing in the equity markets today. One of the things that, the basic requirement is, say, net settlements, a settlement guarantee. I think if we can crack that, that should take care of more than half the issue. The settlement guarantee, anonymous, platforms, combined with, proper margining systems and ease of doing business, I think there's nothing to prevent even bonds from being priced in a very transparent way. And volumes will come. I'm 100% sure volumes will come.
Sure. So, Anand's speech was largely on derivative markets in equities. And we have struggled with derivative markets and fixed income for a very long period of time. We are still struggling with derivative markets on the risk-free curves. But I'm going to still be a bit provocative and ask you this question, that CDS market, we've tried 2 times. This is maybe the 3rd time. Hopefully something will happen this time. But should we look at it a little bit more comprehensively to say that why just CDS? Allow short selling, allow these simple derivative products like FRA, TRS on corporate bonds. Along with CDS market, all of these markets will simultaneously, slowly and slowly develop. But you look at it a little bit more comprehensively rather than a piecemeal basis. Do you think there is demand for short selling in corporate bonds? Do you think there is an appetite from institutional investors who have shown, by the way, remarkable interest in bond forwards for government bonds? And we've seen how big that market has become. Should we allow something similar in, or should the regulators look at something similar in the corporate bond market as well?
So I'm sure that is going to help. And I think, so coming to CDS, for example, CDS, I think, if I'm not wrong, 60 to 65% of CDS volumes happen actually in the sovereign space. Less than 30% happens actually in corporate bonds, as in the underlying benchmark is sovereign risk. Having said that, when we have looked at the CDS play in India, one thing that we need to figure out is who will be the writer of the CDS, who again is going to provide that option to a person seeking safety. And again, once this market starts developing, then pricing will evolve, everything will evolve. But I think it has some place. I don't know how much of that for the retail investor, but especially for institutional investors who want to hedge some part of the incremental risk that they are going to take, I think it has some place definitely. On the other derivatives, obviously, the only functional derivative in India still remains the OIS markets as far as cash markets are concerned. And GSEC markets per se themselves don't have a great correlation with the OIS markets at many points in time, and corporate bond markets are very, very further away in terms of that correlation, although it has narrowed some bit over the years, but it's still wide. So I guess we need to get into more specific instruments here, which actually would reflect the risk return dynamics of the corporate bond markets when we are thinking about corporate bond derivatives, rather than thinking only about generic derivatives, because many times these markets.
Let me ask this question a little bit more directly. As a fund manager of a large fixed income portfolio, what derivative product do you think will appeal to you when it comes to corporate bond market?
So if 85% of the issuance in corporate bond markets is financials, the first index that I would want to look at is an index of financials, right? So if you can provide me with an index of financial services sector or of NBFC, AAA space, etc., I'm actually at least trying to hedge the generic risk of a particular sector over the sovereign. So that is a derivative that one could very easily look at using regularly if it comes to that. And even today, not only issuances, but investors also, the biggest chunk of what investors buy today are PFIs, BFSIs, banks, NBFCs, etc. So the first thing we can do is we can launch a simple derivative product on AAA NBFCs to start.
Mihir, I'm going to ask this question to you as a erstwhile insurance CIO. What do you think will appeal to the insurance investors?
So we did a lot of work when the guidelines were introduced on the CDS market, and as insurance companies, frankly, it's a good product for us, because it's a way of either trying to hedge the existing portfolio or even yield enhancement if it comes to that beyond a point. There were certain nuances in accounting, etc., which needed to be sorted out. But in general, we were quite positive about the development. Unfortunately, the market has not taken off yet in a big way. But I think as long-term players and as as natural warehousers of long-term bonds, insurance space is a good space to write and buy both in terms of CDS. I think beyond a point, what is also happening in the Indian credit market is that there is an inherent mismatch of ALMs. So while insurance companies hold bonds, they are mostly in the longer term nature and they are mostly hold to maturity. They are not actively traded, right? So on one hand, you have a chunk, and as your data showed, a lot of the holdings of corporate bonds are now in the longer term tenure, and that's precisely because the insurance companies, the NPS, EPF need long term assets. On the other hand, they don't have the very sophisticated credit writing skills that banks have. So the natural holders of bonds don't have the credit skills to the extent banks have. Banks, on the other hand, have the credit writing skills, but they don't have the long-term liabilities that the insurance companies have. So we need to figure out a way to bridge that gap.
So maybe transfer some folks from banks to insurance companies. Okay. The other aspect, I think we used to talk about this a lot, is we used to think about, and somehow that conversation has stopped. We used to, or maybe it's kind of died down, that we would think of corporate bond market as a provider of capital for infrastructure financing in this country, right? Somehow we thought that corporate bond market will leapfrog, and people who are not even willing to buy a AA or a single A rated risk will suddenly start buying a BBB minus 25-year long infra, asset risk. But while that may be a bit of a pipe dream at this point in time, but we've also seen in general corporates not accessing corporate bond market for greenfield or even brownfield capacity expansions, right? It's usually seen as a refinancing instrument, right? You set your asset using bank financing, and once the asset is matured, you've got cash flows, then you start going to the corporate bond market to refinance this. What needs to happen for the corporate bond market to become primary provider of risk capital for creation of these long-term assets or even medium-term assets?
Again, sir, I'll start by saying we are here and we need to get there, but 2 or 3 good things are happening right now. The first is that private credit markets have finally taken off, and still early days, but private credit markets are eventually going to bridge this gap of risk capital that is required in many types of assets, including in infrastructure assets. And that is something that you could call it mezz, you could call it any word that you want to use, but that's the place where you will house most of the so-called under construction, stroke, regulatory stroke, whatever risk during this phase where the risk is the paramount thing. And then you move to a more generic market which we have today, which is going to take care of the ALM risk, right? One of the best things to happen in the last 3-4 years has been this entire development of platforms, REITs and InvITs. I was just looking at some data. We have now more than 60,000 crore worth of issuances that are happening in this space in a year, and that's a good number to start with. And obviously this market will grow much, much bigger. We need to continuously keep on working both from market participant perspective as well as from a regulation perspective to ensure that, you know, this market is today seen as a very robust platform system, well regulated based on LTV concepts, etc., etc. We need to keep on very minutely looking at this and ensuring that those basic tenets of understanding of risk do not change over a period of time. Again, you know, there are some 22 or 25 REITs in which today somehow everyone's bonds are AAA rated. And I'm not saying that, you know, they are not regulatorily kosher or something, not rating agencies are looking, but incrementally we need to look at differentiating quality even within this space over a period of time so that investors are well aware. Having said that, this is a brilliant start to house risk. I think one piece of ALM risk that we are not still housing properly, and if you actually look at InvIT REIT bonds that are being issued, most of these bonds are 3 years to 5 years, most.
That's because you wouldn't buy anything more than 5 years.
That's precisely the point. So you need guys who are today buying 30-year government securities and 20-year RECs, PFCs and IRFCs to actually start buying these bonds. They will get a much higher yield than what they're getting on their PSU exposures today. And that's the solution for ALM. Capital markets are brilliant in providing ALM solutions. We just need to bring in the right players who will provide those ALM solutions into these products. Forget REIT InvITs.
As an insurance guy, why do insurance companies not invest in these bonds? I mean, we've seen very limited participation from insurance companies in, although as
no,
Amit
absolutely.
is saying,
And as you mentioned, you know, insurance pension funds are the natural buyers of these 20-30-year bond. They should be. But there is also an element of, you know, prescriptive regulations. Certain amount of the corpus has to go into GSECs and SDLs. A certain amount has to be on in
but these are AAA rated bonds.
Triple, some of them are, but not all the AAA rated bonds you can get for 20-30 years. So and as I said, insurance companies, pension funds are because of the regulatory, you know, nature of their existence, there is a bit of conservatism in the portfolio because ultimately you do see there is a limited exposure to equities that insurance company take. There's a limited exposure to non-AAA bonds that insurance companies take, and that's because of this, you know, general constraint towards non-AAA assets.
I think if I can just add here, my basic sense is that today the way regulations are, we actually focus too much on the balance sheet structure while defining risk. We don't look at the underlying asset and cash flows while defining risk. So at any SPV level, even if you have created a 10,000 crore asset, which is actually revenue generating today, when you look at the balance sheet structure, you will see much larger debt loading because it is an infrastructure asset. That's how it's supposed to be, and much lesser equity loading. And that is the reason why in the traditional system of looking at risk, these do not fit into many insurance and pension schemes from a regulatory and risk appetite perspective. So the understanding of this risk also needs to change, and the regulations also need to support. That's the biggest point, because forget REIT InvITs, even normal NHAI InvITs, normal NHAI SPVs, they will also face the same issue that we are talking about. And one more point, sir, when you think about asset creation, apart from infrastructure assets, the other place where asset creation can very easily happen is securitization. That is something, given the size of the markets, that market was much more buoyant for us also between 2006 and 2012. It slowed down considerably. It has started picking up right now. We have solved for ABS. We have not solved for MBS, and that is a much larger market. We need to solve for MBS within the securitization space, because whatever MBS happens today happens in the the non-securitization.
The direct assignment.
DA market, yeah,
DA,
direct
direct
assignment
assignment
market.
route.
Doesn't happen in the securitization.
Yeah, I mean, I think I didn't bring it up, but good point, great point, that securitization, asset-backed securitization, MBS is the natural progression for us now, right? And I think we are ready for it for quite some time. But I'm still not seeing as much enthusiasm amongst the investor base to come forward and demand for these papers, right? As banks and as one of the arrangers that when we participate in the market, the preference seems to be the same old, AAA financial assets.
See, as institutions, it may not matter for insurance companies or for mutual funds because tax implications are not there. But for individuals, bonds are actually taxed at rates different from InvITs.
Yeah, that's old issue.
So
from a retail participation
exactly.
perspective.
So when we are talking about retail participation, you need tax advantages or at least the tax disadvantages versus InvITs, REITs, and corporate bonds to go away.
Yeah, agree.
And there is also TDS.
Agree. One last point. I know both of you guys are not bankers, but I'll still ask this question. Remember when we were migrating towards India's style accounting for banking system, the limits on HTM were going away, right? This happened, I think, somewhere in this happened effective 1st of April this year. There was this expectation that banks will now start becoming more and more active in the corporate bond market because now you can take these, you can put this in the HTM, fill it, shut it, forget it, no concern about valuation. Hasn't happened. We haven't seen banks come back into the corporate bond market in the big way that we were actually all anticipating. Any guesses why? I've written one reason there, but I'm not sure if that's the only reason.
I think banks are interested. We have seen incremental participation increasing in the last 1.5 years after a gap of 2-3 years. But I think it's a very narrow issuer base. We don't have that many issuers, and for any person like me or bank or an insurance company, I think you have issuer limits, right? At the end of the day, you can give the loan or the bond to the same issuer. So if you have a very narrow issuer base and the same issuer is again and again supplying, at some point you are going to say, I can't buy more of that issuer. So I think the answer to that is widening the issuer base rather than asking banks.
Right. I think we've now less than 10 minutes left. I want to open the floor for any questions from audience if you have. I can see a couple of hands raising, lots of them. Mics?
Hello, my name is Amit Naik.
We can't hear you.
My name is Amit Naik. I am a MFD. I have a simple question with respect to corporate debt market. See, the fixed income market is being regulated jointly by SEBI and RBI. RBI has already created a wonderful platform called RBI Retail Gilt Account for the retail participation. Can we have on the same lines, can we have the same platform for the corporate debt market or corporate debt repo?
Any thoughts? Retail direct equivalent for corporate bonds.
So we already have a newly set up OBPP system where a lot of retail investors are coming and participating. It is being fed into the RFQ system, and I think that is the progressive way in which a lot of retail investors will be able to, in a transparent manner, look at participating in the corporate debt markets. We obviously need much more seamless workaround between the current OBPP platforms and the RFQ system as far as retail investors are concerned. You obviously have retail platforms of NSE and BSE, but very frankly, I would agree with you. I don't think there is too much of price discovery or too much of volumes that happens.
No, I think the point being made here is that when you trade on an exchange, you go through a broker, right? You need to have a brokerage account. You need to have, some broker actually putting bids on the system for you. A retail direct scheme basically means just straightforward, go to some platform, buy it, and that's the end of the story, right?
Yes.
I don't think we have something similar for corporate bonds. I don't think anybody is providing that seamless provision to a retail investor to go and just directly buy a bond.
To a very limited extent, OBPPs are today, but yes, it's not like a NSE or BSE equity platform. We have thousands of securities where you can trade anything that you want. Right. But it is a start, is how I look at it.
See, I have already opened.
We've seen that to develop any market, I mean, we might have a direct platform, but ultimately it's the intermediaries and brokers who ultimately spread the volumes,
That's right. Another question.
Hello, sir. Myself Sandeep Nirvan. I'm from Ahmedabad. I want to ask one question that you have highlighted just now, that there is 200 BPS gap between triple B negative and triple B lending through this one corporate bond and through bank lending. So how government or how the regulators are trying to bridge this gap, and what are the initiatives, and what can be opportunity for people into this corporate bond sellers, or various platforms are there who are engaging in corporate bonds and selling those bonds.
You guys want to take this?
I think what he was mentioning to was the gap is too small, not too large actually. So there is no question of bridging the gap. It has to be market pricing at the end of the day. The only point that I would add here is that there is less appreciation of the below AAA space as far as the corporate bond markets in general are concerned, because there is too much of issuance of only AAAs and very less price discovery of below AAAs in the corporate bond market. That needs to increase for these spreads that you are discussing to start being much more dynamic and start making sense. And I don't think you should be unnecessarily trying to compress spreads if the risk differential is high. It has to reflect the risk differential at the end.
Sir, I have got 12 points in order to make sure that the capital formation is in a very strong note, provided if the panel members are allowing me to tell those 12 points in 2 minutes.
I'm sorry, I couldn't hear your question.
No, there are 12 points from my side so that we can increase the capital formation, and that is the theme of the core symposium which is happening right now. So provided if you can allow me those 2 minutes, so I'll be giving you those.
Please go ahead.
So the first one is yesterday's going by the Anant Narayan sir point of view that accredited investors need to be more in our ecosystem. So one of the major challenge or the regulation which is there is we consider the non-productive assets as well as the productive assets. Going with the India, which is a asset-rich company, asset-rich country, where most of the assets are in the physical assets rather than the financial assets. So the definition of the accredited investor or the parameters which are being considered should be tweaked, so that the cash flow, because India is considered as a cash flow poor and asset rich, so that has to be there. And going by the data of the ITR filings also, in fact the people who are having an income of more than 20 lakh or 25 lakh are very less. But when we compare it with the assets which are being held in the physical format, so they need to be considered. And the second point is, instead of giving a weightage of 50%.
I'm sorry, how many points do you have?
12
we are
points
kind of
in
running out of time.
Fine. 12 points in 2 minutes.
Okay.
So there are only 12 points and I'll complete it in 2
12
minutes.
points are quite a few. May I suggest that you read out 1 or 2 points and then we can take the rest offline?
Right. The second one is instead of taking only the net worth as a criteria or a cash flows as a criteria, the knowledge or the expertise or the experience of the team, which an HNI or an accredited investor need to be considered. And the third one is, instead of promoting the product manufacturer or the product facilitator as a discussion, the product prescribers, say for example the investment advisors which are there, the research analysts which are there, so that sort of community need to be harnessed so that the dissemination of the knowledge happens, so that everyone is well informed about the capital markets regarding the different segments of the capital markets. And the other one is the account aggregator verification or the account aggregator authentication which is there. RBI is proactively taking an initiative and giving a platform.
I'm sorry, I have to interrupt you because some of the points that you're making are not relevant for this panel. Maybe good for the markets, good for the overall ecosystem.
Exactly.
But I'd like to stick to the brief that we have, which is to focus on corporate bond markets. So I'd like to thank you for those points. Maybe we should take it up separately. Happy to discuss it with you offline. I see a hand at the back. Can we have the mic there?
Hello, morning. My name is Suresh from Invesco Mutual Fund. My question is that during the course of discussion, you mentioned that after 2018-19 top-rated default event, there's a lot of risk covers. So how do you think this setting up of CDMDF will help in this to take away risk awareness?
You're referring to CDMDF?
Yeah, Corporate Debt Market Development Fund.
Corporate Debt Market Development Fund. Amit, you want to take that?
CDMDF is already set up. So what is the question?
So my question is
How will that help?
how do you think
How will
that this
that
is
help?
going to help to remove this risk awareness? Because you said after this top rated default event, all the market participants have really become too much risk averse, not able to take risks.
Yeah. So the CDMDF works on a very well laid out principle, laid out with due consultation between the regulator and the market participants. Obviously, CDMDF has enough capital backing it to ensure that in cases of market dislocation, which is what you are referring to, there is a fund which can actually absorb good risk, which may not be very easy to liquidate at that point in time. And it's a very well laid out principle in terms of what you can offer to this fund, how the fund will buy, and everything will be given that everyone here is pretty aware of how the system works and how CDMDF works. Incidentally, it is being run by an AMC. The CDMDF fund also is being run by an AMC. So to that extent, I think this is going to be a very, very smooth process. I wouldn't say we would ever want to need it, but in case we need it ever in future, I think everything is in place to use the funds as and when required. Like I said, the rule book is pretty well laid out. So there is no confusion in terms of how investors are going to use that.
I'll just supplement that by saying that CDMDF is a kind of lender of last resort functionality, which basically means that if there is stress in the market, there's no liquidity, mutual funds can actually approach that fund and get some liquidity in the event of a stress. CDMDF is not designed to address the overall risk appetite in the mutual fund industry. If today, because of the default seen in the past, mutual funds have become more risk averse, that's a risk appetite that the investors need to find within themselves. I don't think CDMDF will address this. One last question before I call it a close.
Yeah, my name is Ansuman. Yesterday we talked about...
we can't hear you. Can you just speak a little louder?
Yesterday we talked about the challenges faced by the entrepreneurs to raise maybe the initial incubating fund itself. Like someone needs to do a startup in the AI space or Web 3.0 space or any of these new generation technology space. There's quite a gap in the market, right? And you guys spoke about the growth capital, the large infrastructure capital that you provide, right? So how can the corporate bond market help entrepreneurs raise the initial, let's say, incubating capital for let's say, doing the prototype, engineering it, and then taking the solution to the market?
There is a vibrant AIF ecosystem now available, and you all know about venture funds and PE funds. But there is also a set of funds which are now available, which are doing venture debt, right? So the market is evolving very rapidly. So for startups, the options are either you go for equity, or the other option is also to go for debt at the venture capital level, which may or may not be linked to the equity performance. So I think we are in the process of market evolution, and venture debt is one more step towards providing that risk capital, which doesn't necessarily have to be entire equity.
Yeah, but the problem is the startups go through that valley of debt in the initial phase, right? The startups go through that valley of debt in the initial phase of the life cycle of any startup. Now venture debt, if you are not able to service that debt, right? And then I mean, every entrepreneur is kind of scared to go via that route. The venture debt thing really can take off after you have kind of proven the product market fit and so on and so forth.
I'll answer it by saying that some of the end users that you're talking about, discovery, product development, I'm not sure if they should be financed with debt, because the risk of failure is very high, and some of these things should necessarily be financed by equity. I don't think these are suitable end users. But if you're someone who's actually put some capital behind, you have a viable idea, there is some cash flow visibility, that's the time the company probably needs to start thinking of debt. And this is where the venture debt guys will come in, right? But very early stage, I'm not sure debt market is the answer for that. Sorry, completely run out of time, and there is a red banner there saying my time is up, our time is up. So thanks a lot for a patient listening, and thanks a lot to my co-panelists. Really, really appreciate
Thank you,
your
sir,
time.
for such a wonderful and insightful session. Now I may request Sri Anant Narayan Gopalakrishnan, whole-time member SEBI, to hand over mementos to our speaker and discussant as a token of appreciation. I would also like to request Sri Tirthankar Patnaik to felicitate the panelists on behalf of NSC. May I request our whole-time member, Shri Anant Narayan Gopalakrishnan, to distribute prize members for the quiz. So can we have the name of the prize winners, please? So yeah, the first prize goes to Anirudh. So Anirudh from NISM. Yeah. Can we have the first runner-up please on the stage? Can we have Amit Naik on the stage, please? I thank each and every one of you for joining the session. We will reassemble here after 5 minutes and we will disperse now for a short tea break. Thank you. Thank you everyone.
everybody, and may I request to keep the doorway free for people to pass. Hello, welcome back. Our next discussion dives into financial inclusion through securities market, opportunities and barriers. The session will explore how security markets can bridge gaps and promote inclusive growth. The speakers joining us today are Srimati Radhika Gupta, MD and CEO of Edelweiss Asset Management Company, and Shri Pramod Rao, Executive Director of SEBI. May I request the speakers to come on stage? Can we have a photograph of this? We'll have a photograph. It's also time for the second quiz of the day. Can we have the quiz screen? And I request all students to join quickly and get the numbers up. Okay, we don't have the screen, the quiz screen. Okay, we'll wait for a minute. Okay, here comes the first question. Can we have the next question? Looks like we are having a small, okay, so we have the second question. Congratulations. So, Pavan Kumar, Rohit and Nishika, you are the winners. So collect your gifts after the session. Thank you so much. And we'll start the discussion.
Presentation slide changer. You have a machine, I can use that. Who has a laptop? Good morning, everybody, and my apologies for the awkward 1 minute on stage. We had a little bit of a pointer going missing issue, but now it has been found. To start with, thank you to SEBI and NISM for organizing, this beautiful conclave called Samvad. I'm especially motivated to see the large number of people joining here, including young students, the number of people in the auditorium, and I'm told an equally large audience joining online. The fact that we have a forum like this to debate and discuss some very interesting issues that pertain to capital markets is, I think, something we should feel very, very excited about. I must also thank you, to the entire SEBI team for this topic, for a discussion on financial inclusion in capital markets, because typically when we talk about financial inclusion, we talk about banking, and some of my comments are pertaining to that. But in the weeks leading up to Samvad, I think my team and I had to do quite a bit of thinking and effort as to how we think about and approach a topic like this. So thank you for giving us that food for thought. And before I start saying anything, and I think it's okay, I'm a mutual fund CEO, so I will start with a small disclaimer, and I'm speaking at an event organized by SEBI, so I think a disclaimer is okay. I think these are thoughts. Financial inclusion for India and for capital markets is a journey, and it is a work in progress. And a lot has been done to that effect. Many of the suggestions proposed here may be outside the domain of current regulation, but the guidance for me was that the idea was to think, the idea was to ideate, and I'm sure, I'll have a great discussion with Pramod after my prepared remarks. So that is my little bit of disclaimer there. Now, when I was going to start this session, I was going to start with the technical definition of financial inclusion. But as I was driving from Parel, where I stay, to NSC here in BKC, I was having a conversation with my driver, Pramod. He's worked with me for now 11 years. And it's a very interesting story because I am always in the car and I'm constantly saying SIP, this, that, one hears it. And a couple of years ago, I noticed that Pramod was asking for a lot of his salary in advance. And I said, "Kyun maang rahe ho?" And he said, "मैं किसी gaming or online cricket platform, which I will not name, उस पे मैंने थोड़े से पैसे डाले थे और पैसे खोए हैं." And then I said, "तुमने थोड़ा बचाने का, invest करने का सोचा है?" And he said, he's a driver, he was looking at the cars, he's like, "मैडम मैं टेस्ला का शेयर खरीद लूँ?" उस टाइम टेस्ला बहुत न्यूज़ में था. And I said, नहीं ये सब मत करो, हमारा एक सिंपल सा हाइब्रिड फंड है, उसमें आप एक SIP शुरू करो. तो उसने 5,000 महीने की SIP शुरू की एंड 3-4 साल हो गए हैं, पैसे बने. आज वो मेरे से कह रहा था, "मैडम ये SIP ना अब मैं और लोगों को रेकमेंड कर सकता हूँ क्या, क्योंकि मेरे साथ तो बहुत अच्छा हुआ है." And I'll come to Pramod in the conversation later in the session. But to me, financial inclusion is when Pramod, when me, when everyone sitting here, when every citizen of India has equal access to financial products and services, has an equal opportunity to participate in the country's economic growth, in the market growth that we talk about and that we see. And I've divided my comments in this session into two halves. One is just looking at India's history of financial inclusion, some of the things that have worked, some of the things that have not worked. And the second is specifically looking at capital markets and suggestions on what we can do in securities markets, opportunities, challenges, things that we want to address. And some of this is well known to everybody, but if you look at financial inclusion broadly, India has had a series of financial inclusion initiatives. I would say well before Jan Dhan started, the foundations were laid with Aadhaar and electronic KYC, followed by Jan Dhan, which was a large movement to increase banking inclusion, followed by UPI in 2016, Pradhan Mantri Jeevan Bima Yojana, which focused on inclusion in the insurance markets, and finally the JAM Trinity that happened in 2020, which focused on the benefit of direct benefit transfers. The good news is, if you look at India's income inequality over the years, it's actually stabilized to improved. This measure of income inequality is the Gini coefficient. The Gini coefficient measures the income inequality of a nation, and a lower number is better. The index goes from 0 to 1. And what you'll see in the last year, couple of years is actually the Gini coefficient of India has come down. So income inequality has actually improved. For those of you who may think that the numbers in absolute have not come down materially, what is credible is when you look at India's journey compared to some other markets. If you look at the trajectory of both China and US, which went through an incredible period of development, typically we see that as a nation develops, its Gini coefficient tends to rise because the benefits of development go to a smaller few. If you look at China, for instance, here in the period of 2004, 2009, etc., the Gini coefficient rose. If you look at the period of US in the early 80s and late 90s, when a spurt of development happened, the same experience was there. Given the kind of growth that we have seen over the last few years, the fact that the Gini coefficient in India is stable is actually something to be happy about. But we can't rest on our laurels. As we go through a phase of development, as per capita income grows from $2,500 to $5,000, we have to ensure that inclusion is for all. It's also more important in the context of India, because if you look at China and if you look at the US, the absolute level of per capita income was very, very meaningful. In India, we're starting at a base, low level of per capita income. A similar number is seen in this statistic. This is the RBI index for financial inclusion. And what you can see is over the last 4-5 years, this index has risen materially. The index essentially measures three things. One is access to financial products and services. The second is usage of those financial products and services. And the third is quality. And quality includes metrics like financial literacy, investor education, all of that. One of the main reasons for this index to rise is that the usage parameter has actually gone up over the last 5-6 years. So there is availability of financial products, people have access to them, and people are actually using those financial products. Now let's break financial inclusion into three specific areas. And as I said, and I was having conversations with a couple of folks before starting this session over the tea break. When we talk about financial inclusion in India, typically the conversation that we have had is around banking. We have made tremendous strides as a nation in banking. I think if you go back to pre-2014, less than 15% of Indians had bank accounts. Today, 78% of Indians have bank accounts. 77% of women have bank accounts. In credit, we have made meaningful strides. 50% of the working population and 10% of rural households now have access to some kind of formal credit. Capital markets, on the other hand, as I said, has made progress, but it is work in progress. 5% of household savings are invested in equities, and I know the last panel talked about the bond market, where retail participation is less than 2%. It's also interesting to put these numbers because, as I said, capital markets inclusion is very much a journey in a global context, and these are some numbers that you may find interesting. We've made meaningful strides in demat accounts, and I know we're doing this conversation in the NSE. So we're 12% demat account penetration. The US, which I would think is an aspirational number, is at 62%. Mutual funds are now 6% of gross financial savings. But as I am known for tweeting, we have only 5 crore unique investors. In a country where 12 to 14 crore people are at least in the upper to middle income bracket. And we'll talk about mutual funds in a little more detail. MF penetration today after all the strides we've made, is at 17% of AUM, of GDP. The world average, and I'm not even talking about developed markets, is at 65%. So a lot of progress has been made. We've made a lot of progress, but a lot of room to go. Now let's talk about some of the financial inclusion projects that India has had, because I think there's a lot to learn from the work that we've done in financial inclusion on the banking side. So I've listed down a couple of major financial inclusion initiatives that India had. Of course, most people would be familiar with PM Jan Dhan Yojana, which now has 50 crore subscribers. Atal Pension Yojana was created to provide retirement benefits to a less privileged and unorganized class of workers. Two initiatives in insurance, one in life insurance and Suraksha Bima Yojana and accident insurance. Both have seen success in terms of subscribers, and of course all of us are familiar with the success of UPI. I think the point I am trying to make by showing this data is that where the government has made an attempt at financial inclusion, the schemes have achieved good penetration. So government schemes, by and large, have been successful at financial inclusion in the banking space. So far, however, they have been fixed return products. They are not capital market products. So the products are there, they've done well, they've got the penetration, but they are largely fixed return products. What we are seeing and what you'll see in the next slide is, though, Indians' aspiration is beyond fixed return products. And we do want to aspire for higher returns. And this is what you've seen. You've seen a large penetration in unregulated products in India today. So, and these are all estimates that the team tried to put together. You've got 3 to 5 crore participants in chit funds, Ponzi schemes. Of course, at some point, the number of accounts in crypto was larger than the number of demat accounts in India. And you've got various gold, precious metal schemes that jewelers run informally, unregulated insurance products. So if you look at mass India, they have access to regulated fixed return products that have come from the government. They have used them. They want more in terms of capital markets products. And unfortunately, they've looked at the unregulated sector for that. And why do we think unregulated products have had the success that they have? I think number one is that they take the empty space of a higher return product which has not been provided by a government scheme, with the exception of NPS, which is a locked-in product. But essentially, many of these unregulated products have fulfilled that need for higher return that a customer has. The second thing is that they have been very accessible. If you look at one of the prominent chit fund schemes, again, which I will not name, which attracted crores of investors, they were able to penetrate small villages and talukas, and the people selling them were people familiar in the village. So you said, ये तो मेरे गांव का ही है, ये मेरे साथ कैसे गलत करेगा? The second is that the ease of access at a time when the formal institutions have required, for the right reasons, a number of KYC, etc., ease of access has been extremely high. No documentation, no KYC. The impact in today's world of peer influence, of micro-influencers has been high. And of course, we are doing this all in the context of a nation where there is fundamentally a lack of financial literacy to understand the risks involved in these products. And so, the last thing my team did here is we looked for global proxies. We were having a conversation with the SEBI team and we said, let's look for global examples of financial inclusion. And we looked and we picked up Brazil and we picked up Indonesia. But, you know, the numbers were surprisingly small. 3 crore people, 5 crore people. And we said, why not look back home? Why not look at PM Jan Dhan Yojana, which effectively is the world's largest and most successful financial inclusion program? And I think there are 4 things to learn as we think about inclusion in the securities program from this program. One is the tremendous amount of political will and awareness. There was a belief that har Indian ko bank account milega, and tremendous awareness was created, again at the very micro level. Distribution is very important, so a large network of distribution was created using our entire bank network and banking correspondence, and it spun rural and urban India. KYC was simplified. Remember, these accounts were zero balance bank accounts. So if there was any inertia of the lower class to open a bank account, zero balance was there. KYC was linked to Aadhaar. So the process of opening these accounts became simpler. And of course, incentives came not only in the form of direct subsidy transfer, but also multiple free insurance schemes, etc., that were provided to people. So political will, focus on distribution, simplified onboarding of these products, and incentives to make this work actually made PMJDY very, very successful. It's now got 50 crore beneficiaries, 2 lakh crore of total depositories. Multiple RuPay cards were issued using technology to PM Jan Dhan Yojanas. And I think what makes me very excited is that 56% of those Jan Dhan account holders are women. And so this is the context in which I now want to turn to capital markets and how we think about financial inclusion in capital markets and make some specific suggestions. Before I do that, I think these are the potential levers and the background that we are working with. In a population of 140 crore people, today we have 80% mobile users. We have 52% of the population that pays tax. We have 12% demat account holders. 30% of the population is a UPI holder. So digital combined with physical is a very important lever as we think about capital markets inclusion. Of course, I come with a bias being a mutual fund CEO, but I truly believe that when you look at securities market products, if there is a capital markets product that has the capability to lead a financial inclusion initiatives, it is mutual fund. And there are a few reasons. Over the last 20-25 years of the existence of the industry, thanks to SEBI, we have become an extremely well-regulated and transparent industry. We also are one of the few capital markets products that it is extremely liquid with T+2 access. And today we are accessible with as little as 250 and 100 rupees. Mutual fund products are built to cater to various risk appetites, which is not true of all capital markets products. And we provide access across a variety of asset classes, equity, debt, gold, REITs, and InvITs. And one of the nice things about mutual fund products is there is an ability, and I'll talk about this in some detail, to add features that can make the life of a common consumer simpler. SIP, of course, has been a very popular feature, using SWPs to generate cashback, perhaps with allowance the ability to add insurance. So these products, the framework is there, it can be packaged very well for financial inclusion. This is MF penetration, and it's interesting to think about how MF penetration has shaped up. So across 32 crore households, if you look at upper and middle income, actually we have made meaningful penetration gains, 40 to 50%. Our argument now is to make wallet share gains. If you look, however, at the 26 crore lower and middle income households, where really we want to talk about inclusion, penetration is less than 20%. And this is where we have to make penetration gains. The other thing that the mutual fund platform benefits from is the impact of MF Sahi Hai. MF Sahi Hai, I think, is it should be a case study, but it's a unique campaign. It's perhaps the first time any industry has got together in the world, such a competitive industry, and pooled resources for the focus of financial inclusion. And I just plotted some data on the impact of MF Sahi Hai and how folio growth in the mutual fund industry has happened post 2017. There's also tremendous disparity today, and this is an opportunity for us, in mutual fund penetration across states. I have the privilege to travel all across India and see this firsthand. But if you look at a state like Maharashtra, MFAUM is 90% of GDP. If you look at a state like Gujarat, which naturally has an equity culture, penetration is much higher. But if you look at many states, AUM as a percentage of GDP, penetration has a long way to go. And so, coming to some specific suggestions, I think there are 4 buckets in which I would want to make suggestions, and then Pramod, of course, I would love to hear your thoughts. One is access, second is distribution, third is product simplification, and fourth is incentives. I think in terms of access, as we look at financial inclusion for a large mass of India, there is capital markets KYC, but there is a potential to leverage the Jan Dhan accounts, the 50 crore Jan Dhan accounts, because everyone today who has a Jan Dhan account has used Aadhaar as a source of KYC. So maybe thinking about Aadhaar-based KYC for this category of people to invest up to 1 lakh. The other thought is, of course, it is well known that if you want to create a folio today, combining the bank cost, KYC cost, exchange costs, it costs about 24 rupees a folio. Can you think about digital EMF accounts to reduce some of the operating costs? But access has to be made very simple. It has to be easy for someone who's a house help to convert and create an SIP account. The second very important point, and I know some of my MFD friends here are sitting here, is this exercise will succeed when we have an army of distributors taking these products to this category of the country. I propose that we think about almost a new cadre of distributors who do the job of only selling simplified funds to first-time investors, and perhaps we can find ways and non-economic incentives for the government to recognize some of these new cadre of distributors who get the highest number of Jan Dhan account holders, Jan Dhan MF holders. I also think that thinking about a new cadre of distributors is a very positive way to think about employment generation in the capital markets industry. And finally, I think using the large network of nationalized banks and postal offices for MF distribution, because we benefit from that. But this will succeed when distribution makes it succeed. The third point I want to talk about is simplified products. I come from the mutual fund industry and I am extremely proud of the number of products that we have. But I am the first one to say that if you want to take these products for mass inclusion, perhaps 40 categories of mutual funds is too much to talk about. I think SEBI has done a wonderful job creating frameworks like the upcoming SIF, which take the mutual fund platform and package it for a higher net worth individual. It's perhaps time to think about a platform like that for the low income group, and a platform that focuses on maybe just 3 simplified products, a fixed income product, a Nifty product, and a 50-50 fixed income and Nifty product. Because when I go to a consumer, being able to explain what I do is very, very important. I also think, and this is something I think perhaps our industry has to do some work on, is one of the reasons that a lot of inclusion initiatives, I think learning from the insurance industry, have worked is they've focused on goal orientation. If I take, if I have a conversation on investing in a Nifty 50 product versus something that is Sukanya Samriddhi Yojana, it evokes emotions. And I always think that we need to think about converting funds into feelings and funds into goals. So some of these products now can be packaged into goal-oriented solutions, just the way Sukanya Samriddhi or Atal Pension have done, but with a capital markets linkage. And I think the point of incentives is very important. Incentives don't come cheap, but there are a few points I would make. We can think about incentives for the next 1 crore unique investors, perhaps adding 100 rupees to someone who has done 2 years of a 250 rupee SIP, and perhaps the AMC IAP funds can be one source of doing something like this. The second, to the point of distribution, today if a MFD does a 250 rupee SIP, they make an income of about 15 rupees a year, and we have to think about upfront incentives for this cadre of distributors who are working on financial inclusion. And I think the last point I would make here is on awareness. We all know the opportunity and menace both that influencers can create. And I think SEBI is doing very good work in that regards. I think there is an opportunity to create a large number of AMFI-registered mutual fund influencers. They could be micro-influencers in small towns and villages. They could be teachers. They could be doctors. People who are AMFI-registered and convey the right message about capital markets inclusion. There is also an opportunity to focus on IAPs in schools and colleges, combined with physical activation in smaller towns. MF Sahi Hai has of course been a very successful campaign, but perhaps it's time to think about the next leg from MF Sahi Hai to shayad MF Sabke Liye Hai. And as I think about making this initiative concrete, it is interesting and perhaps something our industry can think about to take a pilot project in a couple of cities or micro locations close to us. Can our industry not try and run along with SEBI a pilot project at Dharavi, very close by to where we are, to think about financial inclusion? I want to end by telling you a little bit about my conversation with Pramod. So Pramod told me, he said, Madam, अब मैं ना लोगों को SIP करवाना चाहता हूँ, and he said मैं ना शिवडी के गांव में I am organizing a cricket match और वहाँ 350 लोग आएंगे. तो he said आप कुछ कर सकती हैं क्या, आप कोई आदमी भेज सकती हैं? मैंने कहा बिल्कुल भेज सकते हैं. So we will send a person and we will do all that. But if I think about someone like Pramod, if we were to run this at scale, we would need a few things. Firstly, if I were to send a person there and 300 people are at that cricket match, I certainly need the ability to convert them very quickly through quick access. If it was their bank account, it would be a lot easier. I do need micro-influencers like Pramod to spread awareness. And while I can send one guy to one Shivdi village, in the long term, I need a lot of distributors who are incentivized to go to these cricket matches and do this work. And of course, I need a very simple product basket that I can explain to those 300 people. You know, I think the mutual fund industry has a long way to go. This is a chart that I pulled up and it inspires me to do the work I do. India's current economy is 4 trillion in size. You know, if you look at some point, we will become a $10 trillion economy. If you look at the US economy was there in the late 1980s, so early 1980s. So in 1984, the size of the US economy was 4 trillion. It grew to 10 trillion by 1999. GDP went up 2.5 times. The mutual fund industry in that period grew 24 times. In fact, when the US economy grew from 10 to 27 trillion, GDP went up thrice, but the mutual fund industry grew 6 times. I have no doubt that our industry will also see this trajectory. But the trajectory we must also see is something that looks like this. Viksit Bharat 2047, at least 75 crore Indians, which is 50% of our population having a mutual fund account. And I certainly would be very happy if 40% of these are women investors. There's a beautiful line that's just showing up there that says enabling a billion dreams. And I will leave you with just a few thoughts and then Pramod I would welcome. But I believe कि सपनों का भारत तभी सजेगा जब हर हाथ कलम उठाएगा. सपनों का भारत तभी सजेगा जब हर हाथ कलम उठाएगा. पैसे का रंग ना देखें, बस ये चाहें हर इंसान अपना सपना पाएगा. Thank you very much.
So, indeed, you know, Radhika, I must compliment you. The presentation requires very little, you know, sort of critiquing, if I had to put it that way. I find very many points of resonance. So I should begin by saying that, you know, if indeed we are a rising country, it will be because we all rise together. I think it cannot be that anyone is left behind. And I think that's indeed the theme, whether of Viksit Bharat, or enabling a billion dreams and what you just sort of spoke. I think the way I would want to sort of, you know, equally add to what Radhika has said rather than say critiquing it, I would say maybe sometimes we should not beat ourselves up too much either. So, you know, one, to me, every time we have an insurance sale, every time we have a pension sale, to me, actually, there's a linkage back to the capital markets. I think all of their products, while they sell it as pension or insurance, the funds flow into our capital markets. So to me, whether it is a large pool of pension funds which have got assembled, large pool of insurance funds, I think that itself feeds back to us and that is something we should celebrate. And those numbers aren't small either. I think, again, when there is pension for all, when there is insurance for all, I think, again, there is going to be that inclusion which occurs without us looking at it as directly happening. And I think the alternative that the capital markets and in form of mutual fund offers is that it can be pretty direct. As opposed to that there is an insurer deciding where to deploy your funds, a pension fund manager deciding. Here you are able to sort of choose where to deploy. And I think that's what you spoke to, Radhika. So in this, the question which I really had is, and I know it's so new, but I saw very curiously you said SIF for even inclusion. And I know we have yet to launch our first products even for what is, I think it's now pegged at 10 lakhs, so between a mutual fund and PMS. But why would you have thought that, and what's the thought process?
No, so my point there, Pramod, was an SIF equivalent framework for inclusion. What the nice thing about SIF is it takes mutual fund, which is a platform, and tweaks it and carves it out for a 10 lakh income bracket. Why can't we take mutual fund as a platform and carve out something, call it Jan Dhan mutual fund for this? Because my belief is if you just take 250 rupees SIP, the existing class of mutual funds, there's almost too much confusion for a first-time investor. And I'm saying this, by the way, as a representative of the industry. Right. So what I like about SIF is it's taken a platform, it's created a new set of rules. The current mutual fund platform works beautifully for what it does, but why don't you take it and create a class of it that is for this category of investors, where perhaps I can package only, where I can say to AMCs only have 3 kind of products, maybe enforce a certain amount of lock-ins, maybe name them differently like Sukanya Samriddhi Yojana. So that was the idea.
No, and I think that's indeed welcome thoughts. And what I would sort of say is SEBI remains open to hearing these and sort of then looking at what to tweak. Again, in contrast, and at some level, I think we should acknowledge that also. I think we at SEBI more create an enabling environment, and it's really the market players who then take it forward. But if I had to just change the contrast, if I had to say, I think banks had to do priority sector, they had to do, in a way, the enrollment of for Jan Dhan and so on. So the mandate also drives a lot of things which happen. How would you say, if we had to say, what if we had to mandate mutual funds? So far, like I said, it's been a competitive environment, but would that be equally a thing which can then play out?
I think if there is an enabling infrastructure in terms of platform and in terms of distribution, and you mandate it, mutual funds to do it, I think we would readily pick up the challenge because finally, most of us, I think, we feel very good about mutual fund as a product. And many of us carry the dream कि भाई हर घर mutual fund जाए. We know कि किसी को 10 साल की आप SIP दोगे तो nothing bad will happen to that customer if it's in a sensible thing. So I think the industry, if provided the enabling infrastructure, would happily pick up the platform. And I think whenever, and SEBI has done a wonderful job of providing enabling infrastructure, whether it's in mutual funds. I remember when Bharat Bond came up, SEBI created the enabling infrastructure for fixed income passives. In fact, SEBI has created so much infrastructure for passives. I think the industry is hungry to take it up. I think SIF, the industry is going to be very hungry to take it up. So yes, I mean, airline carriers also operate to areas that are non-profitable. Insurance providers do things that are non-profitable. So I think if the enabling infrastructure is there, the industry will rise to it.
Yeah, and to me, I would equally, sort of also be a challenger around the point of saying that we need a new cadre of distributors. So if we are saying we have embraced digital India, and maybe, the penetration on digital front has been far deeper than probably what the financial market has done, then again, my question is, why are we not riding on those digital rails more? Why is it we are not able to harness those platforms to get people to engage? And I'll link that a little later, but I thought I'll first ask you this, and to another point you had made in your presentation.
No, look, I think, Pramod, the answer needs to be a combination of digital plus physical. I do think there is a role that physical outreach and education plays today, if you take the example again of, in fact, I have a story. I had a help in the building who had come to me and she doesn't know me and she said, Didi, thoda sa crisis ho gaya. मैंने कहा क्या हुआ? She said, किसी digital platform से, I couldn't believe this. मैंने mutual fund खरीदा और देखो पैसे नहीं बनाए. And I noticed that she had a bunch of very, sectoral funds that were on a digital platform, ranked the top. You know where this is going. I think the physical role of an advisor is important in guiding someone to the right kind of fund. Because if this kind of consumer goes into the wrong product, we almost lose that consumer and sometimes part of that community forever. So I think digital is a great model for onboarding, but physical is a model for advice.
I hear you. I think the point where I wanted to link it up was the entire spectrum of unregulated products that you showed. And maybe again, some I think ride on these digital platforms and some indeed are physically distributed. To me, the other question, and which really, when I think about the KYC for insurance, and it's very, if you have studied that, it's actually back-ended. So really only when the payout is to happen is when the person who's going to get the payout has to fulfill KYC. So the onboarding in insurance is really easy. So the money comes into the insurer's hands. So my question would be, again, if we had to flip some of it and sort of say, yes, the money's come into a regulated entity.
Yeah.
It's managing it, it's deploying it in whichever fashion. It's when the redemption has to happen that we will do a KYC. Right?
I think that's a fantastic idea.
So again, to me, can we rethink some of these norms? And I'm saying I'm not even drawing from outside. I'm looking at our own country where we have a regulated product which offers this. So on these lines, what else is it that we can do which sort of changes the discourse, so as to speak? Because I think that ease of onboarding, the thing of saying, oh, there are all these documents to fill up, all these things to do, versus saying I'm making that choice about where to put my money, and that's really working through.
And I think if I were to build on this, Pramod, it's a fantastic idea. The idea is that onboarding, that point at which trust thoda dagmaga raha hai, you're confused कि ये करूं. If at that point you say up to 1 lakh, I can use your Jan Dhan account, but on redemption, for instance, on any kind of corporate action, in our case it could be on redemption, by then you have to complete your KYC because then I'm actually giving money back. And maybe you can cap it up to 50,000 rupees of AUM. After that you mandatorily have to complete. I think the idea, and both of us are saying the same thing, is for that customer, just make the entry point very easy. बाद में सब करवा लो. और बाद में वो कर भी लेगा because these are good products.
No, and to me, the incentive obviously is now he does want that redemption. I think at that point in time, there is hopefully lesser, worry about saying I'm parting with my ID documents or my address proof or what have you. And if indeed anyway our credit is into another bank account, that to me is another solve, that we are not actually giving out cash. It's still staying in the system
within our
somewhere.
system, yeah.
The other sort of thought which crossed my mind was that, and it's more a call to us as regulators, but also the MIIs, is that as we see unregulated product, is there a way for us to sort of start thinking about how do we bring it within the regulatory perimeter? Because if we leave it out, my fear is it may become bigger and indeed cause far more pain or far more losses than what the investors can sort of do. And indeed, I have a couple of examples to offer, which is, for instance, I saw there you had said about fractional real estate.
Yeah.
And indeed, SEBI has gone forward and said we will expand our REIT regulations to encompass something called small and medium REITs. To me, that's an expansion of the regulatory perimeter. There were online bond platforms before we actually came out with the regulatory framework to bring them inside. So to me, I think we are also being responsive. Of course, we are limited by the fact that we have a charter. So they have to fit within whatever is the broader charter of saying what is permitted, not permitted. But again, if for instance I'm seeing insurance there, then is it something to go and tell the IRDA that, well, there is something for you to consider? Because there is a demand. Somebody is meeting that demand. Is there a way for you to get it within the perimeter? So any more thoughts around what you saw on those unregulated stuff as well?
So I think one thing that we have to think about, and I agree with you that SEBI has done a lot faster, as fast as it can, to try and bring chit funds, unregistered, collective investment schemes. I think one thing to think about is in today's environment, even from 10 years ago, an unregulated product can become very large much faster than it used to because, and take the example of crypto, which you are well aware of, the combination of celebrity advertising, the combination of influencers, social media, I think all of this has made unregulated products very potent. Which is, by the way, Pramod, why I made that point around micro-influencers, because, if there's a beast out there, we might as well use the beast to do good things and send the right message. I know NSE has been doing a lot of work on capital market safety and sending those right messages, but that's my thought on the penetration goes up much faster than we think it can.
And I think our influencer, regulation or guidelines that we have come out with, I would say actually support a regulated intermediary as long as they are taking responsibility for engaging a influencer. I don't think we come in the way of that. I think our fear is somebody who's, not attributed as to where is he deriving his fee or commission from. But what you are describing is indeed within the regulation.
What I'm saying is actually take it one level further. So you said cut out the bad influencers. We have no problem with influencers. I have said let's use influencers and create our own good influencers. Let's take Amphi and say let's create good NSE regulated, Amphi regulated, SEBI regulated influencers, and not the online guys who go and say, do an SWP or 3 saal mein paisa double hoga. A teacher who's a respected teacher who's looking for some extra income, who has influence in her locality. Why can't she be a good MF or securities market influencer?
I would believe Amphi has anyway led the way in creating the mutual fund distributors. And to me, I think as long as there is alignment to sort of saying, and that's why I said, if that person is indeed engaged by and paid for and held responsible or accountable for by the person appointing them, I don't think we should have a concern, is the way I would sort of put it. But indeed, we will look forward to a lot of these, and I'm hoping it's provoked enough thoughts both for my colleagues and for the audience. Should we equally open it up to audience?
Yes, I think we should open it up for questions. I see quite a few hands, so
mic across.
Do you want to pass across a mic? And I think since we have limited time, I'd request you to keep your questions brief and to the point.
So one of the ideas which after listening to your presentation, in fact NISM also can take a proactive initiation of training these sort of mutual fund distributors at the micro level rather than at the macro level kind of thing. They can take the help of the local mutual fund distributors or at the same time the stockbrokers who are already there, using their own premises to training up these sort of local talent. And it will be helpful. In fact, the SEBI would be incentivizing these sort of activities for that also.
Yeah, certainly. NISM is as much a co-partner for us at this conclave, and Mr. Shashi is here. So I'm sure he will also figure out what's the best way of doing these things.
Yeah, actually, I missed NISM in this, but as we think about distributors, as we think about even influencers, right. I think NISM can play a meaningful role because in certification of these kind of influencers, in talking about these kind of influencers, because we have no problem with social media. We have a problem with bad advice on social media. So if I'm an NISM certified guy, maybe I carry a certain degree of credibility, and maybe there's a public awareness campaign to say, listen to guys who have an NISM certificate.
Certainly.
In fact, smart trainers are also there.
Yeah, this is Amit Naik. I am a MFD. In fact, I have two proposals to SEBI. What we have seen in the Janadhan bank account, it is a humongous success. Why can't we have a Janadhan or a no-frill demat account, meaning that the depository participants of both the depositories should not charge AMC? This is first one. The second one is that the issuance of the mutual fund units should be in a dematerialized form. Now it is voluntary, but it could be made mandatory by the SEBI. Why I am saying is that, so just remember in the past what we have the physical shares at shares. After the dematerialization, the industry got integrated and more disciplined. So why don't we have these kind of things? Thank you.
Thank you. The quick sort of thing on the first item, so we do require the depositories to offer what is called a basic demat account. In fact, I think just a few months ago, we raised the limit of what can comprise in a basic demat account from 5 lakhs to 10 lakhs. So in a way, that is the more cheaper version or low-cost demat account access that is available. But I'll turn to Radhika on both the demat of mutual fund units, because I think a lot of our success has also come from the fact that there is no paper, that there is neither a certificate nor a demat entry, and it's more statement of accounts that on which at least 90% of the mutual funds work on. But over to you, Radhika.
No, I would agree with you, Pramod. I don't think, well, while there's no problem dematting mutual funds, I think the current system in where you have a folio and a statement of accounts, and in fact, I think most of us would be happy to see even the current account and application forms go paperless. So I think we should drive towards more paperless than less paperless. There's also a challenge which is operational in dematting accounts in terms of increasing the cost, because when you start dematting mutual fund accounts, it does add to the cost, and particularly when we are looking at things from an inclusion point of view, all our collective attempt will be to reduce cost. The ability of mutual funds to get data when it's dematted. So I think those things need to be thought through, but I always argue that why fix what is not broken here?
Exactly.
Hello. I am Venkatesh from Punjab National Bank. Ma'am, I just saw in the slide stating that, to have women investors, we have set an ambitious target of around 40 crores investor by 2047. My suggestion is, ma'am, there are large number of self-help groups across the rural hinterland of our country. So, and one of the Pancha Sutras is regular savings for the self-help groups. So why not, with a very minimum amount, 250 rupees SIP, so to reach up to that level, so we need to have like our banking presence is there already in the rural hinterlands, as well as we got a large number of LIC agents, postal guys, we can put them to train them properly under the ambit, and they can reach out to the masses, and we can easily we can increase the investor base there. So I had a suggestion to the industry to look forward to it.
So I have a thought here, and Pramod, I would love to hear your thoughts, but I think SEBI has been working on a 250 rupee SIP, and I think it's a wonderful suggestion. The question is, can you package, and you have one of the beautiful things about SIP, for instance, is it is an investment product, but I think its success is also that it is a savings product. In fact, I remember 2 years ago, I had a help for my baby, and so again, because they hear me talk about SIP on the phone, she came to me and said, "Didi na mera ek SIP shuru karwa do, main kar sakti hu kya?" तो मैंने कहा बिल्कुल कर सकती हो. तो then like a typical mutual fund CEO, I went to her and I said, राजी कौन सी स्कीम में करना है, लार्ज कैप में करना है, मिड कैप में करना है, क्या करना है? She said, दीदी कोई भी स्कीम में कर लो, इन्वेस्टमेंट की बात नहीं है, पैसा पति के पास तो नहीं जाएगा. And we are laughing, but this is the reality. So for her, actually, I started the SIP. It was a way for the money that I gave her to go from her bank account into an investment account so that nobody else could touch it. So SIP is actually a beautiful savings-oriented feature. The question is, can we take this 250 rupee SIP and package it for that class of women as a specific savings feature, and then again create women micro-influencers? So again, the idea is packaging what we have.
I think all of it comes together to, that we have several things that which we can combine and sort of offer. And I would even go further to say, why 250? Why not go down all the way to 100 rupees?
Yeah.
And if you cultivate that habit, sometimes you can do a top-up which goes, whenever you have that surplus cash. So it need not limit itself to a specific number. But I quite agree. I think we need to think about all of these together, sort of then having a big bang impact, so as to speak.
And I think a lot of it lies in bringing it together and packaging for specific solutions and use cases.
The one which you said, for instance, just the goal orientation. that what pension is offering is probably exactly what a mutual fund scheme can offer, but it's about label and therefore making it available. So many things like that, indeed, I think.
I just think, you know, large and mid-cap scheme versus a goal. No, very few people very few people wake up and think, yeah, I want to invest in a large and mid-cap fund today. Most people think, how can I save for my daughter's education? You know, the orientation, I think, has to be and it's to us also, has to be more consumer facing.
Good afternoon, ma'am. My name is Shivani. Ma'am, actually, I have a question come suggestion. As you talk about the financial inclusion, so for the financial inclusion, we are a youth country, young country. So why don't we, with the SEBI or with the NSC, we just give any curriculum kind of thing in the education system for the youth, because youth is a future. If they come to know about what is mutual fund, what is security, with the traditional economics, can we build a curriculum which gives the basic knowledge about these things, so that these representative can, the youth can understand from the basic of it, and in the future only they will get to know about everything. As you talk about financial inclusion and sending representative, so instead of sending a representative, can we make representative in our schools and in our curriculum? So that is my question.
Do you want to talk about this, Pramod?
No, I think it's a brilliant thing. We need to go far lower and far earlier, both in investor education, in equipping them, I think not just, I would say, around investments, but actually money management, around, everything else which they will confront, whether they join the workforce or they become an entrepreneur. I think each of that is indeed required. I don't know where to start or where it should be started, but certainly I think today we have an environment where it can be seeded, is the way I would put it.
Yeah, and I would add, I think we need to do education at various points in an individual's life. So one of your major points is when you enter the workforce, and by then you're already swarmed with bankers and options and unregulated products. So I do believe, and I think people have spoken about this, I think the last budget also talked about this, but bringing financial education, and maybe we can do it via IAP, into the high school curriculum. I also think, and this point is not raised as much, one of the groups that has income and is a target for all of these schemes is retirees. So people who are 55 to 58, 59, a lot of people will go to them, missell, given unregulated products. At various life stages, we need to think about education. It's also targeting financial education to be more life stage focused.
Agreed, quite agreed.
So that 1 crore, because even today anyone who retires from a PSU bank, small clerk also will have a 1 crore corpus at retirement, and it would be a shame if that is put into a product or missold or put into something that does not help them reach their goals.
Correct, quite agree. We'll probably make this the last question.
Yeah, we'll take one more question.
I had a question because since there are products which are such as mutual fund where a lot of money is being encouraged to be invested in the secondary market, so is there a chance that secondary market money flows become so much that it threatens the real world, it creates a cash crunch in the primary market or the real world physical market as well, because the cash, because you are pulling out so much cash from the public to be invested in the secondary market, whereas there's just a exchange of equities, and whereas it can also threaten the demand in the real world. As you can see in the recent quarterly reports, a lot of companies are facing losses. I think, can it create a cash crunch in the real world economy?
Well, I'll try and answer that, but the way I would sort of put it is that stock exchange is indeed where people come in with different perspectives. I think some come in thinking that I want to encash what I already hold. Somebody who believes comes in saying that I want to actually grow what I'm seeing an opportunity for. So I think it's that what makes it a market, that there are different views, different perspectives on issues all the time. How much of it in terms of when you say secondary market, I also look at it as it's like having an ATM every day when you hold stocks, right? You can go punch in the order and you sort of get your money, and when we move our settlement cycles and crunch them, it is almost like that you're getting it as quickly as you can. So I think you have to view the market like that. And it is meant to be a reflection of the real economy? Of course it is. Now, can it run ahead? why it runs ahead is only that it believes that there is something else the real economy will do, which you have an opportunity to participate in. I think that's how you have to sort of look at it. Yes, there can be, if there is a breakdown of confidence, if there are major scandals, scams or whatever, that confidence evaporates and then the prices or valuations sort of slide down across the board, right? And that may or may not be really reflecting of what's going on in the real economy, because that scandal may be confined to something, but the fear sort of envelops everybody. So again, I'm saying these are perspectives around market itself. So yeah, I hope that...
So I had just one last recommendation. Is there a possibility that some amount of money from secondary market can be flowed into the real listed companies? Like if Reliance stocks is being traded, then some buying percentage like 0.1% can actually go back to the Reliance because it's being traded in the secondary market, so that the cyclicality can be maintained.
So why would you want to give the issuer that? That is between the two, between the buyer and seller, and of course those who are supporting that transaction. So yeah, I don't see a merit in that.
Thank you so much, Radhika ji and Pramod ji, for an interesting discussion. We had very nice takeaways from the discussion. May I now request Shri Shashi Krishnan, NISM Director, to felicitate our speakers. I also request Dr. Tirthankar Patnaik to come on the stage and felicitate with the NSE bell. Quiz winners of the top 3 quiz winners, can we have them at the stage, please? Could we have the quiz winners? The quiz winners of the second panel discussion. Pavan, Rohit, and Nishika. Yeah. Thank you so much. I request Ashish to take through the next session.
Thank you, Ashiana. Now we move on to the third session of our day. So good afternoon, ladies and gentlemen. I welcome all of you for the third session of the day. So the topic is fostering securities market beyond equities, strategies for market expansion and asset allocation towards alternate investment. For this panel, we have Nilesh Shah, Group President and Managing Director, Kotak Asset Management Company, as speaker, and Saurabh Mukherjee, Founder and Chief Investment Officer, Marcellus Investment Managers, as a discussant. Now, I would like to request all the dignitaries to come up on the dais for the session. Can we have a round of applause, please? I request the speaker and discussant for a group photograph. Now, before we begin this session, we would like to have a small quiz on the topic. So yeah, The same procedure again. Please scan the QR code on your screen to join the quiz. So congratulations to the winner. I would request the winners to reach near the dais after this session. Now I hand over the stage to speaker Shri Nilesh Shah. Sir, over to you.
Shri Pramod Bhai, Dr. Tirthankar Patnaik, Shashi Bhai, and friends. My topic was fostering securities market beyond equities, strategies for market expansion and asset allocation towards alternate instruments. ये टॉपिक देख के मुझे 3 Idiots मूवी याद आ गई. वहाँ पे भी रेंचो मशीन की डेफिनेशन कुछ ऐसे ही दे रहा था. तो मैं इस चीज को थोड़ी सिंप्लीफाई कर देता हूं. एसेंशियली टॉपिक यह है कि हम भारतीय को आर्थिक आजादी कैसे दिला पाए. हर किसी की चाहत है कि पैसा बने, अमीर बने और आर्थिक सुरक्षितता प्राप्त करें. यह संवाद उसी के लिए है. And this is not something new. Long back, Chanakya mentioned, Sukhasya mula dharma, dharmasya mula artha, arthasya mula rajya. If you want happiness, if you want state or governance, if you want money or commerce, they are all interlinked. As investors, we all want financial security. Let me try to define in next 10-15 minutes what needs to be done. I'm sure all of you are aware about India's greatest general Peshwa Balaji Bajirao. He was never defeated in his life. रणवीर सिंह ने भी उसका किरदार अदा किया था, वो तो शायद आपको याद ही होगा. The statement of Peshwa Balaji Bajirao was very simple: strike at the roots and branches will fall. We have to go and hit at the root so that all these things fall in place. Now अभी एक स्टूडेंट ने सवाल पूछा था कि आप म्यूचुअल फंड वाले पैसा ले जाएंगे तो रियल इकोनॉमी में पैसा नहीं रहेगा. इसे देख के और एक हिंदी मूवी याद आ गई. एक मूवी थी जहां पे स्टेट असेंबली में डिबेट हो रही थी. आप पानी में से बिजली निकाल देंगे तो उस पानी में वैल्यू क्या रहेगी, खेत खलियान कैसे फलेंगे फूलेंगे. बट the question which the student asked, the same question was asked by Mercedes-Benz India CEO. लोग SIP कर रहे हैं इसलिए मर्सिडीज गाड़ी नहीं बिक रही है.
तो you are on the right path. You should apply job at Mercedes-Benz India. But all of you know that in mutual fund, we don't accept cash. If Saurabh Bhai invests in Kotak Mutual Fund, he gives me check. And I go and buy shares from Tirthankar Patnaikar, I give him cash. तो पानी में से बिजली निकालने से जैसे पानी को कोई फर्क नहीं पड़ता, वैसे म्यूचुअल फंड में पैसे आने से रियल इकोनॉमी को कोई फर्क नहीं पड़ता. फिर भी लोगों में ये मिथ है, भ्रम है, मिसकंसेप्शंस है. एंड इसमें बेटे आप अकेले नहीं हो, पूरा भारत एक जैसा है. हमें फिजिकल एसेट्स में निवेश करना अच्छा लगता है. रियल एस्टेट है, सोना चांदी है, डायमंड है. 20 साल से डायमंड में किसी ने पैसे नहीं बनाए, बट फिर भी निवेश करना अच्छा लगता है. ये जो फिजिकल एसेट्स के पीछे हम भाग रहे हैं, उसकी कितनी बड़ी कीमत चुका रहे हैं वो हमें पता नहीं है. फॉर एग्जाम्पल, पिछले 22 सालों में भारत ने $373 बिलियन सोने की आयात की. प्रति साल 1000 टन सोना आयात करते हैं, 700 टन रह जाता है, 300 टन एक्सपोर्ट करते हैं ज्वेलरी के रूप में. $373 बिलियन. गोल्ड स्मगलिंग है, आप सब जानते हैं. और कभी एयरपोर्ट में हम जब आते हैं वापस, तो दुबई या सिंगापुर या मिडिल ईस्ट की फ्लाइट में देखते हैं भप्पी लहरी के कजिन ब्रदर्स एंड सिस्टर्स मिल जाते हैं. लोगों को समझ आ जाएगा ट्यूबलाइट है बट जलेगी जरूर. Collectively, would we have spent $500 billion in import of gold and send our money abroad when we needed that capital to invest in India? This is lack of financial awareness. चलो वो छोड़ दीजिए. Even in financial assets, the lack of awareness is killing. If I tell you that there is a marathon runner which wants to run marathon with 7% lung capacity, how many of you will bet on him or her कि by using 7% of your lung capacity you will be able to complete marathon? I doubt anyone will bet. But then all of us are part of that tribe. When we do our financial sector investment, when you, me and collective Indians do allocation in financial instruments, 93% of instruments are in negative real return product or low real return product. Bank deposits, insurance, small savings, pension, and most importantly, currency notes. आप में से किसी ने घर पे पैसों के जाड़ उगते देखे हैं? किसी ने नहीं देखा. बट फिर भी मैं, आप और हम 9 लाख करोड़ रुपए करेंसी नोट में रखे हैं बिटवीन FY21 एंड FY23 एज पर RBI रिपोर्ट. 9 lakh crore. That is more than money which came into mutual fund. म्यूचुअल फंड में जुम्मा 4 लाख करोड़ आए. डायरेक्ट इक्विटी में 2 लाख करोड़ आए, इंक्लूडिंग कॉर्पोरेट बॉन्ड्स एंड डिबेंचर्स एंड फिक्स्ड डिपॉजिट्स. 6 लाख करोड़ ऐसे इंस्ट्रूमेंट में आए जहां पे आपको रियल रिटर्न मिलेगा, और बाकी सारा पैसा ऐसी जगह पे गया जहां पे कोई रियल रिटर्न मिलने की गुंजाइश नहीं है. आज तक किसी ने देखा है कि बैंक एफडी में इन्वेस्ट करके कोई बंदा रईस बना है? बैंकर बनता है रईस, बैंक एफडी होल्डर कभी नहीं बनता. दिस इज हाउ वी आर इग्नोरेंट अबाउट फाइनेंशियल्स. इसीलिए सबसे पहले लोगों को समझाना है कि भाई अपनी जिम्मेवारी खुद लो एंड बिकम फाइनेंशियली लिटरेट, ताकि पानी में से बिजली की बात नहीं हो, ताकि घर पे पैसों के जाड़ आज नहीं तो कल उगेंगे वो ख्वाब देखना बंद करें, ताकि जहां पे लॉस मिल सकता है, वहां पे लाइन लगाने की जो हमारी जरूरत है वो कम हो जाए. एंड एजुकेशन इज नॉट द आंसर. India's most literate state is Kerala. Most literate. Kerala spends more money buying lottery than buying anything except gold. And lottery business का नियम है, जिस दिन लॉटरी खरीदने वाला पैसा बनाएगा, लॉटरी बेचने वाला धंधा बंद करेगा. And yet Keralites keep on buying lottery year after year, decade after decade, generation after generation. No wonder they remain poor. F&O trading. There are records to be proven that F&O trading करके नुकसान ही होगा. आप सभी ने आयरन मैन मूवी देखी है? शशि भाई, इनको थोड़ा टाइम दीजिए ताकि आयरन मैन जैसी मूवी देख सके. ये लोग करते क्या है? किताब से ज्यादा मूवी देखिए, ज्यादा नॉलेज मिलेगा. सौरभ भाई जाग रहे हैं लोग, टेंशन मत लो. If you have to fight with Iron Man, which is wearing a protective armor, which is supercomputer, will you go and fight? एक झटके में सारी हवा निकल जाएगी. And yet there are millions of Indians who want to fight with Iron Man. There are hedge funds who have better data analytics, who have better computational power, who have better connectivity. उसके साथ ये लोग लड़ने जाते हैं रोज सुबह, रोज पिटाई करते हैं, बट नहीं लड़ेंगे. भाई लड़ना बंद कर, गलत डायरेक्शन में जा रहा है तू. अभी आपने परसों के अखबार में पढ़ा होगा, टोरस करके मीरा रोड में 1,75,000 आदमी ने हजारों करोड़ रुपए गंवा दिए. एंड आई एम श्योर दिस इज अंडर एस्टिमेटेड नंबर, बिकॉज एक तो पैसे के ऊपर से इनकम टैक्स वाले घर पे आ जाएंगे. प्रमोद भाई, मैं अंधेरी में रहता हूं. अंधेरी की एक भी कॉलेज ऐसी नहीं है जहां पे मैंने जाके ऐसे लेक्चर नहीं दिए हैं. एक भी सोसाइटी ऐसी नहीं है जहां पे जाके मैंने ऐसे लेक्चर दिए, लोगों को समझाया भैया निवेश करिए. कोटक म्यूचुअल फंड में तो अंधेरी वालों ने 3,000 करोड़ नहीं दिए, बट पूरी म्यूचुअल फंड इंडस्ट्री में नहीं दिए. और वहीं पे सौरभ भाई एक दूसरा बंदा था, चार्टर्ड अकाउंटेंट था. मैं तो गोल्ड मेडलिस्ट ही हूं, वो तो रैंकर भी नहीं था. उस बंदे ने लोगों को सिर्फ ये प्रॉमिस किया, मैं आपको 2% रिटर्न दूंगा. 3,000 करोड़ की चोरी करके भाग गया. और मेरे फंड ने पिछले 20 साल से 2% रिटर्न दिया है स्मॉल कैप में. खाली मैं बोलता नहीं हूं, जो देता है उसको कोई पैसा नहीं देता, जो बोलता है पैसा लेके भागने वाले उसको लोग लाइन लगा के पैसा देते हैं. ये सब लोगों को हमें समझाना है कि भैया अपनी जिम्मेवारी खुद लीजिए एंड स्टार्ट इन्वेस्टिंग. सो द फर्स्ट थिंग इज फाइनेंशियल एजुकेशन, सॉरी फाइनेंशियल नॉलेज, बिकॉज एजुकेशन से तो कुछ नहीं होता है, वो आपने देख लिया. How do we make people financially literate? How do we make people not only wise but also knowledgeable? There are multiple things. Radhika mentioned couple of things. SEBI has done a great thing on mutual fund Sahi Hai campaign. NSE has been doing lots of activity. But ultimately यही है कि हम घोड़े को पानी तक लेके जा सकते हैं, पानी तो घोड़े को खुद को पीना पड़ेगा. प्लीज बी रिस्पॉन्सिबल फॉर योर फाइनेंशियल सिक्योरिटी. हम लोग सेबी के रेगुलेशन में आते हैं तो किसी को स्टॉक की टिप नहीं देते, एंड पिछले 20-25 साल से ऐसा कर रहे हैं. सौरभ भाई, एक बंदे ने मेरी माँ को फोन किया कि तुम्हारा लड़का एकदम बेकार है. माँ बोली वो तो मुझे पता है, बट अब क्या किया उसने. जब मैं उसको शादी में मिलता हूं और बोलता हूं कि नीलेश भाई कोई टिप दे दीजिए, तो बोलते हैं हम टिप नहीं दे सकते, म्यूचुअल फंड में एसआईपी करिए। और टेलीग्राम चैनल में रोज पैसा कौन सा डबल होने वाला है उसकी टिप देता है। माई मामा इज 81 years old। उसने उनको समझा दिया कि देख भाई वो नीलेश सर रियल नहीं है, फेक है। बट मेरे रिलेटिव जो मुझे 25 साल से जानते, उनको ये विश्वास नहीं था। This is the kind of ignorance which we are fighting. Regulators, industry, exchanges, authorities can do many things, but ultimately घोड़े को पानी खुद पीना पड़ेगा। Second thing, what we have seen in any industry where regulator is there are boundaries within which people operate. If there was a SEBI equivalent regulator in Ponzi scheme, do you think Taurus would have happened? Extremely unlikely. If there was RBI equivalent regulator in many of these chit funds and nidhis and wishes, do you think people would have lost money? Answer is no. We need regulator which cover all the aspects of financial investment. And we need regulator with Iron Man suit. In US, Rajat Gupta was caught giving information to Rajaratnam because there was wiretapping power with SEC. We don't give that power to our regulator and we expect them to catch. How can they do it? We need to empower our regulators so that they can enforce regulation. Fear of law is far more potent than punishment of law. The third thing, पानी वहीं पे जाता है जहां पे ढलान हो, पैसा भी वहीं पे जाएगा जहां पे एक ढलान होगी. Where does ढलान occur? It happens with various incentives, various differential standards. आप म्यूचुअल फंड का पोर्टफोलियो देखिए, लास्ट नया पैसा कहां पे इन्वेस्ट किया उसकी डिटेल मिलेगी. बैंक में जाके पूछिए कि भाई आपने लोन किसको दिया है, कोई इंफॉर्मेशन नहीं मिलेगी. There are different disclosure standards, different commission standards, different transparency, different tax incentive. ये सारे ढलान के बीच में पानी ऐसी जगह पे पहुंच जाता है जहां पे नहीं पहुंचना चाहिए. And hence there is a need for a level playing field between banking, insurance, mutual fund, pension, small savings, and also most importantly buying of gold. गोल्ड खरीदना है, कोई केवाईसी नहीं है. म्यूचुअल फंड खरीदना है तो केवाईसी करनी पड़ती है और 3 साल के बाद वापस करनी पड़ेगी. गोल्ड खरीदना है, उसके ऊपर कोई एमआरपी नहीं है, कोई मार्जिन नहीं है. 5 ग्राम का गोल्ड 40% मार्जिन पे बेच देगा, कोई पूछने वाला नहीं है, कोई समझने वाला नहीं है. हम अपने एक्सपेंस रेशो 1 पैसे से आगे पीछे करते हैं, आपको इन्फॉर्म करते हैं. लोग ऑब्वियसली गोल्ड खरीदेंगे, म्यूचुअल फंड क्यों खरीदेंगे? देखने का दर्द होता है. प्रमोद भाई अपने चार्ज करते हैं 15 पैसा, बट 15 का 16 पैसा कर दिया, भाग जाता है. गोल्ड में 40% सामने से देके आता है, तो देखने का दर्द है लोगों को. विच इज वाई वी नीड लेवल प्लेइंग फील्ड. फाइनली फाइनेंशियल प्रोडक्ट बिकते हैं, हेंस इनोवेशन चाहिए. कई बार हमने देखा है कि घर की मुर्गी दाल बराबर हो जाती है. एक समय था बॉम्बे स्टॉक एक्सचेंज, नेशनल स्टॉक एक्सचेंज में खोखा कंपनी का. एक लिस्टेड कंपनी में आप अनलिस्टेड कंपनी मर्ज करो, उसे खोखा कंपनी कहते थे. लोगों को अच्छा नहीं लगा. अब वही चीज स्पेशल पर्पस एक्विजिशन व्हीकल करके आ गई तो लोग उसे मानने लगे हैं. जब मुर्गी मुर्गी थी तो नहीं अच्छी लगी, बट पैकेज करके आ गई तो अच्छी लगी. झोटा फाटक करके हमारे यहाँ पे ऑप्शंस ट्रेडिंग होती थी, वो हमने बंद कर दिया. अब ऑप्शंस फ्यूचर्स करके आ गए तो चलने लगी. ग्रे मार्केट आज कंट्रोल में नहीं है, रेगुलेशन में नहीं है, बट वही चीज वेनिफ इश्यूड मार्केट बनती है तो एक्सेप्टेबल हो जाती है. हाउ डू वी एनकरेज आवर ओन होम ग्रोन इनोवेशन so that more and more people can participate in this journey of investment? एक और चीज जैसे मैंने कही कि फाइनेंशियल इंस्ट्रूमेंट बेचने पड़ते हैं, लोगों को समझ तो बहुत पड़ती है बट लोग करते नहीं हैं. महाभारत आप में से कितने लोगों ने पढ़ी है? शशि भाई, इनको रामायण महाभारत सिखाई है, इसीलिए ये लोग ऐसे हैं. महाभारत में एक सबसे अच्छा प्रसंग है. दुर्योधन के सामने भगवान कृष्ण जाते हैं लड़ाई के, महायुद्ध के आखिरी शुरुआत के पहले, और दुर्योधन को समझाते कि भाई क्यों लड़ रहा है, तेरे ही भाई है, 5 गांव दे दे, वो लड़ाई नहीं लड़ेंगे. दुर्योधन नहीं मानता. भगवान कृष्ण लाख प्रयत्न करते हैं कि युद्ध अटक जाए, संहार नहीं हो, बट दुर्योधन नहीं मानता. और तब दुर्योधन कहता है, जानामि धर्मम नच में प्रवृत्ति, जानामि अधर्मम नच में निवृत्ति. ओ ग्रेट कृष्णा, प्लीज डोंट टेल मी व्हाट इज राइट. आई नो एग्जैक्टली व्हाट इज राइट बट आई कांट फॉलो इट. And don't tell me what is wrong. I know exactly what is wrong, but I can't leave it. कलयुग में तो कृष्ण भगवान थे, सतयुग में तो कृष्ण भगवान थे दुर्योधन को समझाने के लिए. अब कलयुग में आप महाभारत पढ़ते नहीं हो तो कृष्ण भगवान आएंगे नहीं. इसलिए आपको डिस्ट्रीब्यूटर से चलाना पड़ेगा जो आपको समझा सके कि भाई निवेश करना सीख, इन्वेस्टमेंट करना सीख, SIP करना सीख. We need to develop intermediaries who can take knowledge of investment to every pin code of India. Finally, capital flows where there is rule of law. जहां पे rule of law है, वहीं पे investment होता है. I'll just give you one example. आपने स्कैम 92 करके सीरियल देखी होगी. शशि भाई, मैंडेटरी दिखाइए, सबको पता चले क्या हुआ था. आज भी वो केस चालू है. 92 का 2024 हो गया. स्कैम 92 के ऊपर एक था बर्नी मैडॉफ करके, गुरु घंटाल. दुनिया में सबसे बड़ी टोपी उसने पहनाई है, कुछ $64 बिलियन की. उसने पॉन्जी स्कीम के भी ऊपर वाली स्कीम लॉन्च की थी. जाहिर है फाइनली बेड़ा गर्क हो गया. दिस इज नोन टू एवरीवन. सौरभ भाई, देयर इज अ जेंटलमैन कॉल्ड इरविंग पिकार्ड, चार्टर्ड अकाउंटेंट था या लॉयर था. दैट गाय वेंट एंड रिकवर्ड एवरी सिंगल नया पैसा ऑफ बर्नी मैडॉफ स्कैम. He went after Madoff family members and recovered every single possession, including undergarments. He went after every single investor who had received money from Bernie Madoff fund and paid back to all the entitled legal holders. That is rule of law. नहीं कि scam 92 चल ही रहा है, चल ही रहा है, चल ही रहा है. Our judiciary is overburdened. Our regulators are not empowered to settle matters of investment related world. Now, तारीख पे तारीख करेंगे तो लोगों को निवेश के ऊपर उतना कॉन्फिडेंस नहीं रहेगा. बर्नी मैडॉफ जैसे हमारे यहाँ पे भी एक सज्जन थे, निर्मल सिंह भांगू करके, नाम सुना है किसी ने? वो महारथी थे जिन्होंने आज से 20 साल पहले 60,000 करोड़ रुपए का चूना लगाया था. They had a company called पंजाब एग्रोटेक कॉर्पोरेशन लिमिटेड. टिक वुड, साल वुड, लैंड, पता नहीं क्या क्या बेचा था. आज तक वो केस अनरिजॉल्व है और निवेशक को पैसा नहीं मिला. हमें इरविंग पिकार्ड जैसे बंदे भारत में चाहिए। ऐसा नहीं है कि इरविंग पिकार्ड भारत में नहीं है, बट जो इकोसिस्टम होती है जुडिशियल इंफ्रास्ट्रक्चर की, जुडिशियल इकोसिस्टम जो उसे सपोर्ट कर सके, वो हमारे पास नहीं है। और जब तक वो इकोसिस्टम नहीं बनेगी तब तक कैपिटल मार्केट डाइवर्सिफाई नहीं हो पाएगा। This whole topic is so big that it is like 5 blind men trying to identify elephant. Fortunately मेरे बाद जो मेरे दोस्त आ रहे हैं सौरभ भाई, वो learned है, blind नहीं है, तो he'll be able to throw more lights on this topic. Thank you.
थैंक यू नीलेश भाई। विश मेरी नॉलेज ऑफ इंडियन सिनेमा थोड़ी बेहतर होती। बहुत एक्यूट नॉलेज का गैप महसूस हो रहा है। शशि जी, जब वो आप अपडेट करोगे NISM करिकुलम टू ब्रिंग इन द लेटेस्ट मूवीज, कैम्प 92 तो एसेंशियल है ही। प्लीज इन्वाइट मी, आई ऑल्सो वांट टू जॉइन दैट कोर्स। बट ऑन अ सीरियस नोट, टेकिंग I think 3 cues from what Nilesh said. I'll focus on 3 issues because in the interest of time, given that we have only till 1:20, we won't be able to do more. So पहला मुद्दा जो I think Nilesh ने छेड़ा है फाइनेंशियल क्राइम का, आई थिंक ये काफ़ी इम्पोर्टेंट मुद्दा है। Myself, my firm, we were targeted last year, we fought back, we did what we could, but as I'm sure all of you realize, this has become a widespread issue, and the challenge is, हम बोल सकते हैं जामतारा एटसेट्रा। अगर हम जामतारा बोले किसी का 10,000, किसी का 20,000 गया, तब लगता है कि छोटा मुद्दा है, right? But if you, many of you would have seen this, what's happening is many of us who are in the listed market, who are running PMS of mutual funds, we are being impersonated. Large sums of money are being taken in our name, and those guys are then running away, right? And what, if this continues, what this could do is reduce the credibility of listed markets in totality, right? I don't have the data, but whatever I am being subjected to, whatever financial crime we as a SEBI listed entity are being subjected to, is on a large scale, and we are a smaller firm. Larger firms like Kotak, I'm sure, are dealing with a graver problem, but there's a broader issue. Indians want to invest. Indians want to invest. Clearly, this financial system is not giving them enough way to access products that they like, and hence they're turning to crime. I'll give a quick example. I'd gone to Kolkata on a holiday. I was waiting at the baggage carousel, and a lady comes up to me and says, "Thank you, Saurabh, for allowing me into your NYMEX trading group." And I said, "What NYMEX, ma'am? New York Mercantile Exchange. I've never been there. I've never done anything." "Nani, such a good product. You've let me invest 50,000. I'm so grateful that your assistant Kitty let me into your NYMEX trading group." And I realized, I said, "Dikhaiye mere ko." She showed her WhatsApp chat, and I realized that God knows hundreds of people have been scammed in my name and my company's name to join a fictitious trading group on New York Mercantile Exchange. Clearly, they lost their money, right? I don't have the answers to this. I think the regulators sitting in front of me, I think we need a mission mode response to address this, where the power of this little thing in my hand is being monetized by the wrong people, right? So I think that was a appropriate point Nilesh touched upon. 92 scam तो एक बंदे ने किया था, अभी 92 स्कैम करने वाले लोग चारों तरफ फैल गए हैं, उनके पास ये वाली चीज़ बहुत पार दे रही है उनको। I think the other point Nilesh ji raised, right, which I think is super relevant, is retirement planning. So कुछ आंकड़े मेरे दिमाग में घूमते रहते हैं, मैं आपसे शेयर करता हूँ। मेरा अंदाज़ा है आज से 10 साल बाद करीबन 1/3 हमारा देश, 1/3 हमारी पॉपुलेशन 40 के ऊपर होगी, ठीक है? 1/3 पॉपुलेशन 40 के ऊपर। हमारे देश में ना, हम यंग कंट्री है बोलते रहते हैं, बट बिकॉज वी हैव 1.5 बिलियन पीपल, वील हैव 500 मिलियन पीपल, 50 करोड़ आबादी होगी जिसका एज 40 के ऊपर होगा, ठीक है? इफ यू डू सम स्ट्रेट फॉरवर्ड मैथ्स, यू रियलाइज दैट टू रिटायर इन इंडिया, मिडिल क्लास रिटायरमेंट, मतलब 15-20 लाख प्रति वर्ष का खर्चा वाला रिटायरमेंट, यू नीड एट रिटायरमेंट अ कॉर्पस ऑफ रफली 10 करोड़, ठीक है? 15-20 लाख वाली रिटायरमेंट, आपको 10 करोड़ की कॉर्पस चाहिए, ठीक है? We'll have a third of our population approaching retirement a decade hence, and I don't have the confidence to believe that even 10% of them will have 10 crore या उससे ज़्यादा का corpus. So retirement planning is something I think we need to look at very seriously. Why is that? Because as Nilesh ji said, RBI का data आप देखिए, RBI data बोल रहा है कि 95% of Indian households' balance sheet is in physical assets, राइट? उसके ऊपर अगर बैंक एफडी वगैरह ऐड कर दो तो आई थिंक नीलेश भाई वाज सेइंग 97% of assets are potentially giving less than inflation, right? And you're going to have a country where 50 crore log are going to be approaching retirement, right? I think this is where the need for regulators coming together, products coming together is very powerful. So मैं कुछ data लेके आया हूँ इस मुद्दे पे, right? So मैं अलग-अलग products का data लेके आया and I wanted to then highlight what could happen if we could pull all of this together in the same construct. So NPS, right? Shashi ji, you're here. I'm glad you're here. NPS 9 trillion का corpus बन गया है. Rupees 9 trillion, right? Corpus 6 crore subscribers, right? Outstanding success. I am a NPS subscriber myself, right? Mutual fund 70 trillion का 70 trillion AUM, NPS 9 trillion, and finally PMS, the industry I belong to, 10 trillion excluding EPFO, 10 trillion rupees excluding EPFO. अगर आप EPFO ले लें, EPFO is 26 trillion, right? So if you add all of this together, right, it's 1.1 trillion. मैं इंश्योरेंस के प्रोडक्ट्स में नहीं जा रहा, जस्ट ये सारे प्रोडक्ट्स ही 1.1 trillion है. Now, as I'm sure you've figured out where I'm getting at, ये सारे प्रोडक्ट्स के टैक्सेशन रूल्स अलग हैं, राइट? मैच्योरिटी रूल्स अलग हैं. इनको प्रॉपरली समझने के लिए एक इंसान को एटलीस्ट 2-3 महीना तो प्रॉपर पढ़ाई करनी पड़ेगी कि पीएमएस को कैसे टैक्स एफिशिएंसी इस्तेमाल करें, एनपीएस के क्या रूल्स हैं, एंड म्यूचुअल फंड में लेटेस्ट ग्रेटेस्ट रूल्स क्या हैं. सो मेरा जो सुझाव रहेगा इज आई थिंक वी थिंक ऑफ अ रिटायरमेंट रैपर. वी कॉल इट रिटायरमेंट पीएमएस. आई थिंक द रेगुलेटर्स कैन कॉल इट वट एवर दे लाइक, बट आई थिंक रिटायरमेंट रैपर चाहिए जिसके अंदर पीएमएस भी आ जाए, जिसके अंदर म्यूचुअल फंड भी आ जाए, जिसके अंदर एनपीएस भी आ जाए, जिसके अंदर इंश्योरेंस प्रोडक्ट्स भी आ जाए. एंड इनसाइड दैट रिटायरमेंट रैपर we have to let go of taxation, right? Radhika ji ने दिखाया American mutual fund industry का कमाल, right? She showed the mutual fund industry का ramp from 1980 onwards. The reason that industry ramped was because in 1978 USA ने 401 के accounts बनाए, right? USA ने 401 के accounts 1978 में बनाया. उसके बाद ही US की VC industry चली, उसके बाद ही US की mutual fund industry चली. If we want to help our country turn physical wealth into financial wealth, put all of our retirement corpus into one product, I think we need a retirement ka wrapper. I appreciate it will require our regulators in Mumbai to work with North Block, but I'm sure that's a very doable thing. It will also lead to an uplift in the investment advisor profession. I think India has barely 1,500 investment advisors. हमारी 15 करोड़ की आबादी है और हमारे पास 1500 इन्वेस्टमेंट एडवाइजर है. डजंट मेक एनी सेंस टू मी. द कॉम्बिनेशन ऑफ रिटायरमेंट रैपर एंड उसके अंदर म्यूचुअल फंड, उसके अंदर इंश्योरेंस पॉलिसीज, उसके अंदर एक्विटीज, आई थिंक विल बी पोटेंट. नाउ लिंकिंग दिस टू माय थर्ड आइडिया, हमारे देश में एक रियल एस्टेट के प्रति, गोल्ड के प्रति एक बहुत बड़ा एक फॉन्डनेस है, राइट? पार्ट ऑफ इट आई थिंक कल्चरल है. लोगों को फिजिकल चीज़ों में ज़्यादा भरोसा है. लोगों को लगता है स्टॉक दे दिया, म्यूचुअल फंड दे दिया, बॉस ये पता नहीं क्या है, कागज़ के टुकड़े हैं. अब उसको वो भी डीमैट हो गए तो कागज़ के टुकड़े भी नहीं है, ये तो फ़ोन पे एंट्री है एंड फाइनेंशियल क्राइम का ज़माना है. सो आवर कंट्री इज़ इनॉर्मसली फॉन्ड ऑफ फिजिकल एसेट्स, राइट? एंड आई डोंट थिंक वी कैन प्रिटेंड सिटिंग इन BKC दैट वी विल rid Indians of their love for physical assets. But what we can do is turn physical assets into a democratizable asset class. So आपके पास REITs हैं, AIFs हैं, वेंचर कैपिटल है, वेंचर कैपिटल के अंदर AIF Cat 1, Cat 2 हैं. If those could be traded, if we see AIF Cat 1, Cat 2 and Cat 3 चलो खैर वो तो anyway stocks हैं. Cat 1, Cat 2 becomes traded liquid asset class. You're democratizing wealth, right? कोई छोटा निवेशक 10,000 20,000 रुपए देके भी AIF वेंचर कैपिटल AIF खरीद सकता है, and thus he is accessing our pura startup ecosystem, right? We can't on the one hand talk Dhindora Pito about the startup ecosystem and then tell the public that boss ये जो सबसे अच्छी part of the investment universe है startup ecosystem, इस पे आपका तो कोई हक नहीं बनता क्योंकि आपके पास 1 करोड़ रुपए नहीं है, right? If you want to democratize PE, VC and also turn physical wealth into tradable asset classes, मेरे ख्याल से AIF का trading and then all of that inside a retirement wrapper will dramatically improve liquidity in the market and turn the most exciting parts of the investment universe in our country, startups, private equity, real estate, into a democratizable asset class. ये मेरे 3 suggestions थे. I can't in any way critique what Nilesh ji said. I think the examples were brilliant, and जो मुद्दों उन्होंने hit up किया, right? Financial crime, उससे कैसे बचना है, and how to encourage people to have less than 95% of their wealth in asset classes which don't generate a real rate of return. बार काफी low actually. अगर आप वैसे सोचे, since सारी आबादी का 95% wealth is in asset classes that don't generate a real rate of return, बार काफी low है. I'm sure we'll do better in the years to come. But for that, we need to think through how our country saves rather than ये अलग-अलग प्रकार की चीजें. If we can come up with a wrapper, and the wrapper can be regulator agnostic. The wrapper can be regulator agnostic. I'm sure we'll then carry on moving forward on the path to financial freedom. So thank you, Nilesh bhai, and thank you, SEBI, NSE, NISM for BSE for giving us this opportunity. So Q&A करना है तो क्या protocol है?
So now we will have questions from the audience.
Good afternoon. I'm Professor Deepak Parmar, and question of financial crime which you touch upon, Mr. Mukherjee. Biggest problem in a financial crime is the second side, which is a mool account, which are like a jamtar and other things is available, and money which person who rented out this mool account is 30%. So that's something which is RBI need to step in, which being a cyber lawyer, I am tracking it for last decade plus. No activity has been done on that front. Now, with AI and ML, it's very easier to track the mool account and their activity. Account which is not operated for like 3 months odd, suddenly 10 lakhs, 20 lakhs comes and it's going out. Somewhere RBI, I don't know whether SEBI can pass it on. Being an individual, my suggestion will never taken serious tone. There is always protocol in our country, tum kya mujhe sikhaoge. But this is something which is seriously taken because this is anywhere. These are roots, sir. If you are not striking on that root, if crime honge. And other things we are not learning critical thinking. Everybody wants co-pilot to read a long trail of mails. Draft also you want it to co-pilot to develop. Then where will we develop a critical thinking? When will you question the system? When will you question unreasonable returns? Somebody recommending on a WhatsApp, 2%, 20%. Somewhere we need to teach our
Okay, sir. I think that was a fair enough question. So would anyone like to answer this?
Thank you for stopping me. I'm grateful to you.
So, sir. Can we have the next question from the audience, please?
I think let's move forward. By the way, if anybody hasn't read the SEBI order, which is on the NSE and BSE website, pertaining, it's a 180-page order pertaining to the insider trading scam which took place over the last couple of years. I would strongly recommend you read it. I mean, not least because this is the first time I've seen the regulator. A lot of credit, Pramodji. I don't know exactly who's responsible in SEBI, but enormously complex investigation, explained lucidly in 180 pages. And whilst I don't know exactly what technology SEBI used to detect that insider trading scam, it has to be pretty sophisticated technology to track a scam which spans multiple cities, multiple countries, and at least from what I could make out, 15 agents. So, padiyega, financial crime thriller ki tarah hai. And I think if there's a Bollywood person in the audience, I think aapko script mil gayi hai, aapke agle blockbuster ke liye.
Yeah. Saurabh, this is Santosh here. In fact, you touched a really good point about the RA and IA. So India being such a vast country, we have so many demat accounts, but unfortunately we have hardly like 1400 RAs are there, and we have around 900 IAs are there. So maybe something is wrong with our controls on the RA or IA, maybe requirements are too high, or maybe there after we become RA or IA, then a lot of controls are being added there, and because of that, it doesn't make sense to become an IA or RA. That could be the case. So we do have a SEBI members over here. I think SEBI needs to work on that because that is a one area I would say we are miserably failed. And on the second part about the pension plan, I would recommend that because a lot of mutual funds, if you see with the benchmark, they might go in the negative territory. So if you're planning something like a pension plan, we have to make sure that at least we should not go in the negative territory. Otherwise, that will lose a lot of confidence here.
So in RA and IA, look, I mean, I'm sure the regulator is working on this. The specifics of the scheme, I'm sure they will think through. But मेरा only submission था कि और चाहिए इंडिया को RAs and research analysts and investment advisors हमको लाखों में चाहिए 1-2 हज़ार से कुछ होने नहीं वाला and I'm sure we'll see the right regulatory response. I couldn't quite understand the second question.
Second question, you said that we need a pension mutual fund kind of pension kit. Pension plan का kit एक बनाना पड़ेगा. Now mutual fund क्या होता है कि बहुत सारे if you consider the mutual fund performance with respect to their base index, almost 75% are underperform. Okay, sometime it goes.
Please check your data.
Maybe I may be wrong.
Please check your data and I can show you right now.
Yeah, I may be wrong.
On 31st December,
Yeah.
every single scheme of Kotak Mutual Fund on equity side and hybrid side is outperforming benchmark indices.
Absolutely, sir.
So what are you talking about?
Yeah. So I'm saying we should not, if you're going for any pension plan.
See, this is where lack of financial awareness comes.
Yeah. So we have
Headline
to.
पढ़ ली. आप वो लेके घूम रहे हो.
Correct. No, I'm saying.
भैया डेटा देखना एक बार सेबी की वेबसाइट पे मिलता है, कोटक म्यूचुअल फंड की वेबसाइट पे मिलता है, वैल्यू रिसर्च पे मिलता है.
Okay. Perfect. I would say.
ये दुर्योधन को निकालना पड़ेगा.
सर जी मेरा क्वेश्चन यही था कि few mutual fund do go in the negative territory. अगर पेंशन का कोई किट बनाना है, then we have to make sure that मैं कोई पेंशन प्लान में जाता हूँ, after 60 years I shouldn't be shocked that is single point of failure कि मैंने पूरी लाइफ एक पेंशन किट में डाला हुआ था and it goes in the negative territory.
भाई मेरे गवर्नमेंट एम्प्लॉय नहीं है तू कि तेरे को ओल्ड पेंशन स्कीम चाहिए. कंट्री डूब जाएगी उसके पीछे. यूटीआई पूरा डूब गया इन गारंटेड थिंग एंड उसकी कीमत मैंने आपने और हमारे पिताजी ने चुकाई थी. Learn to live with volatility of market. Why are you afraid?
So in that case we are demotivating to go into that plan.
Let's not debate. See, there are certain facts. You have to accept it. Guaranteed return में UTI mutual fund डूब गया. Guaranteed return of old pension scheme. There are states where 49% of their net tax revenue goes only in payment of pension scheme, which was stopped in 2004. उसके बाद तो NPS आ गई. If you all go back to old pension scheme, government will have only money to pay pension. There will be no money to pay salaries.
Okay, sir. Yeah.
So ये guaranteed चीज़ ही निकाल दो दिमाग से. Take risk. You will be compensated for the risk you are taking.
So मेरा एक ही था, as a young generation मैं खुद भी करता हूँ. I am an active trader. Okay. Young generation के सही है. For a senior citizen, it's not a good thing.
बाबू तू पहले अपनी सोच. You be financially secure. दुनिया का बाद में देखेंगे.
Thank you, sir. In fact, जो आपने, thank you, sir. Let's close that.
So thank you, Nilesh sir and Saurabh sir for such a wonderful and insightful session. So now may I request Shri Shashi Kumar, Director SEBI, to felicitate Saurabh, our discussant and speaker for this session. I would like to call upon stage Shri Tirthankar Patnaik to felicitate the guests on behalf of NSE. Can we have the Slido results, please? I would like to call upon the stage Executive Director Sri Shashi Kumar to give prize to our Slido winners. So yeah, the first winner is Supragya from NISM. Supragya, can we have you on stage? Shivam Modi, the first runner-up. Now we have Shivam for second runner-up. A big round of applause for our prize winners, please. Now we will thank you everyone for joining this session. Now we will disperse here for lunch break and we will reassemble at 2 p.m. sharp. Thank you.
5, 6, 7, 8, 9, 10. Hello.
Check, check, test. Hey, hey, mic check. Check.
आ रहा है उधर साउंड?
Check, check, test. Hey, mic check.
Hello everybody, welcome back. I hope you enjoyed your lunch. Our next discussion will explore RegTech and SuperTech, the future of supervision and compliance, a critical topic as technology continues to shape market oversight. Joining us for this session are Shri Shantanu Paul, founder of Talent Sprint, and Shri Nehal Vora, MD and CEO of CDSL. Let's begin with a fun, informative quiz first. Okay, while the quiz slide is being set up, may I request the speakers to come on the stage? Can we have the quiz slides, the Slido quiz? So we have the first question. Okay, we are done. We'll have the leaderboard now in some time. Congratulations, Sachin, Gaurav and Paras. You have won the quiz. Please reach the stage during the Q&A. Thank you so much. And sir, we can have the presentations. Can I get my presentation? Yes. Can we have sir's presentation? So this is the slide changer. You can just skip. Next.
Not yet. Not yet. Starting early, so we have a few minutes. They're loading now.
Okay. It's not
All right. I think it is working. It's not working. Ah, there we go. Perfect. Thank you. Good afternoon. So post-lunch, the challenge becomes harder for all of us to stay awake, right? But I'm sure we'll try to do our best to make that happen. My name is Shantanu Paul. As mentioned, I'm the founder of a company called Talent Sprint. Those of you who study, upskilling in deep tech, you might want to take a look at the company and its website. I'm also a member of the SEBI Committee for Financial and Regulatory Technologies, and that's one reason I'm here, along with Nehal. And also, 20 years ago, I had this very interesting privilege of being the CTO of a startup in the US called Open Pages, when the Sarbanes-Oxley Act came into existence. Many of you may not be old enough to know what Enron scandal was, but many of you might be. How many of you remember the Enron scandal? Oh, that's pretty good, almost 40%. That's more than I expected. All right, so the Enron scandal rocked the US quite significantly, and after that there was a series of legislations in the US Congress, and one of them was called the Sarbanes-Oxley Act. And we at OpenPages built the first solution for how companies can comply with the financial reporting requirements of Sarbanes-Oxley Act. So I have a bit of a practitioner's experience of this problem as well. So what I'm going to do as the format for these sessions, I'm going to start off with a 15-20 minute quick introduction to where RegTech and SupTech is going, but most importantly, the subtext is important. What is the future of this field in terms of compliance and supervision? That's the question that we are trying to answer. Yeah? And after I finish, I'll go back to the chair and we'll have Nehal give his thoughts, because he's got a tremendous amount of wealth of knowledge. Being a former chief regulatory officer, I'm sure RegTech is something he sleeps and breathes every day and used to, and of course now in CDSL. So he will give his thoughts and then we will have a discussion followed by questions. So let me get started. The outline I'll follow is just a quick few snapshots of the global compliance landscape, then some RegTech and SupTech use cases. Interestingly, even though RegTech is called RegTech, supervision tech is called SupTech and not SupTech. There's a mystery to me as to how that happened, but that is how it is. And we'll have some use cases. The third piece is where I want to talk about what I think is the future of this field, and that might appear to be a little bit pushing the limits of our current expectations and thinking, so bear with me, and if you disagree with us, you can challenge us during the questions. And we'll end with the classic challenge of all time, how to balance innovation with regulation. So worldwide, I think it's fair to say that regulatory systems are causing a lot of frustration across the board. I'm sitting in front of a regulator and saying this, but I think that's a well-known fact. Regulators and regulated entities are both plagued by friction, inefficiencies, and often a situation of low trust. Regulations tend to be very complex in nature. They tend to be a lot of regulations for good reason, and they keep evolving rapidly for good reason because the markets are innovating at a rapid pace. The regulated entities are also innovating with technology at a rapid pace, and therefore regulating them becomes a challenge. So therefore regulations change a lot. There's an issue of jurisdiction and geography, different for different regulators, different kinds of products, different kinds of markets, etc. Very often regulated entities will say that the regulations are too subjective, hard to understand, can't follow it, hard to comply. One side of the regulation says something, there are mutual ambiguities between regulations on the same entity on the same topic. And the most important part, those of you who are students of economics or game theory will know this, that there's something called the zero-sum game, in which the assumption is that if one side has to win, the other side might lose. How many of you students here know what a zero-sum game is? Anybody wants to give a definition? Okay, I'll give one because we have Q&A later. If I have a single cake and I want to divide between me and Nehal, if I cut the cake at 51% for me, he's going to get 49%, right? So it's a zero-sum game in the sense that the more I grab, the less is left for him. In other words, the total is not going to change. Whoever grabs more will get more. And that's a zero-sum game because totally when you add it all, it's back to zero. Nobody gains without somebody else losing. We will, as we go through this presentation, I hope to show in the end that this is not supposed to be like this. It's supposed to be a non-zero-sum game, which means that everybody should be able to win, both the regulator and the regulated entity. Now the point is that there's a need for scaling up these technologies very quickly. RegTech, as defined, is technology used by regulated entities to comply with the laws of the land and the regulators' regulations. And SupTech is technology used by the regulator to supervise the regulated entities and listen to what is happening in the market and understand it, right? So both of these are two sides of the same coin, RegTech and SupTech, and today they are not in harmony, and that's why we have a lot of friction and unhappiness. So moving forward, it's important to understand, of course, that RegTech and SupTech are technology companies trying to help with solving regulatory problems and compliance issues and supervision issues. One of the interesting facts is that regulatory systems are often perceived as a damper. So if you want the economy to grow quickly and a lot of startups to come to the market, raise capital quickly, one of the concerns that most technology companies have, fintechs and startups, especially fintechs in this case, because we are talking about SEBI and NSE, the Indian capital markets regulator. In this case, it is true that if you ask startup entrepreneurs around the world, their biggest concern about emerging markets is that the regulatory environment is uncertain. These are actual data taken from the PwC report, which came out, I think, just now on capital markets. So if you look at the first, third, and fourth, they all refer to the idea that regulated entities are afraid of the regulatory climate and the environment, which kind of makes them hesitate to come into capital markets to raise funds, which is not a good thing from a regulator's perspective either. So that's good to know that there is again the zero-sum game, the fear of the other side. So let's talk about a few case studies. Where do they come into play? Just to give everybody warmed up. So I'll take an example of a few startups, right? Many of you here who might want to someday become entrepreneurs, I can tell you with full confidence that RegTech and SupTech are very fertile fields for becoming entrepreneurs. There's a different question around, how do you get quick traction? But in terms of innovation in RegTech, SupTech, a lot is happening and a lot is going to happen. So keep that in mind when you choose any entrepreneurial plans of your own in the future. So here's an example of a company called compliance.ai. The problem it is solving is very simple. Essentially, many times, regulated companies are being fined or they're tripping up because the regulation has changed and they don't know regulation has changed. Therefore, their compliance is behind the curve, and that someday they get pulled up and the regulator says you have to pay a fine because you're in violation. So regulated entities don't want to be in violation, but that is just too hard to solve through human intervention, right? I mean, take an example. Take an analogy. Cybersecurity as an example. If you're being attacked by algorithms, you can't defend with humans. You defend also with algorithms, right? So the same thing here is that if you are getting regulations coming in, then after a point you can't keep building lots and lots of people-based compliance departments. You have to use RegTech. So one example here of that is that regulations change. Can a startup like Compliance.ai help a fintech or a regulated entity to comply better and comply in real time? So you have the assurance that you're not in violation at any time. So this is technology-based compliance of changing rules and regulations and the laws of the land. That's an example. Another example is Digio, which is an Indian startup. Digio solves the problem of saying that if you have an AIF, and AIFs have problem with KYC and onboarding, and you want a flawless experience for the regulatory purposes, also for the purpose of giving a good experience to the investor, then can you automate as much as possible the task of getting the KYC done and make the entire onboarding workflow seamless? So this company is providing technology solutions for all the fintechs which are running AI, or the companies which are running AIFs, and similarly other funds or any product for that matter where KYC and onboarding is important. Signature, getting the documentation done, getting the signatures done, onboarding workflows, all that. Can a specialized company do that? So the idea of RegTech is specialized entities helping solving specific problems in compliance and helping entities comply better with their regulations. This is a third example from Singapore, Monetary Authority of Singapore. Very different example, right? Here we're talking about data. Now we all know that there's a problem of greenwashing, right? Greenwashing basically says that companies are reporting sustainability, green, environmental, ESG data, which may not be entirely accurate. There might be issues. So can you create a trusted database of ESG reporting? That's what the MAS has done in Singapore, is to create an open system where is a portal where everybody is supposed to expected to update their ESG data. That is then made sure that this data is of high quality, and the whole ecosystem benefits because investors and others have trust and faith that the data being reported on ESG is accurate data and not being embellished or modified or doctored. So this is a perfect example of an ecosystem benefit using RegTech/SupTech. The fourth and final example I'll give is a company called Regnology, which is building systems, which is trying to see that the RegTech and SupTech are two sides of the same coin. Can we bring them on a single set of data models, and can we then have common workflows integrate between the regulator and the regulated to save the humans in the loop doing lots of busy work? In other words, can we integrate the workflows of both sides so that end of the day the supervision workflows and the reporting workflows can properly hand over and harmonize with each other, right? So in other words, can we make this a collaborative process rather than a contentious process? Okay, so those are some examples I gave you. I'll quickly move to what I think are the emerging themes. So I think if you take all the examples of RegTech, SupTech, you will start to think quickly, and I have the advantage of not being a financial services person, but I've looked at the world from the perspective of technology, right? So if you look at it from a technology side, what can we do in the future, or what will happen in the future to make this problem much simpler to solve? The RegTech and SupTech will become easier to solve. This is what I think is my main slide, which is to say that the future of compliance and SupTech, in my view, contain 4 C's. What are those 4 C's? First, it can no longer be a human problem. It has to be a computational problem. In other words, you have to be able to say that a regulation is a computation. I'll come to that in a minute. The second, data models have to be shared between all entities. It can't be that everybody is doing their own data models. Number 3, cyborgs. You know what a cyborg is? A human enhanced by technology is called a cyborg, right? You must have seen all the movies in which humans who are augmented by technology are performing amazing feats. That's a cyborg, and I'll give more examples of that. And the fourth C is collaborative interaction between entities, and we'll give examples of that. So let's look at these 4 C's one by one quickly. Number 1, the next paradigm for regulation and supervision in our view is that we are going to go from level 1. Today regulations are human readable, it's a document, it's a PDF. It's no longer going to be sustainable in the future to have human readable documents as regulation. They have to become machine readable. First with metadata, that's level 2. And eventually it has to become a piece of code. It has to be a program that can be executed. Let me give you an example. There was a time when we thought contracts are purely documents, PDFs. But we know with the arrival of blockchain, we can have smart contracts, where contracts are a piece of code that execute when certain conditions are met, right? So the idea that eventually we will see that bit by bit, these regulations have to become technology, they have to become code, and the future is going from human readable documents today to machine executable documents, regulation as code, as programs. So this is a bit of a strong claim, but I think if you do the literature search, you'll start to realize that this is what people are thinking. You cannot have a situation where humans are writing, publishing, other humans are reading and interpreting, and then talking to systems. The second big thing is cyborgs. Now, let me give an example of cyborgs. Do we have cyborgs today in our society? The answer is yes. Example being, have you heard of people who do surgeons who do robotic surgery? Right? A robotic surgeon, human surgeon who's using a robotic surgery platform, extending their arms with all this technology and their eyes with all this magnification, is essentially a cyborg. It's a human expert augmented by technology to do a much better job than they can do otherwise in terms of accuracy, efficiency, and outcomes. So if you look at the bottom left of this chart, today much of what is happening is humans are brain and brawn in the field of RegTech and SupTech. Machines are playing a small role. Increasingly, they're going to play a role in the middle. Humans will provide the brain, machines will do the heavy lifting. And then eventually, we will have a situation where the machines are doing, the computers are doing a lot of the heavy lifting of SupTech and RegTech, and human experts are oversight capacity. I'll give you one more example of a cyborg. So I was flying once, sort of a few years ago, and sitting next to me was a person who was a pilot, a commander of a 777, right? It was an Emirates Airlines, so the person was going on a holiday, he was a pilot. And I was chatting with him about how much of the flying today, modern flying, the pilot is doing as human flying and how much is machine flying. And he told me that 97% of the flight time of a long distance flight from Dubai to New York, 97% must be flown by the machine. And just in case that 97% becomes 96% or 95% and the human is flying more, their bonus is going to be deducted. So in other words, pilots are incentivized to let the machine fly as much as possible. Guess why? Because machines do a better job of fuel optimization, and fuel is expensive. Humans flying make it harder to kind of save fuel in the right way, in the most optimal way, unless the machines are flying more. So the point I'm making is, much of what we think of today's expertise is already in cyborg mode. The commander of a 777 or an Airbus 380, 350 is essentially a cyborg, a human being overseeing complex set of machines which are hardware and software and algorithms. So in that sense, I think the future of RegTech and SupTech, maybe the chief regulatory officer becomes that cyborg, right? You're surrounded by this technology that gives you that enhanced power. Okay. Third C, common data models. It's not possible to say that everybody will have their own vocabulary, dictionaries, data dictionaries, own taxonomy, own classification system, own labels, own data models. It has to all come together eventually with industry-wide common data models that can be shared. So if regulators are basically publishing regulation through SupTech that is being complied with by RegTech, through RegTech technology layer, the regulated entities, the REs are being affected and they're actually complying, the reporting back and the supervision goes back. This common data model will really lower the cost and increase efficiency of RegTech and SupTech compliance and also make it a much more harmonious relationship. The last bit was the last and the fourth C was collaboration. If you look at collaboration, constructive coordination is the order of the day because we know that there are many different jurisdictional issues. especially among regulators. So for example, in the UK, we have Digital Regulation Cooperation Forum, where all regulators across financial markets and non-financial markets sit together to look at digital implications of regulation. In India, we have the financial FSDC, which is not digital focused, but takes into account all the financial regulators under one forum. Similarly, Europe has ESMA, which is all the European Union, the SEC equivalents or SEBI equivalents come together to coordinate their activity. Again, it's cooperation, collaboration between regulators. And finally, we of course, we have ISCO, which everybody knows about here. ISCO is the International Organization of Securities Commissions, like SEBI and SEC and so forth. So the point here is that, we see a lot of projects that are happening already around the world where we are trying to see that all of these regulators are coming together to create a common view so that the jurisdiction becomes more sort of harmonious and more seamless, and they can actually exchange best practices and also improve the frameworks through which subtech and regtech can happen in the future. So my last point that I started with is that the zero-sum game mindset is a problem. We need a non-zero-sum game mindset. Regulations will become code. It's a matter of time, because that's the way we'll get efficiency. We'll get common data models. We will end up with cyborgs-based approach that humans alone cannot do this. It has to be done humans augmented by technology, algorithms, machines, AI. Of course, a lot of that. There's also going to be a world in which we will see things like atomic compliance. Every transaction will become, in some sense, will have to be tested for compliance at the time of the transaction. It is not like I build a bunch of transactions, later on I make sure compliance happens. The transaction, in the transaction flow, we'll have to have atomic, or in other words, instantaneous compliance. And the supervision will get embedded in the systems of the entire flow of transactions, which is another way of saying that supervision will have to become programmatic or automated. So with that, I will stop, and hopefully that was useful, and we'll move back to this discussion session. Thank you. You can take it up. Your comments, please.
So I think, Sandhanu, you've really covered a lot in your brief but very comprehensive presentation. I'll have a slightly different take on some of the aspects. I do agree on some of them, but some of them need to be contextualized with what is the real world. So, this question used to often get asked to me when I was in the area of regulation and compliance. Why should I comply? Why should I be regulated? What is it in? Is it for the business to comply? And my answer used to be just one word. That is this 5-letter word on which especially financial markets is based on, and that's trust. So what compliance and regulation do is creating trust. Now to contextualize this further, I'm sure we are in India, so the game of cricket is something which we all love. As a raise of hands, how many of you love cricket? So my favorite analogy to this would be that when we play cricket in the building, the batting team's non-batting player becomes the umpire, and the audience is just the two teams which is playing. When you go into club cricket, you have professional umpires, but kind of not doing it as a full-time job, and the audience are a few tens. You go into a national match, you have professional umpires who are only doing umpiring as their job, and the audience grows because the trust grows. You go into international cricket, you have neutral umpires out there, and the trust grows even further so that there's no conflict of interest. Add to that, we have technology coming into the area of umpiring, where you have a third umpire who is not sitting on the ground, so he's not privy to the emotions and the real world or the real life, but is sitting like a few tens of meters away from the action, but has a overall say over the on-field umpires also, who has the ability to refer it to the third umpire. And that gives a very important perspective that for the neutrality of umpiring, it's important to sometimes stay away from the main action, to not be biased by the emotions which are there. Add to that, the third umpire is now privy to some kind of technology to kind of replay the entire ball or the shot in slow motion to understand. So it is for the human, the technology is really used to basically slow down so that the trust can grow. And finally, we have technology completely taking over, where the DRS is completely technology driven and it's over and above the humans. What has all this done is that it has increased the viewership, it has increased the ability to demonstrate that there is fairness, there is transparency, and there are video cameras which are looking at it, and it is getting kind of shown to the whole world immediately. Similar world is what regulators are, because not only are their actions being constantly being judged, but they have to uphold that trust or the fiduciary of markets of trust that it continues to grow. They have to ensure that their ability to withhold or uphold the ultimate ideals of trust is based on the highest levels of technology. It's not biased by the conflicts which they have, or they may not be biased by the past which has happened. And therefore, the role of the regulator becomes all the more tough. The regulated entities, it's like the team which is going to bat, is always going to feel that the umpires are unfair, the third umpire is unfair, the DRS is unfair, and that is because of the very nature of the beast, that the conflict which emerges in that. So how do you kind of come to a position where now in the area of X and all other social media platforms, you're being constantly judged that whether that trust is getting upheld or not? And the answer to that is what I really agree with you, is that we need the system of RegTech and SupTech. Now I like to divide this into two parts, is that it's part of the value chain. RegTech at its lowest part of the value chain is complying with the circular. So how can I convert a circular issued by SEBI or exchanges or any of the market infrastructure institutions into a workflow-based solution so that it embeds into my system so that compliance becomes very seamless? The second part of the value chain is that how do I ensure, this is ensuring the letter of the circular or the letter of that regulation, but how do I embed the spirit of that regulation? And that's where the human in the loop comes into play, because when you want to comply, and finally everything translates into building trust. I think if we are all on the same page that the currency of regulation is building trust, then we are all on the same page that whatever we are doing is not a cost, because as we start building trust, the business is also going to grow. And that we saw in the first session, that in terms of the growth which really India is witnessing, etc. So there is a larger obligation and responsibility on all the parts of the ecosystem, that this trust which the system is trying to put onto us is upheld at its very ideal. In terms of, therefore, letter and spirit has to go hand in hand. And hence, from a RegTech value chain standpoint, it's not only about technology being able to convert it into workflow, but whether the true spirit of upholding trust, which that regulation would like to uphold, is getting upheld by that workflow, is something what the human will have to do. So I think that's where I would put on the RegTech. On the SupTech, there are two parts. SupTech is not only for the regulator, in my opinion, it's also for the management, the senior management, the CEO and the board, to ensure that its own firm or company is complying with what is required to be complied. Because otherwise there is a human trust element that my compliance officer is going to comply with everything which is required to be done. There needs to be an inbuilt accountability also set that what it is supposed to do is being done in a systematic manner. And that has to kind of flow into really the regulator being able to really focus from an enforcement standpoint on few of the large examples which need to be made an example of. You cannot go after every non-compliance, but create a large non-compliance, make it an example so that you create a watertight case and it is upheld by the court of law, is what, in my opinion, is going to be a far more impactful communication on how trust is going to be upheld. The final piece which I would like to end with, and before we can start with our dialogue, is that we also need to be aware that as the regulatory systems are embracing a lot of technology, AI, Gen AI, quantum computing in the next 2 or 3 years, the other side is also doing the same. So we need to be aware that there are systems which are built to defeat the purpose of AI and Gen AI, which the regulators are using. So the RegTech and SupTech which is being built, there are systems which are being built to really ensure that you remain below the radar, you don't get caught. And therefore, the constant human intervention to see that there are no unknown unknowns as part of the RegTech and SupTech solution needs to be there.
Thank you so much, Nehal. You can hear me, right, at the back? Okay, wonderful. I think you brought up some fantastic examples. I think the cricketing example of umpires can be stretched to the next limit. And I was thinking aloud before we start the conversation that in the eventual limit of this, we don't need a human umpire at all, because technically you should be able to run a game with pure automated umpires with a human oversight. Perhaps the physical human umpire goes back into the stadium in the stands and the technology runs the whole game, and I think there might be enough trust. Anyway, that's a different discussion for a different day. Speaking of RegTech, one of the challenges of RegTech is that, it's an emerging field. Companies are still kind of cutting their teeth. A lot of DIY, people have done their own solutions. Do you think the RegTech field is emerging where it will ultimately be seen as a product, set of products, a set of solutions, or will RegTech as a service find currency?
So I think it's an excellent point, and way I see it, I know a lot of regulators have mandated that compliance cannot be outsourced. The ultimate responsibility of compliance to regulation remains with the core firm. So people should not use regulation as a service and they're saying that is not my lookout, it's his or her lookout, and if they goof up, you go after them. Though that is what regulators are not going to accept, and it is basically rightfully so, because if you are playing the game, you are supposed to be responsible in upholding the rules. But having said that, there are a lot of products which are coming in. I keep on reminding myself the co-pilot model of Microsoft, where it runs as an AI or a Gen AI tool on your own servers or your own data. So there are two parts on the product side, that some products kind of require data to flow into their servers and they give you reports which you can consume, which from the DPDP Act, also from the regulatory restriction that data cannot flow out of the national boundaries, etc., will be restricted. So the co-pilot part of RegTech is, I think, going to be more immediate success. A, because it doesn't require the accountability to be outsourced. It remains with the core firm. But it brings in the sophistication that at least the letter of the law is getting complied in in its completeness. And the spirit of the law is something which will need to get reviewed by the compliance officials or the regulatory officials to ensure that what really requires to be complied with is being complied or not. There could be some false positives. I have dealt with a lot of AI and RegTech systems, huge amount of false positives. So you need to even tutor the system in sometimes ignoring or sometimes including things which otherwise would not be done. Therefore, I think RegTech as a product and solution is a more evolved concept in today's context. As a service, unless it is specifically regulated in a very, very focused manner with the responsibilities clearly set out, I don't see that coming very easily.
Okay, very clear. So you're saying that RegTech as a product and solution, its time has come. RegTech as a service, it can come only if the RegTech as service or RaaS players themselves become regulated entities, right? Okay, wonderful. I want to also ask the question about standardization. One of the key themes that's emerging worldwide around RegTech, SupTech is that unless we have common data models, we can't integrate workflows across organizations, and this is going to be a huge element of discord and friction, and dissonance rather, between entities. So do you think, I mean, it seems intuitive that if a data model has to come, it has to come from a collaboration between regulators, right? Or it can't come from the techs, it can't come from the regulated entities for sure. What is your sense of the worldwide appetite for regulators to start building common data models so that the RegTech and SupTech becomes easier to solve over time?
So here I think SEBI should be given real kudos for. We have a market data advisory committee, really Prabhas is here, so he's one of the senior officials who runs that. And SEBI embarked upon itself, obviously led by the vision of the SEBI chair, that data needs to be standardized amongst the intermediaries. So today between brokers, depository participants, major part of the secondary market intermediaries, data has been standardized across exchanges, depositories, clearing corporations. Now, I see that as the first piece, that it will help RegTech also for these firms, it will help SupTech for the MIIs and the regulator, but more importantly, allowing products to evolve, because then that is where the first piece is there. However, on the larger question, the international mode, I know in OECD has been trying on the company side, on the disclosure side, that can there be a standard taxonomy across. And whilst they have prescribed some part of standardized taxonomy, but each jurisdiction, it's kind of a standard which is just prescribed. It is not mandated. And that kind of brings in differences because each regulator within its own jurisdiction for its own reasons may want to deviate from that. And once you have any one jurisdiction deviating from that, you cannot create a standardized format. So what is the evolved way of looking at it? It's more of by the output. Can you standardize output rather than standardize the input and the work in progress? So if you can standardize output, how you get that output is your problem. But if the output is more or less basically standardized, then there can be basically the analytics, etc., which can be based on the output. So how you cook your food is your problem. The taste should be kind of within a similar range. I think that's how it's getting evolved.
Very interesting. So I also wanted to ask you one question because you have mentioned this to me in passing that in the past that you know this difference between omnibus-based and segregation-based accounts in the Western jurisdictions, Indian jurisdiction. What is your take on how RegTech and SupTech is affected by these different approaches to accounting? Yeah.
So I think India is one of the few large jurisdictions which is a segregated account structure right from the pre-order level to the post-trade and even at the holding of securities level. The West, everything is basically an omnibus structure. So really the assets of Jack can be used by June, and by June can be used by Jill, and without Jack, June, or Jill knowing that they are really their assets are being used. And therefore, RegTech will have to have a human in place to rely on the intermediary to give to the regulator that it is performing the role of regulation and compliance in letter and spirit, which is conflicted in my opinion. Here the source of truth lies in the data itself, and therefore data flows in its original source right from the intermediaries to the market infrastructure institutions and also to SEBI. So the surveillance, for example, can be done right up to the last beneficial owner's level without anybody knowing. Now the inherent nature of this beast makes the RegTech and SupTech different. When it's an omnibus structure, you need a RegTech to segregate within that omnibus structure what is belonging to a beneficial owner versus what is belonging to the intermediary. Whilst in a jurisdiction like India, where inherently the data are being segregated, the RegTech, SupTech can be more intrusive and can be faster in turnaround because you already know who the beneficial owner is. So these are the paradigm shifts which will be required within both these models. And I think, I know in Europe, they have embarked upon a journey as part of their MiFID II that we need to move into a segregated account structure, but they've not been able to yet do it completely. US also, I know, had embarked upon this journey about 5 or 7 years ago, but they've yet not completely succeeded. So I think it is a prerequisite, not only from a integrity point of view, but even from prevention of money laundering point of view, that it's important that to have the segregated account structure to build a more robust, trustworthy RegTech system.
So in a way, our history is coming to our advantage in this case. Okay. My last question before we open for the audience. Regulatory sandboxes have been around for a long time. What is your assessment of the future of this whole model?
So as I said earlier, that products and solutions will be the first will take a first go on the RegTech and SupTech piece. So regulatory sandboxes can be used where real life data, which is obviously masked, can be used to create more real life products which can hold the test of times in a lab-like scenario. And I think SEBI has also done, both SEBI as well as the RBI has done that they have created these models where basically fintechs and basically startups can come up and have been using some of this data of the real life which have been masked to really create that products. But as a service is something which, if it's lower down in the value chain, and at some point if the regulators get comfortable that some part, the lower part of the value chain of compliance can be outsourced without the accountability being outsourced, then that is something which could have a potential. But I see that more in the midterm. In the immediate term, it's I think the products followed by a solution which could really take off.
Thank you so much. Can we open up for questions now? Is that a good time? Yes, thank you.
Hello.
There's some hands going up. We can give the mic around. Yeah, it's coming to you. There it is.
Hello. First of all, thanks to organizers for including a session on compliance. I think, as you appreciate, trust is the foundation for any securities market. So thanks a lot, and thanks, Mr. Paul, for the presentation.
Just can you hold on? Yeah.
Hello. Thanks for the presentation. I think it gives a lot of ideas to me for compliance. So my question is that you would appreciate that the regulations are never crystal clear. There are always scope for interpretation. And does that require human intervention? How do you see role of RegTech in uniform interpretation?
I'm sorry, I could not hear
my
last part of your question.
So my question is, you would appreciate that the regulations are never crystal clear. There is always scope of interpretation. And it requires human intervention. So how do you see RegTech can support uniform interpretations?
So if you see, at least in the securities market, SEBI really has been on a consultative process, and there's a consultation paper before the regulations come out. SEBI even puts out the board notes to contextualize that what is the intent behind creating a regulation. After the regulation has come out, there are circulars issued, which gives more clarity, and there are FAQs which are kind of put in. So these are the world of information which gets kind of created to kind of make it more focused for RegTech solutions to take place, because there are some firms in the market which have embarked upon this journey of converting SEBI circulars, etc., into workflows which help firms to kind of comply. I think SEBI also is generally very, very open in terms of the informal guidance, a lot of people, and that's put out on the website, so everybody can gain really, you know, from somebody else's question. The intent is that I think if you follow really the 80-20 rule, 90% of the regulations are fairly clear. You may have some 10% nuances which will get kind of factored in as you gain experience. And also SEBI has been very mindful of reviewing its own rules on at least a 2 or 3 years basis, so that it can bring in the necessary clarification, clarity, if at all required. So to answer your question head on, I think you have the requisite material to at least comply on a 85 to 90% basis. The 10% tail is always something which the human will have to be there.
I'll just add one tiny rejoinder to that. You know, the computer science answer would be that ambiguity is natural in human language. If it's a document, human readable, it's going to have some degree of room for ambiguity. It has to become structured document, has to become ultimately programs, and then it will work.
One of the challenge as a market intermediary which we are facing is obviously the interpretation which we are talking about. As a research analyst or as an investment advisor, so whenever there is a regulation which is coming up, so we are uncertain about okay, what has to be the spirit of the law, what has to be the letter of the law. So if any GST portal kind of common platform is there, so that all the regulated entities are, whether it is a RBI regulated or whether it is a SEBI regulated, with a common KYC kind of structure, so that will help the industry to grow. And at the same time, if these sort of platforms are available for the compliance officers of the organization, so it will help us the industry to grow at a large level. And we are, as an individual, we don't feel that okay, we are overburdened on the compliance part. So any lights on that? And at the same time, we need some sort of training on following the compliances, because being a regulated entity, we want to follow all the rules and regulations which are there, and we don't want to bypass that. So at the same time, if some sort of regulatory trainings are given to the compliance officers, especially on the regulatory technologies, not just on the regulation, on how to use these sort of technologies, or connecting to the sandboxes technologies which are already building these sort of platforms, will help the industry to grow at a faster pace.
So my answer to that is that, see, the regulator and the MII ecosystem conduct a lot of training programs on training on what the intent of the law is, and there are a lot of compliance related trainings. Now how you're complying, whether you're doing it manually, you're doing it through a product solution, is your business model. Training on the product is what the vendor can give you, because I don't think it would be fair to expect the regulator or MIIs to train you on products. What they can train you is on what is the likely outcome or the intent behind that regulation. You means any of really the intermediaries can actually come together and create a forum. I know when I used to work in the market as earlier part of my life, we used to have a compliance officers forum where competition would not take place. It would be kind of engaging with each other, because we are trying to figure out what the nature of the beast is and where the pitfalls could be, and then coming to a solution that this is how it should be complied with. I think that kind of, since you talked about really the RIAs, which is a new intermediary which is coming in, and the large numbers, it may make sense for some of the large RIAs, at least on the compliance side, to come together and create a forum where at least most of the questions get answered. And what cannot be answered, I'm sure SEBI is very open as a regulator. If you write to them, they'll definitely answer what the intent is.
Sir, this is
Our time is up, so we'll make this the last question. Yeah.
Yeah.
Thank you.
Sir, this is Santosh here. This is not regarding the compliance, but more of the reporting part for the end user. So as a retail trader, we are there. A lot of brokers, they give the reports in different formats. So can we work on some kind of standardization from the SEBI so that all the brokers give the tax reports, a contract note in the same format rather than having their own specific formats?
See, where the brokers are concerned, I think the reports have been standardized to a very, very large extent. I think about 85 to 90% is now standardized. Be it your audit reports, be it your internal audit reports, system audits, cyber audit, VAPT audits, all this I know is being standardized. It's electronically fileable with with I think all the MIIs. So that kind of brings in a lot of sophistication at your end. But that has to be coupled with your back office also being able to support that kind of sophistication. So it's like saying the road is built where Mercedes S-Class and Rolls-Royce can be driven on. But you need to have that kind of a system which is equivalent to a Mercedes S-Class and Rolls-Royce. The point is that the regulator has created a road wherein you can really ensure that all of this can move into an automated form. But now is the part on each of the intermediaries part based on the scale where they will need to really basically automate to ensure that it becomes seamless.
Thank you, appreciate.
I have some good news here. We have been given more time to take questions. So if there are more questions, we can take them now. Yes, please.
So adding to the previous question, so as a new breed...
If you don't mind, let's just let other people ask, if that's okay. Yeah.
No problem.
You can ask him, have an offline with him.
Huh.
Yeah, thank you.
Hello sir, my name is Shubham. Actually, is there enough data, open source data or regulatory data, enough to build the in-house models for creating the RegTech or SupTech platform?
I'm sorry, I couldn't hear the question. Did you hear it?
Yeah, so you're saying that there is enough data for intermediaries to create RegTech and SupTech on an in-house basis. That's what is the question,
yes,
right?
Yes.
No, that is not true. There are products which are also really available in the market. You will need to look at these vendors. So they are both the models. When you have a large intermediary, you would like to do it yourself. You have a large team to do it. But there are also products off the shelf where you can customize it to your requirements. So it's like buying basically a software. When you buy a new laptop, the Microsoft Office comes with it as a product, but you can customize it as per your requirements. Similarly, on the compliance front, there are some products which are there. And obviously, they are also going through their level of evolution. If the demand is there on a collective basis, and I keep on saying this to a lot of intermediaries, it makes a lot of sense that you are kind of collaborate on the business side sometimes when you want to position a need to SEBI or the MIIs. But why can't you collaborate from a compliance standpoint where you can push the vendor into bringing in a higher level of automation in some of these products? Because if there's collective demand, the vendor will surely want to change.
So what will the impact of DPDP Act on RegTech and SupTech?
Sorry?
Impact of DPDP Act.
Yeah, so the DPDP Act has been in existence. Rules, the draft rules have just come out. Obviously, they will be formalized after public consultation. So that's what my point was, that regulation as a service will be some time away because that requires the data to flow out into somebody else's office or jurisdiction. And if there is a leakage there from there, then the primary source is held responsible. So therefore, RegTech solutions will come as a product which has to be embedded within the systems and the firewalls of your own intermediary, so that the protection which is required to be given from a DPDP point of view is also ensured, but the sophistication is also ensured. It's a kind of a win-win solution. As this matures over a period of time, there'll be some part which probably could be outsourced, and that's where regulation as a service to some extent can be outsourced.
It's a long way to go. 2 years it will take minimum to get implemented.
I'm sorry, could you speak loud?
DPDP Act will take around 2 years to get implemented or get in. This is like.
See, I don't know in today's times how long will it take. It could take a very short period of time also. It depends on how the entire process really evolves. The rules I know are going to take some time to take really effect on. But at the same time, the spirit which the Act lays down is something which the intermediaries and the ecosystem should start imbibing anyways. Because even if it's after 3 years from now or 2 years from now, if you start building from now, you will have the benefit of making something going wrong and yet not being penalized, in ensuring that when it really becomes the rule, it is kind of seamless. So I think it is the need of the hour, but more importantly, if you translate it, it's finally building trust. So your customer's data, if it's protected, and if from an optics point of view, he or she knows that your data is safe with you, your business is also going to grow.
Thank you, sir. But we like a Dhoni style, our compliance done in the last over only.
Okay. Any other questions? There, over there, yeah.
Most of the companies, they are.
You will need to speak up.
Most of the companies are at different stages of their maturity, right? So do you have any industry benchmarks that what percentage of your top line or bottom line could be ascribed to compliance department, so that these different entities which are there at different stages of the maturity curve, you kind of, they are able to do it in the best way that they can do it?
Take that.
I'll start off, but you can join. So I think your question is that, are there maturity model that is available, data available to show what kind of companies are in what stage of the life cycle? That's your question of maturity?
And
what is what percentage of the top line is going into compliance? That's your question.
yeah, what is the ideal and what is, whether they're underdoing it or overdoing
Okay,
it?
I'll give. I don't have the data. I'm sure that's something. It'll be a good research report to have. My sense is that, you know, the general perception is that the cost of compliance is going up, and it's quite common to hear companies, even startups, talk about the fact that the cost of compliance is significantly high, that we have a whole compliance department even though our business is quite small, right? That's a common complaint that many people have. I think this to me is really a case for automation, right? I mean, it is just not going to get solved through throwing more people at it, because we can assume that the regulations will only get more complex and more sophisticated in the times to come. So I think the real point here is that there might be a benchmark. It could be 2%, 5%, something of that sort. But end of the day, there is going to be this view that you have to cap that cost and then start automating, and not just make it a human-centric problem. General view of this is, like I give the example here, that like cybersecurity, you're not going to solve this by hiring more and more cyber security professionals. You have to get tools, technology, platforms to defend your cybersecurity threats, against your threats. So in that sense, I think this should not be looked upon as human investment alone. It has to be seen as a technology investment. That's why RegTech, that's why SubTech, that's why these are technology solutions, right? Want to add anything? Or?
Yeah, so I think it'll be a very myopic way of seeing that what percentage of the top line is spending on compliance. Because compliance is how you view compliance as a culture within your organization. There are firms which see compliance as a cost, as a burden. There's some who see it as a business enabler because you're building trust. So in which part of the quadrant are you will actually depend how much you want to spend on your compliance.
So I think it's a good suggestion to start collecting this data, right? People can self-report, and this might lead to a sort of sector-wide data can come from this. Yeah, maybe regulators can actually play a role in collecting this data. Yeah. Okay, are there any other questions? In fact, while we wait for any other questions, I'll ask one here to you. Jurisdictionally, you've seen, you know, all over the world, different countries, US, then there is FCA, then there is UK, then European Union, then you look at Hong Kong, Singapore, all the markets. Where do you think the most amount of innovation is happening in RegTech and SubTech today? Which markets, or one example or two you can give that have excited you about how much innovation is happening?
Well, I am really biased, but I think really what in India is doing, a lot of it is not reported in the international press, but I think we are far, far ahead of the world, be it in surveillance, be it in the inspection and audit area, at least in the market infrastructure institutions and the systematically important brokers. There is a huge amount of RegTech and SupTech which is getting used. And again, what I'm trying to say is that because we are a segregated account structure and it's a retail market, the challenges of compliance and regulation are that much more because you have that many more touch points. And therefore, it is a need of the business also to ensure that you have more RegTech and SupTech. So I see the proof of the pudding is in the eating, and that's where I see that with these retail growing and the necessary amount of frauds or those which are not being seen or getting stopped in its tracks proves that there is a huge amount of technology which is being used. Besides India, I think Singapore has been fairly advanced. The West is slightly slower. They are more focusing on the business side than on the compliance side. Is yet on the human at the core and systems at the support, which is what is my sense of what's happening in the world.
So on that note, I mean, India is now seen worldwide as a technology power, whether it is Aadhaar is seen as a role model, UPI is seen as a role model for digital payments. So in digital, this RegTech, SupTech world, do you see similar reputation? Like you're hinting at the fact that India is ahead of the curve, but do you have any specific things that you think can
numbers
happen?
Which we saw on the first day, and I belong to the depository world. 5 years ago, the total size was about 3 crores or 3.5 crores. Today, we are at about 17.5 to 18 crores. 50% of that coming from tier 3, tier 4 towns. So if accounts can get opened on the DMAT side quickly, but at the same time having the requisite controls and checks, and that is equally applicable in all facets of the ecosystem, shows that that's where RegTech and SupTech, though not being reported, is playing under the radar on a silent basis where this growth is being seen.
So invisible RegTech and SupTech is already at work and it's working. Okay. All right. I think if there's any last questions, we can take that or we can close at this point. Okay. I think we'll close. Thank you.
Thank you, Shantanu-ji. Thank you, Nehal-ji, for taking us through a very knowledgeable session. May I request Shri Pramod Rao to felicitate our guest speaker. I also request Dr. Tathankar Patnaik to felicitate our speakers with the NSE bell. Please. Could we have the slide of the quiz winners, please? So Sachin, Gaurav and Paras, can we have you on the stage for the award? Congratulations, Sachin. We have Paras, who is the second winner. and Paras. Congratulations. We'll now take a short break for tea and coffee, and we'll resume in 10 minutes.
Hello. Hello. Hello, sir. Can you hear me? Hello. Hello. Just kindly unmute and talk. Sir, can you sit on the table and talk? Just can you talk? Hello? Just, yeah, you are audible. Is there any presentation? Sir is going to give any presentation? Only talk, only speak. Just if possible, you can keep the microphone near to sir. Okay. Okay, from our side, audio is okay, na? You are able to hear? Okay. Yeah, audio and video both are okay. Thank you.
Yeah. Good afternoon, ladies and gentlemen. So we will be starting our last and final session of the day soon. So I request all of you to please settle down. Thank you. Good afternoon, everyone. I welcome all of you for the final session of the day on the topic capital formation and financing infrastructure ideas for balancing supply and demand. For this session, we have Dr. V. Anantha Nageshwaran, Chief Economic Advisor, Government of India, as speaker. And the discussants for this session are Professor Venkatesh Panchpageshan, Professor of Finance, Faculty in Charge, IIM Bangalore, and Sri Navneet Munot, Managing Director and Chief Executive Officer, HDFC Asset Management Company Limited. Dr. V. Anant Nageshwaran would be joining us online via WebEx link. I would like to welcome Professor Venkatesh Panchpageshan and Sri Navneet Munot to join us on the dais. Sir, please. I would request the discussants for a photograph, please. Now, before we begin the session, let's go for final quiz of this symposium. So, can I have the QR code, please?
We're going to slightly tweak the order.
Okay, sir.
I'm going to go first. And then
Sure, sir. Sure, sir. Now, the last and final session, last and final quiz of this session. So big congratulations to the winners. I will request the winners to come to the dais after this session to collect their prizes. Now over to you, sir. I would like to welcome Professor Venkatesh on the stage, sir.
All right. Welcome. And this is the last session. So we are going to be discussing, many people had touched upon it in the course of yesterday and today. So given all those constraints, I'm hoping the session is still going to be valuable, and we've got two great experts from the one from the government and one from the industry to join me on focusing on capital formation and the infrastructure financing. So what I thought, I mean, since the session was involving two experts from the ground, so as an academic, I just wanted to step back and raise some issues around these themes, and then have both Anant as well as Navneet to share their thoughts, and then open the floor to more questions from all of you, just to make it a little bit more interactive. So the first thing is on the capital formation. Of course, we have heard a lot from yesterday about how the capital markets have grown, the mutual fund assets under management have grown, and so on. Yet we also heard yesterday a couple of things which gives us a little bit of a pause, which is the gross fixed capital formation in the country has been largely stagnant. So the private investment has not really taken on to be able to sort of correlate with all the other things that we have seen in terms of the stock market performance and the mutual fund performance. So given that, the first question is, where is that money that we are raising? Where is it going? And I think yesterday Sajid was sharing some data, and I thought I'll bring one of that data point out to say that only about some 20–25% of that money is actually going towards new projects. So the rest of the money is either going as an exit to promoters, or maybe repayment of debt. As we know, the debt leveraging has come down in the corporate side. So I think largely, if you're looking at infrastructure or funding for the long term, we do need investment. And given that investment is not growing, is a cause for concern. And I think clearly that's something that I'm sure Anant is going to discuss that while he is talking about his, from his point of view. The other thing is, we also heard a lot about the structural gaps in the capital market. We heard about corporate bond market. We heard about paucity of capital for the startups, in the sense that, a lot of startups are starving for capital for the growth stage. And then, of course, the infrastructure. There were some discussions about it in the earlier sessions, and we're going to dive a little bit deeper today. So I think in all of this, they're all risk capital. How can a capital market generate that risk capital and allocate it to the right places? And I think that's a challenge we need to address if at all we are going to grow into the $25 trillion economy that we are talking about. So I wanted to also bring a little bit on the infrastructure, and I'm going to lay out a few things that I see as an economist. And then, of course, we'll open it up to the other two experts. I think the need for infrastructure financing is, I mean, no doubt about it, right? It's on lakhs of crores. So I think we all are aware of the need. The models that we have followed so far has been either government-funded projects or a public-private partnerships or a private-funded infrastructure projects. So clearly, all three models we have tried out with varying degrees of success, and we have not been able to identify one or two or even a hybrid version that will help us for the next 20 years or 25 years of growth. So that is something that we have to figure out what is the right model to approach. For example, in the past, the governments have funded these large projects, but I think going forward, most are aware that both the central and the state level, the governments are fiscally constrained. So their ability to actually use their own capital to invest in infrastructure is going to be limited. So given that, how are we going to deal with it? Infrastructure, the way it is painted in our setup is very broad. It includes both generation of public assets like metros or a bridge or a tollways and so on. But at the same time, we also have things like warehousing or affordable housing, which also comes under the definition of infrastructure. So clearly, these are private assets. So one thing that kind of strikes me is that we do need to separate the two. And I think in the case of private assets, clearly there are workable private models. And I think those can be separated and optimized in that space. And then in general, some of the learnings that we have had so far is that there has to be government involvement in the infrastructure, at least at the early stage. I mean, if you look at the risk of infrastructure, most of it, it's the early stage when the development risk and even in getting it off the ground kind of risk is pretty high. And I don't think we do have any other entity or an institution that can take care of that need. So one of the things we should be looking at is how can governments get involved without putting capital at their own capital, and is there a way in which we can do it? I have some ideas. I'll get to that later. I'm just throwing some of these things. And there's one other thing that I wanted to bring out in the way we have developed infrastructure financing in the past. We have had a lot of bank financed projects. And as we all know, banks do have a great advantage in measuring credit risk. But at the same time, they cannot take the maturity or a tenor risk because of their of the longer duration of these infrastructure projects. And I think that was also raised yesterday. Given that the optimal investor or optimal player who should be able to take these longer term projects without being the government would be your natural entities like pension funds or insurance companies. And I was just looking at some of these large players like EPFO or LIC and looked at how much are they investing in infrastructure. And I just picked up a random year, looked at their infrastructure related investments. In fact, both of these large entities invest much lower than what they are obligated to invest in. I mean, according to their own limits. So clearly, it is not in their interest right now, as it stands today, to invest in these long-term projects. So in which case, what do we do? And again, the solutions, we will address it later. And then the last thing is in terms of the securitization, and I think I wanted to bring this out more forcefully here, is you do have to have some degree in which the assets that are being created can be securitized by the original investors. And how do we do it is a problem. Right now, we don't do that very well. But if you look at some of the larger economies, let's say even if you think about asset-backed securitization, a lot of it is happening in India on very short-term loans, credit card loans and things like that. So which clearly means that we do have an opportunity to develop that market, whether it's an asset-backed or mortgage-backed or even longer infrastructure bond securitizations. But it's just that it is quite important for us to close the loop. So you need an original investor. You need somebody to carry that risk for some time. And then you also need an exit for these investors in order for this to work. So these are some of the points I wanted to bring out in terms of what the gaps are today. And I'm going to have Anant talk a little bit about his views on both capital formation and infrastructure. And then we'll follow it up with Navneet. And then as we progress, we will get all of you involved. And hopefully, one of our own internal goal was to come up with some takeaways or some ideas about what do we do next on these two spaces. So Anant, do you want to take it over from me?
Yeah, thank you. Thank you, Venki, and good to see you at least on screen. And wish you all assembled there, not only the people on the stage, Navneet and Professor Venki Panchabagesan, and also members of the audience. Wish you all a very happy, healthy, prosperous, purposeful, and peaceful 2025. So my apologies to the organizers, the Securities and Exchange Board of India and others for not being there in person, which I would very much have liked to. But given the circumstances, January being the month for the preparation of the budget and the economic survey, unfortunately, my plans to be there did not materialize. So I'll start with those apologies. But given that this is the beginning of the year, organizing a conference of this nature on finding the resources for investment or capital for growth, I think it's a very, very good initiative. I think we need to keep the issue alive on the table and also reinforce from time to time. Even though, as Professor Panchabagesan put it, everybody is aware of the challenges. I mean, ultimately, capital formation is the key to growth, because we know that an investment rate of 35 to 40%, which is what the East Asian countries were able to achieve in the 70s and the 80s, were the ones that propelled their period of high growth. And later on, it was emulated by China as well. In the case of India, of course, we know that in the first decade of the millennium, we had this huge investment spurt. Both savings and the investment rates went towards the upper band of the 30s, towards almost 40%. We had a 37.8% savings rate in 2006 and 7, or 7 and 8, I'm not remembering the exact year, from national income data. And we also had a very similar high investment rate, but they couldn't sustain because of the fact that some of these investments were not productive. And naturally, therefore, the second decade went into the balance sheet repair in the private sector, and overall economic growth was lower than the 8 to 9% we achieved in those 5 years between 2003 and 8. And as a result, both savings and capital formation came down. By the time the balance sheet repair was completed by 2019-20, then we had the pandemic set in. Now things are recovering. Now, right now, we would say that the savings rate is close to about 29%. I'm talking about the gross national savings rate as a percentage of GDP. And the investment rate is close to about 30.5 or thereabouts. These are all approximate numbers. And naturally, the gap between the two is the current account deficit. And now, talking of achieving growth rates of 7 to 8% require that the investment rate, whatever it is translated quickly into output generation, employment, and income generation. And that is where the incremental capital output ratio comes into play. So now there are two ways to therefore boost output arising from investment. One is to boost the investment rate, and the other is to boost the incremental or lower the incremental capital output ratio, or a combination of the two should be able to achieve that. But this is where I think we need to get a bit more realistic about the kind of decade or decades we are facing up to at this point. So if you look at the RBI data, which they put out every month as part of their monthly bulletin on foreign investment flows, you can see that FDI flows are holding up very well at the gross level. But because of successful, profitable exits, etc., and also the interest of Indian entrepreneurs to invest overseas, the net FDI, i.e. gross FDI minus repatriations minus the FDI made by Indians overseas, etc., that number is on the lower side. And it has been amply backed up by, of course, the portfolio investment inflows. In fact, some of the repatriations were actually transfer of ownership from direct investors to portfolio investors, and that happened in the last couple of years. and that attests to the resilience and the performance of the Indian equity market, and also the depth of the equity market that could absorb these exits. So that is all, these are all very, very positive dimensions. But nonetheless, if it is going to be the case that on a net basis, that FDI numbers are going to be lower than the past for whatever be the reason, and we are entering it, and that is why I want to enter into this discussion on the global environment, which is going to be very challenging in the coming years, because India isn't competing for capital formation and investments only with emerging markets. It is also competing with developed countries themselves who want to retain many investments onshore. And therefore, one of the important issues we need to face up to when we talk of capital formation is this challenge about what is the sustainable level of current account deficit. It used to be accepted in the past that India could handle a 2.5% to 3% of GDP as the current account balance, and it could be financed. Of course, as the GDP becomes larger and larger, we are heading towards $4 trillion in the course of FY25 and 26, and onward towards 5 and 6 in the coming $6 trillion in the coming years, and therefore a 2.5% to 3% of that number will be a larger number, naturally. But the question is, given the competition for investments between developed countries and emerging economies, India therefore has to figure out in that environment, is the sustainable current account deficit a lower percentage of GDP? Which could be 1.5% to 2% rather than 2.5% to 3%, because the world has changed. The last 30 years were a different era: globalization, free movement of all factors of production, labor and capital, especially, obviously, and in general, continued steady growth in trade in services and goods. All those eras are going to be somewhat difficult to replicate or expect to happen in the next 30 years. And therefore, we need to focus a lot more on investment efficiency rather than on looking at expanding the investment rate and anticipating that it would go back to the kind of levels we had in the first decade of the millennium, when I said it was approaching East Asian levels. So I think so capital formation, of course, is desirable in and of itself, and if we can do that, therefore, with domestic savings rather than relying on external savings, that will be key. But we all know that savings in the macroeconomic parlance is actually endogenous. It is generated by income growth, which in turn is a function of investment and also household employment generation, and that is why it is endogenous. So much of the reluctance that we see in the private sector isn't entirely true. In fact, private sector post-COVID has indeed ramped up its investments. The question is the pace at which we are anticipating that to happen, because many of us think that now that the balance sheets repair is behind us, now that the pandemic is behind us, therefore, there is an implicit expectation that investments would go back to where they were in the first decade of the millennium. But that isn't going to happen. The first decade of the millennium was the apogee of the globalization era. To a large extent, the financial crisis of 2008 actually should have made us review whether that is going to last forever. But policies such as quantitative easing and ultra-low interest rates gave us the impression that the globalization could be stitched together and put back in shape. But then came Brexit in 2016, the election of President Trump, who's coming back to office in a few weeks, in 10 days' time or so. I think all these things should have reminded us that, therefore, that post-pandemic, post-balance sheet repair, it isn't that realistic to expect that we would go back to the mid to late 30s investment and savings rate as a percentage of GDP in India. So I think the focus should be therefore on, yes, we should get the investment and savings rate up to at least the mid 30s, but that will also take some doing. And for that, paradoxically, the private sector actually start to invest to be able to generate the savings and income growth, and then to be able to finance it. So it is endogenous. So I think it is a cat and mouse game. And given the fact that the private sector profitability is, barring the last couple of quarters until about the end of March 2024, was at a very high level. profitability as a percentage of GDP, and the rate of growth of profits also in and of itself post-COVID were all extremely good. And therefore, there is a certain risk-taking, which is what private sector is all about, that needs to happen in terms of capital formation and hiring as well. So naturally, investment is not just a game of finding the capital from profits, internal resources, which is good, but it is also about labor share, because ultimately the household sector is the most important source of these funding. And without their ability to have the kind of income growth, then the private sector will find it difficult to finance its investments once the current accumulated profits of recent years is exhausted. And with the global environment being what it is, then we will have a challenge maintaining the investment rate in the 30s. So let alone going into the mid to upper 30s. So this is the situation that we need to realize, and the onus is largely on the private sector, because post-COVID, or even starting pre-COVID, the public sector has done its part in sustaining capital formation. And that was partly for classical Keynesian reasons, but also because the private sector was risk-averse, both the financial and non-financial sectors. Somebody has to run with the baton, and the public sector did so. And we are also seeing, therefore, lately that both state and union governments have done a lot on public investment, but we may be running into state capacity constraints as well. So when it comes to capital formation, and I think this is where the lay of the land is as far as we are concerned, and boosting the investment efficiency, therefore, goes, and there the onus is largely on the government agencies, because investment efficiency means translating the speed with which investment becomes output, or reducing the time when it takes time it takes for investment to become output, and for that output to sustain. And there, I think clearances, approvals, regulatory patterns, etc., need to be reimagined, and that onus is on the public sector. So now, in the remaining 3.5 minutes of my 15 minutes, which I set for myself, I will speak about the infrastructure part. And I think, again, sort of continuing from this capital formation story, infrastructure is obviously has always been thought of as a public sector area, because it is naturally long gestation. Returns are relatively low because infrastructure are regulated areas, and the public and the state has an obligation to ensure that the user fees are kept reasonable, and therefore it is always considered to be a public sector domain. But with the public-private partnership and viability gap funding, etc., the public sector has tried to make infrastructure remunerative for the private sector, so that it doesn't get excluded on account of its inherent low return, high risk prospects. So, but public-private partnership in this country, therefore, began partly on account of these reasons, and also partly because public sector investments and public sector balance sheets, which Professor Panjabagesan alluded to, the fiscal balances post-COVID are still on the mend. The union government may have brought down its gross fiscal deficit ratio quite substantially from 9.2, and this year the target is 4.9%. And states also have done so, but still on a combined basis, we have an 8% fiscal deficit in the country between union and state governments, and the debt ratio is around 80% of GDP, which is why I think it is important to continue to make it attractive for the private sector to be a partner in infrastructure formation. And there I think much more needs to be done with respect to the public-private partnership, and some of the issues I want to highlight in the remaining time. It basically requires that we have strong PPP frameworks in several sectors, and the atmosphere for such private sector participation is quite conducive. But more importantly, the partnership aspect because the PPP has 3 Ps there: private, public, and the third word is partnership. And that is where I think much more needs to be done. Often authorities, and I here mean authorities around the country, authorities often forget that PPP is not a public-private engagement, but it is a partnership. It is not like an engagement done in an EPC contract. So the inherent trust deficit still remains and continues to play a spoil sport between public and private sector. And I think there are many people many authorities believe that the private sector isn't a partner, but a vendor, that they must rein in from making more than expected returns. I think, therefore, the idea that there is a price associated with the risk that the private sector bears must be kept in mind. And also, on the part of the private sector, there is a tendency to look for projects where everything is assured upfront and that they don't have to take risks. If that is the case, they should also be prepared to accept commensurately lower returns if the entire risk is insured by the governments, by the authorities. De-risked PPP models have gotten traction, but pure play PPP often loses out in the push for safety. Now is the time for the private sector to come forward and say that given the number of projects that have already taken off, for example, in roads, that we have increased our risk appetite and we are willing to take the next leap. And that is a statement that has to come from the private sector. I'll just take one more minute to complete. So the government in general can act as a catalyst for creating infrastructure and investment opportunities, but these are the critical factors that need to be strengthened for PPP to take off, and PPP has to take off given the huge challenges we face in funding infrastructure, funding development needs, and also for ensuring that the infrastructure means social and soft infrastructure also get the attention, and where I think the government has a much bigger role to play. And the third issue in the PPP dimension is a ready pipeline of investable projects. And for that, projects should be well structured in their infancy. If authorities across the country, particularly at the state and local levels, if they develop good PPP projects with clear contracts, timely dispute resolution, and risk-sharing mechanisms, private capital will then start to come in as well. So the government is indeed, the union government in particular, is indeed undertaking extensive capacity building at all levels, but it requires participation of local authorities and state governments, multilaterals, etc., so that the understanding of PPP, the taxonomy is uniform across all players, the public and the private sector. So I think as Professor Panjabagesan said, we need to provide more time for you to participate and make it interactive. So I will conclude my preparatory remarks right here. One way of basically boosting capital formation, apart from what I said about the need to make sure that investments translate into output as fast as possible, and regulatory agencies have a much bigger role to play. The second aspect to introduce as much transparency as possible, because information asymmetry is one thing that holds back public-private partnership. Something like a dedicated India infrastructure credit market, which is an online marketplace where infrastructure projects are listed for financing by institutional and retail investors, is a possibility, something to explore. And its features could include credit ratings based on real-time data, the guarantees by the government, and also blockchain integration for project records, etc. So in general, from high-speed rail networks to 5G connectivity to renewable energy grid to smart cities, India's infrastructure is indeed growing vigorously and is continuing to align itself with the vision of the country to become a global economic powerhouse. But it continues to require courage to innovate, the discipline to implement, and the collaboration of all stakeholders for it to become a continued success as it has been over the last 10 years. I conclude my remarks at this point and hand it back to Professor Panjabagesan. Thank you very much.
Yeah. In the interest, thank you so much, Sebi. Thank you so much, NISM. I'll keep it very short. I'm looking at the clock, and then Venkatesh mentioned that we'll try to keep our session more interactive, but I think we have a few minutes. After 2 days of listening to a galaxy of learned
stars and then ending with hearing from Ananta, there is very little to speak. But I remember when we were discussing about this session, he told me that the format of a symposium is a presenter present and the other two people on a very lighter note, he said they have to tear him apart. I cannot do that for someone, a close friend, as well as somebody, I mean, we look up to as a thought leader, as an investor, as a policy maker now, and of course, a macro practitioner. But I'll just pick up one point. I think you mentioned about the global macro backdrop, which is very challenging. Our view that while, yeah, it's a challenging environment, the only thing I can say about the world is continuity of uncertainty. The only thing I can say with certainty about the world is continuity of uncertainty. Having said that, I have a view that I think the world is going to see another very big investment cycle, and that will be driven by the challenges that the world is facing. And it is out of compulsion and not out of conviction of policymakers that, or the business community, that we are going to see a massive investment cycle across the world. This will be driven by the geopolitical risk, which will lead to a lot more defense spending by every country in the world. And post-Trump, I think the probability has gone up. The whole trade war and the higher tariffs, etc., anti-immigration, all of that will lead to supply chain shifting locally, right? World moving from hyper-optimized to a more reliable supply chain, which means what I think is a period of what I call globalization of localization, which means more investment. COVID accelerated that pace, and I think the pager attack by Israel is only going to accelerate that massively in next few years. The third, if you add, is a climate change, which will lead to energy transition in transportation. I mean, massive changes in the way infrastructure has got built in last 200 years and the way we have to build for the next 100 years to ensure that humanity not only thrives, but even survives. So for that, I think there is going to be a global cycle. India will be part of that. I mean, this will create some challenges in terms of, let's say, an availability of capital and many other things, but it will also a big opportunity for India. Coming to India last, I mean, listening to a lot of speakers, I didn't have the opportunity to listen to everyone, but whatever I've read so far and heard, any presentation on infrastructure will have a picture where you'll put Atal Setu, maybe a Mumbai Bandra, Sea Link, and some of those kind of pictures. I think the first, we have to think about infrastructure in the most holistic manner, which is physical infrastructure, which includes all of the things that Ananta talked about. We have to add social infrastructure, which is education, healthcare, and we have to add digital infrastructure to it. And it's very critical when we think about the financing of that, or when we think about infrastructure, these three are interlinked, and there are a lot of learnings from each other. I think at some stage, we have to think what that we can learn from the way India has built the digital infrastructure. What is that we can do in building physical infrastructure? And I've been waiting, like, when the DPI movement will come for the physical infrastructure, reducing the risk, keeping it an open architecture. There is so much we can learn from the digital infrastructure, and also a lot more investment which is needed on that side as well. It is also important thinking holistically, because when you look at all the avenues of investing as an investor, as an institutional investor, whether it's equity at various stages, I mean, a digital infrastructure or a digital, I mean, when we talk about that, we're talking about a seed capital or a risk capital of a different order or a venture debt. When you're thinking about social infrastructure, you're thinking about an impact investing. You're thinking about maybe government funding a lot more, gap funding, than what you think about the physical infrastructure. When you think about physical infrastructure, it's a different kind of equity. It's a different kind of bond and the debt. It's about internal accruals, thinking very differently, and it's about monetization of those assets. And all four have to be on table instead of thinking of equity or debt or corporate bond versus banking or let's say the monetization separately. All four have to be. Because if we are able to achieve all four together and put a right policy prescription, then automatically it increases the availability of capital. It reduces the cost of capital. For that, the another thing we have to think about in India historically, I mean, a finance minister would have spent more time doing investor shows in London, Frankfurt, New York and Singapore, we never realized that an 500 rupee per month SIP can one day become $3 billion a month. The financialization of savings or the fractionalization can become such a large amount for a country which is a nation of savers. How do we transform this nation of savers into the nation of investors? I think that is biggest challenge as well as the biggest opportunity. I'll come to the challenge part in a minute's time, why it's very important to solve for the policymakers, not only to fund infrastructure or to meet our investment need, but for a bigger societal need. And it kind of like ticks a lot of important boxes from a holistic solution perspective. Within that, whether it's taxation, whether it's the way we put the regulation, whether we put policy, has to ensure that we look at it in a holistic manner. We look at all four: equity, debt, internal accrual. I mean, how to make them more viable, how to make that more profitable. And profit is not a dirty word the way it was thought in 60s, 70s, 80s. It's very, very important because it reduces the risk. It reduces the risk of, it reduces the cost of capital for the other investors and the monetization of assets, which is the most critical. From the government, policymakers, and regulators' perspective, I think the biggest, I mean, India is at a good place. We've never had the political stability, social stability, macroeconomic stability, and the financial stability the way we have today. Corporate balance sheet and financial sector balance sheets are in a great shape, probably the best that I've seen in my career over the last 30 years. The world is looking to invest, notwithstanding the volatility over the last couple of weeks in the capital market or the foreign outflows. I stay very positive. I think capital markets are buoyant. We have seen a record year for IPOs. I mean, raising of the equity capital, and over a period of time feel the same about the bonds. I think what's needed is like how do you, and the government over the last couple of years has shifted the focus from has shifted a tremendous focus towards capex, particularly the central government, and the nation has been a beneficiary of that. I think what we need to do is maybe one of the big learning from the COVID, where India did not follow rest of the world. We didn't throw cash from helicopter, but actually we did something very, very interesting from the fiscal side. This, what was that, ECGLS, the emergency credit guarantee type. I think we should put the maximum amount of money for infrastructure, on infrastructure from the government in something like that format, where we are just trying to reduce the risk, because that scheme did a wonder where it made banks comfortable to lend at a time where future was probably the most certain in a century. But banks lent because there was a backup. And the government should put that money as a backup to reduce the risk of that project or of that plan, and spend less amount of time in really building it. If they are really building it, then there has to be a bigger focus on the constant asset churn, constant monetization, so that you don't block too much of cash on that. The number two thing that we need to do is on the taxation side. So that was one. The second, from a fiscal perspective or policy perspective, taxation should not be looked at revenue maximization. Taxation should not be looked at, I mean, from that narrow perspective, but actually from a more holistic perspective, that how do we ensure that we have more money available for the infrastructure development, which will have a huge multiplier effect and solve some of the other societal challenges. If we don't do the financialization of savings effectively and don't transform the nation of saver into a nation of investors, the two big challenges that I see going forward, and maybe I'll stop there. The number one is that we will become a developed country by 2047. We will be a 2025, $30 trillion economy. My friend Subbu has written $55 trillion economy by 47. But the biggest challenge that we'll have, that we won't become a nation of rich people. I think we would still be, and from a per capita GDP perspective, would be small. And the government is doing a phenomenal job on the overall welfare, like a toilet or an LPG cylinder or a tap water and all. But given, I mean, a starting base of 82% public debt to GDP, we will never have, at least in our lifetime, enough money for the government to secure the retirement of a large population. And that's why it's important that people invest today more to secure their future, which can give them inflation beating returns, because this will also solve the inflation problem. But we are also addressing a larger societal problem. And taxation, why I'm saying that, because the way we tax equity, and of course there have been changes there also, and I would urge a rethink on that. But the way we are taxing a long-term corporate bonds and a bond mutual fund have to have a rethink because of that. And the second, that was the one aspect, and the second aspect we need to look at in policy also is that the country needs what I call IE and EI. I is individual experts and the expert institutions. In my career over the last 30 years, I've seen like a couple of those cycles. In 90s, some of the people I can see here who were part of ICICI, IDBI, and those institutions, we had a very short cycle, got into all the challenges, wouldn't go into that. And then we thought we need universal banking. We had the best era between 2000 to 2008. But again, thanks to global financial crisis, again, that cycle kind of like didn't go long for the infrastructure build-up. And then we experimented with many things. 11 to 14 was that period where Murphy's Law applied. Anything that can go wrong will go wrong. So policy paralysis to execution logjam to regulatory overreach to judicial overreach to everything that could go wrong went wrong. The 15 to 19 was a great reset where we tried to put everything in place again, whether it was IBC, whether RERA, whether many of the other things without getting too much into detail to that. But unfortunately, just at a time when we thought that all of these things will lead to a massive private participation in CAPEX, COVID hit. And then now again, government has to do the heavy lifting of the investments. But at some stage, it will change. What we also need, apart from all the things that I talked about, is, as I think what I said, IE is the specialized institutions, and of course we have NEFIT and all that, but we need a different scale altogether. What we also need is expert individuals. The people who have funded these kind of long-term assets were in 90s and 2000s, and they have made tons of mistakes over the years, exogenous or the endogenous or whatever. I think what we need is investing a lot more in talent if we want this 3.5 trillion to become 10 trillion and have to get much greater investment that anybody in the world has ever seen. We are going to do that in next 20, 25 years. And when I say world has never seen, I mean, think of the scale that China had between 2000. Oh, I think it's already one more minute. Between 2000, post GFC, when the world wrote of China, between 2010 and 15, China used more cement than the US had used in the previous 100 years. Maybe at some stage we need that scale, but this will require a lot of investment in talent also. So if the government or policymakers to get the most buck, I think investing in that, what I talked about, something like a backup or ECLGS type, I think a lot more investment in the talent, maybe learning again from DPI. I think a large fund, which is basically not only developing the talent, but developing the technology, how we can leapfrog on the physical infrastructure. A very large fund, which is not investing in the bridges or the tunnels or the seaways, but actually looking at or building the technology, R&D technology, which makes the execution a lot better. Maybe in the interest of time, I stop there.
Thank you. All right. I'm going to open it up because we don't have time. So, all right. Anybody? Yeah, please. Let's start with this gentleman in the front.
Hello, sir. My name is Vishesh Kothari. We have already seen that infrastructure in India, corruption and delays have been an inherent part of the infrastructure. So I have a very straightforward question. Because we have to tackle these challenges, we have to tackle somewhere and somewhat we are tackling it. But what your analysis or viewpoint on this, and because we have bullet train project also which has been delayed and several other factors are affecting it, but corruption and delays. So infrastructure financing, how do you see it? These factors affecting those things.
You sure corruption is not there anywhere else?
Corruption is there, but infrastructure, it's affect infrastructure because cost increases.
Yeah, no, absolutely right. I think it's a cost, and it has a lot of implications. I don't know whether in this panel I can solve that problem, but clearly, I think if there is what we call in economics as an incentive compatible. That is, the people who are investing have the same incentive or the people who are using that money, then things will work. There are multiple ways in which we can address that issue. But just in the interest of time, since we are really running out of time, this is a much deeper question. So we'll have to take this offline, if that is okay with you. Yeah.
Hello.
Yeah.
Yeah.
So,
My name is Pawan Jhabak. I would like to ask to Anant Nageshwaran, Chief Economic Advisor, that in what way has Dr. Manmohan Singh helped him make a better economist?
hey, this is a not. Can I use the moderator's option, because this is a much larger question, not related to this particular topic. Yeah.
Kevin James from the London School of Economics. Infrastructure is an option in the sense that you can build it at any point, but once you build it, don't want to build it again.
Can you keep it a little bit closer?
So given that technological uncertainty is increasing, and as Mr. Munot was saying, how do you take into account kind of the optionality of infrastructure going forward? Just because it's probably more a difficult issue than in the past.
Yeah. No, it's a great question. I think the optionality exists at various stages in the infrastructure development process. There are well-known techniques, well-known approaches to address the optionality of the thing. The main thing is, of course, a lot of it requires some degree of transparency and some degree of having the right mechanism. In fact, for example, the optionality to delay a project. How do you ensure that optionality doesn't get enforced? And I think there is and this is a area where there's extensive research and extensive models across the world. So I think we do have solutions available for that. If I have to answer you in a very generic way. But as I said, optionality exists across the whole spectrum. Yeah. Any other questions? Yeah.
Yeah. A question for Navneet. You brought out...
Just keep it closer and make it tighter.
Yeah, you brought out that aspect of investing in digital infrastructure, and he brought out the aspect of corruption in physical infrastructure. So I'll maybe give a couple of examples. So many of the physical infrastructure that you see, they get redone just to get that money so that it can be spent on elections by the politicians, and hence that corruption angle is there. To ask a specific question to Navneet, like there is a gap at this point of time in the risk capital at the initial stage of the startup life cycle. While there is a lot of growth capital that is chasing the well-established businesses, which have already proven that, okay, they have a product market fit. Now they can go to the public markets, and then they might be making losses at this point of time, but eventually they will make profits for the investors. So as investors, how are you trying to, let's say, give the confidence to the entrepreneurial ecosystem in the country that guys come, build startups, and we are there with that initial small size checks, which you can leverage.
Again, sorry, man. This is an infrastructure panel. I think startup ecosystem is in the other end of the spectrum. I mean, there is, you can look at it, entrepreneurial infrastructure, but I think that's stretching the definition a little bit too much. So if you don't mind, those questions, we'll take it offline. Yeah.
Sir, Digambar here. My question to Anand sir. The speed of implementation of infrastructure project is the main problem. For example, when we built Bandra-Worli Sea Link, it took almost 5 to 10 years to build that project, while China built such kind of 6 projects within a year. So, I mean, what are the steps government of India is taking for a speed of implementation? Since Mumbai-Goa highway is also building from since 10 to 20 years.
Very difficult to understand what you said.
But yeah, I mean, it's a long gestation, and how do we reduce the time? So as I said that, I think we need to invest a lot more. A government should have a large fund, which is basically funding the R&D technology on physical infrastructure. How do we look at like material science or the construction technology and all of those differently? And how do you look at the whole policy side? I mean, what really leads to the delay? I think we have learned a lot. When I said that 15 to 19 was a great reset period, where whether it was like what has gone wrong in terms of funding, what has gone wrong in terms of, let's say, clearances, many things I think got kind of like corrected. RERA is a classic example. IBC is a classic example. Many other things that have happened, but it's a continuous learning, and we have been on that learning path. Now you have like so many policies. The whole, what is that, Gati Shakti and the NIP and all that are a lot more holistic to reduce the risk in the project. Yeah. Maybe Ananta can add more. Yeah.
I think I did allude to that. I think
where are you?
The entire Gati Shakti initiative, was about reducing the project delays and ensuring that, and states have actually embraced that Gati Shakti mode. And it is now, there are conversations that it could be, parts of it could be made available to the private sector as well. And that initiative is all about ensuring that project delays are minimized. And I also spoke about the need for regulatory approvals and processes to be more meaningful and efficient in terms of time taken to give approvals. So I think there are initiatives that are happening that have reduced the time taken for infrastructure development to happen. We need to have a good metric to compare where we are compared to where we were. And yes, you are right in comparing some other nations, but we operate in a different framework where anybody and everybody can actually go and get some stay order, and there are some, so judicial processes are much more elaborate in this country, etc. So every player in the system, whether it is the government or the private sector contract, and also sometimes once you win a bid and then you renegotiate the price, etc. after you win the bid, those things can also delay execution. So it's not easy to answer this question within the short time that we have, but all the players in the system therefore have to realize what is it that they are doing to contribute to the project delays, and therefore take it upon themselves to do whatever they can within their limits to reduce the time taken. And one of the initiatives the government is taking is about Gati Shakti, but I agree with you that regulatory processes also can do a lot more to reduce the time gap between investment and output realization. Back to you.
Yeah, please.
So I'm Balkrishna Kini from AMFI. I have a question for Dr. Ananta Nageshwaran. Historically, government steps to channelize the household savings into the capital market, or, in terms of formation of UTI, and then ELSS have been proved to be very successful. In fact, ELSS has been very successful, channelizing the domestic savings into equity market. We're talking about financing infrastructure. So one of the suggestions we're given is to, to channelize the domestic savings into infrastructure funding through mutual funds in the form of DLSS, or, today, rural electrification corporation or national highway authorities, invest in the bonds. You get 54 EC tax benefit. Our proposal was to allow the mutual funds to come out with the, funding infrastructure projects, through the bonds and debentures issued by infrastructure companies, which are defined in that, RBI master list of, harmonized infrastructure subsector, so that there is a good amount of domestic savings channelized into such infrastructure. I just wanted to get your thoughts on that, sir.
So just one point there before Anant can answer. See, mutual funds have these daily liquidity requirements, and these are long-term investments. So I feel, my opinion is that this is a wrong way for mutual funds to step in. I think you do have finished infrastructure projects, which is where the InvITs come in, which can be an investment for mutual funds where the liquidity is there. But if you're looking at an ongoing development project, I think mutual funds would be a wrong vehicle to invest because of their own structural requirements. So I think you need, for the development of infrastructure, long-term patient capital. And I think that comes from either government or pension funds, like basically sovereign funds or pension or insurance funds, who have that long-term ability to handle that risk.
You're right, sir. That's why we have to look at a most holistic manner. So mutual funds are also a large investor in REITs and WITs. I think there would be different kinds of security, different kinds of instruments where you need participation of various players. SM REIT is a great idea. Over a period of time, this will take off. And there could be like SM InvIT type. I'm sure there will be a lot of experimentation that can be done. Even a long-term project needs various kinds of in the capital structure, various kinds of capital, and how you can make, an instrument where a certain set of class of investors can invest, and I'm sure industry can play a big role.
Actually, yesterday there was a very interesting point that people raised in one of those panels, which is the banks have the natural credit advantage, the ability to assess credit risk, while the insurance and pension funds have the ability to handle the longer term risk. But you do see in infrastructure, the banks coming more, but they can't handle a longer term investment. So is there a way to marry the two to be able to have, what they call as a takeout financing, where banks come in and then after some time they exit by giving it out because once the project is stable, then the banks can exit out. So I think there are, as Navneet pointed out, there's a lot of interesting ideas for innovation in the instruments, but force fitting them into an existing model might not work, is my idea.
Just a small point, sir, to counter your point. You're absolutely right. But if it's an open-ended structure, yes. But if it's allowed as a closed-ended structure, and ELSS historically plays as a closed-ended structure, and it can be listed on the stock exchange, so then that problem will not be solved.
Absolutely closed, and that's where the alternative funds, there is a whole lot of other vehicles that are already out there. But let's take some more questions if,
Sir.
Please.
Good evening, all. My name is Pradesh Sadanandan. I am from Dhanlakshmi Bank, sir, here. One question, actually, one part of question already our Kini sir asked and already you cleared that. And my second question, now the capital gain bonds, we are getting only 3 bonds included in that capital gain bonds. But my request is that we can include more products, more bonds, maybe state government bonds also we can consider for including in the capital gain trajectory. State government bonds also we can include. More products we can include into the capital gain infrastructure bond trajectory. That is my
54 EC, that 54
yes.
EC, right? That's the one you're doing. So you are right. That should the scope should be expanded. Yeah, mutual funds can be added there. Maybe a certain class of funds which could be an infrastructure funds. Yeah.
All right. Yeah, please.
So one of the major challenges for the infrastructure, long-term infrastructure projects is the political stability, as well as the project priority, and as well as the financial safety of the participants who are already likely to put their capital into the project. So we're going into the one nation, one election kind of scenario, which is a kind of political reset going forward for the next 20 years or a 30 years kind of scenario. So what sort of measures are required in your thought process?
Very deep question. Clearly, this is a holistic problem. I think the political process may change and it may be reversed also. I think what I would like to keep the focus is on the capital market side. But you are absolutely right. Political risk is a huge risk that needs to be accounted for by the initial investors. So I think there are people who will take that risk for a reasonable return. So the question is, can you identify them and bring them to the table? Any thoughts?
No, Ananta is better placed, but India, political stability, social stability, macroeconomic stability, financial stability, I think we are in best of the times currently, and I don't see that changing for next several years. And frequent elections doesn't mean uncertainty, by the way. There have been countries in the world, Syria had a stable family managing it for whatever, several decades, but that wasn't the good thing.
I think both Venki and Navneet have answered this question. While as all of us agree that political stability is indeed important for investment to keep flowing, and as Navneet pointed out, it's what kind of stability that is equally important. And I don't see the connection between this recent legislative proposal tabled in the Parliament and referred to the committee on the one nation, one election. What does that have to do with political stability per se? I don't see the connection. And again, most importantly, as Navneet points out, political stability, whether it is not about the number of elections or the number of times governments change, but more importantly, what investors look for is policy continuity, policy predictability, and also policy transparency and consistency of application of the policy across different situations. I think that is what matters, regardless of the political stability, which is important at at sort of a scaffolding level. But on a day-to-day basis, what investors look for is in what way political stability or instability translates into the policy level consistency or the lack of it. Ensuring the latter is much more important than, in that case, the political stability aspect becomes secondary. Back to you.
Thank you. I think we just have probably a minute for all of us to wind up. So my limited point, like a takeaway for this session is, I think we need to channelize savings, which I think Navneet pointed out. How to do it is the challenge. What is the best mechanism? I think India is also, especially in the infrastructure, we do have the trajectory, but the slope is not great. So how do we increase the slope of money coming into this sector? So I think that's maybe a hackathon with NSE and SEBI to be able to identify what is the right way to channelize, especially after hearing Radhika saying that for every crore of people coming to mutual funds, there are like 3x or 4x going to an unregulated product because they're all looking at chasing yield. So tough problem to solve.
Biggest opportunity also.
Anything last words too?
No, that's it. I think if we don't transform from the nation of savers to nation of investors, we have a lot of other challenges over the next several decades, and we won't be able to meet the dream that Prime Minister has given all of us of a Viksit Bharat by 47, and ensuring that every Indian has a respectable, a retirement life. I'll just say that if everybody is putting money in bank deposit, which is very safe, and everybody is borrowing from the bank, then India's debt to GDP has to be calculated very differently, because by default, I mean, the government may not say it, RBI may not say it, but effectively, it's very difficult for the policymakers to allow a bank to default, right? Which means that you are underwriting the entire economy. The government, the sovereign is underwriting the entire economy, which has its own, I mean, long implications. I want to talk, given in the interest of time, longer on that. And that's why disintermediation is very, very critical. And that's why the fractionalization or the financialization of savings, financialization of assets, these are very critical, and they have to be a very big policy priority. And everything that we do, whether it's taxation, whether it's policy, many things have to ensure that we don't lose sight of this bigger picture.
Hey, Anand, we'll leave you with the last word.
Thank you, Venki. I think this is sort of much more open-ended topic that we have been given. So I think for me, the important part is to be able to, more than focusing on raising the capital formation rate too high and aspiring for unrealistic levels. And I would like to point out that the global context is going to be very challenging, and therefore we need to do whatever we can to keep ourselves very attractive for investors, domestic or overseas. And therefore the action points lie in ensuring that there is a trust improvement between different players in the system, and that we look at each other as partners rather than as somebody to be controlled or manipulated or managed. And therefore the public sector on its part has to set the example by making sure that the private sector is seen as a partner, and private sector on its part must recognize the endogeneity between income growth and capital being available for its own investments. And we should not be relying too much on external capital for various reasons, because money isn't necessarily fungible. These days it comes with a flag attached to it, and therefore the sustainability of the current account deficit and the investment rate also has to be kept in mind. The focus has to be on investment efficiency relative to investment accumulation, and that is the way to move forward in the current year as well as the coming years as well. Back to you. Thank you.
If I can just take last 10 seconds, that there's a lot of discussion on how do we finance the green. Maybe in the interest of time, we are not discussing that today, but I think the agenda for next 10 years has to be, how do we green the finance? From financing the green to greening the finance has to be a bigger agenda.
Thank you all.
Thank you, Dr. Ananta, Professor Venkatesh, and Sri Navneet Manot for such a wonderful and insightful session. Now I'd like to welcome Sri Shashi Krishnan, Director NISM on the stage to felicitate our discussant. I would like to call Sri Tirthankar Patnaik on stage to felicitate our discussants on behalf of NSE.
So Ananta, we are giving it to you virtually.
I will take it from Tirthankar later.
Can we have the Slido winners, please? Okay. Okay, I would like to welcome Shri Sashi Krishnan, Director NISM, to felicitate our Slido prize winners. So, Mr. Hardik Kamble. First runner-up, Sanskar Dikshit. And our second runner-up, Mr. Kanthast Jain. Okay. I thank you everyone for joining the session. We will have a small break here, after which we will have the valedictory session. Thank you.
Dear audience, I request you to be seated. Uh, we will move on to the valedictory session. Distinguished guests, esteemed speakers, and dear participants, as we draw to a close on this insightful journey that has been the Samvad Symposium, it is time to reflect on the incredible knowledge exchange we have witnessed over the last 2 days. Day 1 brought us 4 thought-provoking panel discussions that tackled key themes at the heart of our financial markets. Day 2 built upon that momentum with 5 powerful speaker sessions that offered deeper perspectives from industry leaders, policymakers, and academics on the topics. The conversations have undoubtedly left us with much to think about and, more importantly, act upon. As we now prepare to conclude this 2-day symposium, it's only fitting that we hear from someone who has been a guiding force in shaping this event. Ladies and gentlemen, please join me in welcoming Mr. Shashi Kumar, Executive Director, SEBI, to deliver the valedictory address. I also request Dr. Prabhas Rath, Chief General Manager, SEBI, to come on the stage and then deliver the vote of thanks. Over to you, Shashi sir.
Thank you. Good evening. Good evening. I think at the end of 2 full days, especially youngsters should not be tired. So thanks for this privilege of having all of you all present here for this conference. The topic which was selected was also capital for growth. This is something which each and every person would agree that is something which is most required for our country to achieve our dream of or the goal of Viksit Bharat at 2047. At the same time, for all the sustainable development goals which the United Nations has envisaged, which would be what each one of us would also think should be available for every citizen of the country, finance is what finally drives most of those goals. And where better to think of it than sitting at the center of finance of India here at NSE. So, to my mind, this is an opportunity where Samvad, dialogue, is something which brings together the best of minds to try and look at the problem from different angles. And the youngsters especially would be thinking, the whole range of subjects which we have tried to encapsulate within the 2 days would have been of benefit to them to open their eyes as to what all are the issues which needs to be looked into when we are trying to solve these problems. I know the youngsters would be thinking, what am I to do in this when people are talking of such big terms and big issues which are to be tackled. But it is these youngsters who would actually be delivering our country to what we all are aspiring that we will do and what we will be able to do. So I'm sure each one of them would have benefited from all these discussions. I'm reminded of a story where in our scriptures where somebody asks, small squirrel who goes to help Ram to build the bridge. So nothing small is insignificant. Every person is required to contribute in this endeavor. And I'm sure, just like many of our taglines go, no investment is too small. So to that extent, everyone's contribution is what is looked into. And one can't think that one is just a cog in the wheel. Because, for example, I think, just to again go back to, or maybe in terms of films, I remember Rajesh Khanna's one movie, Anand, which says, Babo Moshai, hum sab rangmach ki Katputliya hai. But to my mind, while the Almighty is the power behind everything, each one of us has a role to play. As I said, we are not just cogs in the wheel. Each one can endeavor and achieve what is required to be achieved. So just like a butterfly effect, which many of you would be knowing, a butterfly flapping its wing at one corner can influence the whole world. So to that extent, every one of us are contributing to this endeavor. So the last 2 days has given us a lot of food for thought to the elders here, practitioners, right from the thought process of what should be the country's dependence on the bank amount raised to what is through the capital markets. Even within the capital markets, what should be the share of government debt versus the corporate debt, how to better the corporate debt market. We also thought about issues where social stock exchange, so another different way where to the bottom of the pyramid, many of the NGOs, how they can raise resources. And the main reason for the market, stock markets, the MIs, is to bring together the buyers and savers and the people who are going to productively use that. And therefore, this is the place where we meet and try and fulfill and see that the productive needs of the economy are being met. And it is our role as SEBI and the MIs to see that we have this place where this productive use is being done, market integrity is in place, proper disclosures are there. So all of this will help in achieving the objectives. So as we said, Samvad, dialogue, this is just the beginning. All this needs to continue in the days and weeks and months ahead so that we achieve. And it will be like the churning of the oceans, which is there in our scriptures. So what we will get out of it would be the Amrit at the end of the life. And to my mind, many of the issues, therefore, which we looked into, including, these are the most challenging times, is what many of the panelists said. At the same time, it is full of opportunities. So we are having not only AI and ML, we are having many things where the needs for health sector, the needs for education, the various things like biotechnology, 3D printing, all the EV. When all of these are opportunities where each of you, the youngsters who are there, if one idea is there, we can solve humanity's problem. Somebody mentioned about Enron and asked whether people are aware. I would, on a lighter note, say that on WhatsApp, last couple of days, one Enron egg is being circulated, which claims to say that if you have the Enron egg, for the next 20 years, you don't require to have any other electricity in your home. So, I mean, that is just an extreme example. But with all the technology, with all the R&D which is going on, I'm sure we'll be able to solve many of the problems which we think today are big challenges, making it an opportunity. And here, in terms of finance and how to finance all this growth, is what we have tried to bring ideas to. So I hope that each one of you has benefited from these 2 days, and I look forward to all the continued participation and encouragement for more such events. Thank you.
I request Prabhas sir to give the vote of thanks.
Good evening, Shashi sir, dignitaries in the audience and the delegates. So, as we know, I mean, vote of thanks is a customary ceremonial thing that I have to extend. But before I come to that, let me tell you a few words as to where this particular edition of Samvad needs a, more intense vote of thanks. So, I mean, we had about 15 hours of deliberation since yesterday, including lunch breaks, tea breaks. 36 subject matter experts spoke here. That also within those 15 hours. And the amount of learning that we got in last 2 years, I think it's immense. It will take months, perhaps years to even get it. So I would like to tell you that what I learned and where I should actually offer a vote of thanks. Let me first justify that. So actually I had a draft vision document based on last 2 days discussions. So let me come to that. So as we know, there were about 10 sessions since yesterday. So what I have done is that I have put a vision document which has a mission and a strategic action plan. And the fourth part is that from there actually we have to really draw the actionables. So what is the vision? The bigger vision and the theme on which we were working till yesterday was a market large enough to support a Viksit Bharat. I think that is what comprehends the vision. The mission that we got, I have put them into 4. It can be more because within the limited time that I could synthesize, so much of perspective and information came. I could put it in 4 mission statements. So the first one is additional annual finance to the tune of 3.5% of GDP. That is about 7.5% or 1/5 of capital formation in the economy through capital market. And that we have to achieve by 2036. The second mission statement, additional 6.5 trillion rupees of equity financing, additional, in addition to what we are already raising now. The third one is mobilization of more savings through securities market by converting savings into investment through greater inclusion in securities market. And that also has a sub-vision statement which says that 50% of population should be in mutual funds, out of which 40% females should be in mutual fund. And that again by 2047. The fourth one, which came is upholding and promoting trust in the market. And so that is my vision statement, mission statement. Let me come to the strategic action plan. So I will just quote 10 because there can be too many. So first one is, let me start from the macro. First one is counter-cyclical regulatory approach to balance demand and supply of funds. Second one is transparency, awareness, dealing with financial crimes to build trust and responsible investing. Third one is learning all the time, being watchful of all the time to have more realistic way of managing risk to promote market stability and investor protection. The fourth one is identification and redressal of root causes for market failures and inefficiencies in each of the market segments. The fifth one comes to corporate bond market and the development of the corporate bond market through unification of bond tradings, ease of doing business for retail bond investors, going down the yield curve in bond market, addressing tax issues and tax issues. So that was the corporate bond piece. Coming to the inclusion, here the focus was on financialization, product packaging, easier entry, digital access for transaction and physical mode for investment advisory and distribution. And also to include the startups on the other side, lower issue ticket size in equity to include small entrepreneurs. Seventh, we discussed about social infrastructure. It was in the context of social stock exchange. So better marketing of social stock exchange concept and orienting social stock exchanges towards boosting human capital through financing, education and healthcare. Then we discussed about physical infrastructure some time back, and the focus was on having in place structure, dispute resolution mechanism, risk sharing mechanism, and transparency for successful public-private partnership models, learning from our fast-paced development of digital infrastructure, focus on research and development for speedier and holistic execution of infrastructure projects, and greater monetization of infrastructure assets to be able to recycle the funds and cater to more infrastructure projects. Then the last two pieces, how technology can be used to support the entire this thing. So one session we had on artificial intelligence, and there the theme that came is that we should not avoid, rather we should embrace artificial intelligence for greater efficiency. Its tool developed, so the AI as a tool is developed by human to be used by humans. Hence, the same checks and balances and the socio-legal judicial system that applies to humans should also apply to behavioral biases of AI tools. And the last but not the least is the transformative human-machine interface through RedTech SupTech to enhance efficiency and compliance in letter and spirit to promote and uphold trust. So I think let me end here with trust. So I think everything boils down to trust. So now let me come to the customary part of the vote of thanks. So as you know, for this kind of an event, there are minimum 6 elements which needs to come together and synthesize to actually produce a blockbuster. So they are the plot, the characters, the actors, organizers, and above all the audience. But to do everything, what we need is the comfort of the venue. So I think all these 6 things came together to actually produce a blockbuster in the form of first edition of Samvad in 2025. So coming to each one of them little bit, on the plot side, I cannot but profusely thank our whole-time member Anand Naran sir, Executive Director Pramod Rao sir, and our Executive Director Shashi Kumar sir. They really set the plot. Not only set the plot, they actually handheld us selecting the characters also and the actors. So these 3 parts, I am so very thankful to all of you for putting this structure in place. And of course, without the relentless effort of the organizers, it could not have been possible. And I know it's not 1 week, 1 month affair. It's an affair of 1 year, if I can say so. Though it actively starts at least 6 months before the events is organized. So I will come to that in a moment. And of course, the comfort of the venue. So, I mean, while we have partnered with all the 4 MIIs, NSC, BSc, NSTL and CDSL, definitely a profuse thanks goes to NSE and the leadership team of NSE for providing us such an excellent and fault-free, hassle-free venue to organize this event. Now I will come to, just give me a second. Just give me a second, because I want to mention few names who needed to be specially thanked for this successful event. And of course, apart from the leadership team of SEBI, NSE, BSE, NSTL and CDSL, there have been people from all these organizations who have really worked hard to give us the benefit of what we heard over the last 2 days. And I would like to first thank Tirthankar from NSE. Without him, this event couldn't have got this kind of a response as well as seamless organization. And his colleagues, Prasanjit, Sushant, Asiana, Prerna, Vijay and Amish. From BSE, I would like to thank Mr. Khusro Bulsara, Kiran and Biraj. From NSTL, Mr. Narayan Venkat and Ms. Malone. So without them, I mean, it would not have been possible. And of course, from CDSL, Ms. Kaveri and Ms. Neha. And I could see, I mean, Ms. Kaveri is there and she has been here, all of them have been here for last 2 days. It is not like they were just doing it. They have been actively participating also. And of course, the last waves of thanks definitely are reserved for my dear colleagues from my department and SEBI. And I may not be able to name all of them, but few of them I will definitely like to name. Dipti LS, and Ms. Dipali Dikshit, both of them have led this initiative, and their colleagues Ashish, Anuradha, and of course Meena. Meena is always enthusiastic, and Meena, all of them have made this possible. So with these words, thank you all, and of course, the biggest thank you to the audience, because without audience, it can't be a blockbuster. So thank you for making it a blockbuster, and we expect the same year and year after. Thank you.
Also, I would like to add SEBI and NISM. So a big thanks to NISM also, along with all the MIS for organizing this. Thanks a lot. And to Shashi Krishnan, Director, special thanks.
Thank you, Shashi sir and Prabhat sir, for your concluding remarks and summarizing the two-day conference so beautifully. On behalf of NSE, I request Dr. Tirthankar Patnaik to felicitate our chief guest and Prabhat sir with the NSE memento.
Thanks for the thanks.
To celebrate the conclusion of the successful two-day Samvad Symposium, we have a surprise cake cutting session on the stage. So I request Pramod sir, Shashi Krishnan sir and Nehal sir to please join us on the stage. Dipali ma'am, could you join us on the stage, please? Thank you, everybody. We have just concluded this conference. We have high tea served in the round ticker area. So I request all our participants to join us there.